presenting.
Thank you, Antoinette. Thank you, Amar. It's really a pleasure to be here. And this is joint work with my wonderful colleagues, Stefan Huber, Bella Shen, Christina Zhu, all from the Wharton School, and they're all here today. Private equity firms increasingly own insurers as direct subsidiaries. Even as these same PE firms are also becoming major players in private credit. The result is a new kind of financial conglomerate operating on both sides of capital intermediation. On the one side, insurers' liabilities generate investable capital. On the other, private capital businesses need capital for loan origination and liquidity management. This integration has drawn attention from regulators and industry observers. As this recent article from The Economist highlights, The Economist argues that the growing ties to private markets make insurers particularly exposed to a private credit downturn. And so that makes us wonder, why is private equity buying up insurance companies? In particular, do PE-owned insurers provide financing, even preferential financing, to affiliated private credit businesses? Here is a stylized ownership structure of this new PE conglomerate. At the top is the PE firm. Think Apollo, KKR, Blackstone. These firms are most commonly associated with the PE funds that they run, which invests LPs' capital into portfolio companies that are ultimately intended for exit. These companies could include insurance companies, but these are not our focus. Instead, we're interested in insurance companies that are directly owned by PE firms. They still invest policyholders' premiums, but they do so within the broader PE organization. Think Athene, which is Apollo's flagship insurer. Athene forms the retirement service segment of Apollo, distinct from its asset management segment. At the same time, these PE firms, they also own lots of private credit businesses, which issue structured securities to help finance themselves. Insurance companies can buy these securities, and when the insurance company, the insurer, and the issuer are under common ownership, that investment is affiliated. So do affiliated investments happen? To answer that question, we construct a novel dataset that maps the ownership links between PE firms, insurers, and security issuers. We then combine this with insurers' holdings and transactions records going back to just after the great financial crisis. We document 3 findings that help explain why PEs are so interested in insurers. First, insurers channel their capital to affiliated private credit businesses through structured securities. Second, when they do so, they actually pay higher prices for the same security compared to other insurers buying the same security on the same day. Finally, these purchase the affiliated securities, in fact, exhibit greater downside risks. This has implications for policyholders. We estimate that in a downturn that's comparable to the great financial crisis, these affiliated structured securities could nearly wipe out insurers' capitalization. And this also has implications for financial stability. Because insurers are also major holders of corporate bonds, CMBS, among others. Now, insurers stands as a transmission channel between stress in private credit to the broader asset markets. Let me start with the backbone of the data that made this paper possible. And these are the PDFs of the complete corporate structure that the insurers file with NAIC. These regulatory filings allow us to distinguish between 2 types of PE involvement. We call a PE-owned insurer an insurer whose ownership traces directly to the PE firm. That is distinct from a PE portfolio insurer whose ownership traces just to a PE fund. We define control as having equity share of more than 50%, though in reality, 95% of the PE-owned insurers actually are wholly owned. Moreover, we think an issuer is affiliated if that issuer is under common control as the insurer. So NIC provides a flag if an investment is with an affiliated issuer. We manually verify that more than 90% of the affiliated transactions done by PE-owned insurers are into investments issued by issuers who are wholly owned, 100% owned by the same PE parent. Finally, we identify PE firms using Preqin. We construct a timeline of ownership using 2 decades of insurance M&A record. And where possible, we manually verify everything against the state regulator examination reports and other public sources. We then combine all of this with insurers' acquisitions data and holdings data, all from the NAIC. So let me show you 3 facts that really demonstrate how insurance companies and private credit have become intertwined. Fact 1 is that direct ownership is now the dominant form of PE involvement in insurance. Since the financial crisis, PE directly owned insurers has increased from just 4 to now almost 140. In terms of the amount of assets that they manage, they now today manage almost $700 billion from less than $1 billion right after the crisis. These growths far outpace that of PE portfolio companies. Today, PE-owned insurers outnumber PE portfolio insurers 2 to 1, and they manage more than twice the assets. So do these PE-owned insurers invest differently? Fact 2 is yes. PE-owned insurers concentrate their portfolios in structured credit markets. To be sure, since the great financial crisis, all insurers have increased their investments in structured securities. But compared to independent insurers that have no PE ties, PE directly owned insurers do so at twice the rate, devoting nearly 40% of their investments to these structured securities. What are these structured securities? They broadly fall into 3 buckets: CLOs, ABS, and privately placed securities. Now, if you look at independent insurers, they invest heavily in CLOs, and even their ABS tend to be backed by very conventional assets like auto loans, credit cards, student loans, so on and so forth. But the picture is very different when you go to the PE-owned insurers. Their ABS, for example, have a lot more exotic collateral, for example, a whole business securitization. But more strikingly, nearly half of their investments are in these what we call privately placed securities. So these are securities that don't have any CUSIP, probably because they're never intended for trading. It also means there's very little information on them. So we really dug into them to try to figure out how they help insurers finance private credit. So at the center is a private credit fund that issues loans. From recent work from Gregor, Thomas, and Amit, we know that these funds are primarily equity financed, about 65% to 80%, with the remainder coming from bank revolvers. So how could insurers participate? Surely holding equity stake in a private credit fund would be very costly because of risk-based capital charges. One solution is rated feeder funds. For example, this privately placed PGIM Senior Loan Opportunities 2. So these rated feeder funds, they take a stake, a limited partner equity stake in the private credit fund, but they finance it by issuing investment-grade bonds. And so to the private credit fund, it looks like LP equity investment, but to the insurer, it looks like rated fixed income investments. A second mechanism is even more powerful. These private credit funds, they don't have to raise financing directly. They can simply sell off the loans that they have originated into CLOs, ABS, or even more flexible special purpose vehicles. That frees up capital, a balance sheet immediately. And that allows these private credit funds to to originate way more loans against the same capital that they have. It also provides very valuable liquidity, which, as we all know, would be incredibly advantageous if you're trying to manage IRR. One good example is this Fox hedge. It's a privately placed SPV owned by Apollo. Its collateral includes direct lending loans, real estate debt, or even tranches of other securities or other securitizations, all pulled from Apollo's various funds. As Bloomberg describes it, it's a smorgasbord of assets plucked from Apollo's own funds. Of course, what gets securitized doesn't have to come from the same fund. For example, this broadly syndicated KKR CLO 40. Its entire portfolio consists of lendings to PE-backed portfolio companies. But these may not be necessarily backed by KKR. It could be backed by other firms as well. So who invests in these assets? Insurers. The PGIM rated feeder fund is invested by Prudential, which makes this investment an affiliated investment because both the issuer and the insurer are owned by Prudential Financial. It also is invested by Nassau, which is a PE-backed insurer, which means that it's not a PE-owned insurer in our definition, nor is this an affiliated insurer. That Fox Hedge SPV is invested by Athene, which makes this a PE-owned insurer's affiliated investments, even as Fox Hedge also attracts other independent insurers like Lincoln National. Similarly, this KKR CLO 40 has an affiliated insurer that's also PE-owned in the form of Commonwealth Annuity, which is wholly owned by KKR, even as other independent insurers are also investing in it. So affiliated investments happen. How often does this happen? Fact 3 is that PE-owned insurers' structured security investments most of them are issued by affiliated entities. As we can see here, for independent insurers, affiliated investments do happen, but they're somewhat minimal. But for PE-owned insurers, more than 60% of their investments go into affiliated entities. So here are the facts. PE firms increasingly own insurers directly. They invest heavily in structured securities that are tied to private credit, and a lot of these investments are affiliated. Collectively, these facts show that PE-owned insurers provide financing to affiliated private credit businesses. But now we're going to dig deeper. On what terms is this financing provided? Namely, is there a pricing difference compared to arm's-length transactions? And secondly, what kind of securities do they buy? Are they riskier or not? Let's start with pricing. For every single transaction, we're going to construct a value-weighted benchmark. This benchmark is going to be based on all other independent insurers that buy the same security on the same day. We then construct a relative price. That's the difference between the focal transaction price and this benchmark. And so this effectively controls for all security-specific characteristics and any market conditions. And it also offers the advantage that the benchmark is based entirely on independent insurers. Now we're going to regress this relative price on the interaction of two indicators, whether the insurer is PE-owned and whether this investment is affiliated. That coefficient on that interaction term tells us whether systematically PE-owned insurers are paying a different price. On average, when a PE-owned insurer is buying an affiliated transaction, structured security, they pay about 6 basis points more. For comparison, an independent insurer, when they are buying an affiliate transaction, if anything, they pay 1 basis point less. This is consistent with these independent insurers, for example, Prudential, being kind of the primary economic focus of these traditional insurance groups. And so these affiliated financing vehicles, they, in some ways, exist to benefit the insurer. But the picture is flipped once you come to PE-owned insurers. Now, the financing benefit accrues to the issuer. We split this into those that are PE-owned, directly owned insurers and PE portfolio insurers, and we see that basically everything is coming from PE-owned insurers, underscoring the importance of separating these two forms of PE involvement. We mentioned earlier that a lot of their securities are actually PE-owned insurers' securities are in privately placed securities. So now let's take the sample, split it into private versus registered. Registered just means that it actually has a CUSIP. And we see that the overpayment is almost 5 times as large in these privately placed securities. Finally, if these are truly financing benefits, we would expect them to really accrue to the primary market, and indeed, that's what we find. This is where all the overpayment happens. But these are pricing, which, as important as they are, is but one dimension. Now let's zoom out and think, regardless of the pricing that they pay, how do these securities perform? Now, because a lot of these investments have been rather recent, it's hard to look at realized losses. So we're going to try to examine ex-ante risk by leveraging this NAIC 2023 CLO stress test, which projects losses for every single CLO tranche held by insurers by the end of 2023. And so what we're going to do is we take each CLO tranche as a unique observation. So this is a security. And we try to see if the losses are greater when a larger share of it is owned by is held by PE-owned insurers, controlling, importantly, for both tranche or seniority as well as vintage year. So here are the 10 scenarios that we have the results for. As you go down the table, they increase both in severity, so higher default rate and less recovery rates. Just for reference, this scenario 8 is on par with what we experienced in the GFC. And here's the result. In benign to moderate scenarios, there's no difference, neither in magnitude or in significance, which is why all the bars are translucent. But the picture changes dramatically when you move to severe stress scenarios. In scenarios 8 through 10, we see that a security hypothetically 100% owned by a PE-owned insurer would have losses that are 60 to 80 percentage points more relative to a security that has 0 PE-owned insurer shares. So what are the implications? PE ownership in insurance is channeling capital to private credit through structured securities to the tune of about $74 billion per year, of which about $45 billion is to affiliated entities. And this financing is coming at on favorable terms, with overpayment amounting to about a financing benefit of $27 million to affiliated issuers. And we emphasize that this is surely, almost surely, a lower bound for a variety of reasons, not the least that this is only identified of securities that are purchased by other insurers on the same day. How are these financing provided? Well, with policyholders' premiums. And so what do policyholders get in return? Securities with far worse downside performance. We estimate that for losses that are comparable to the GFC, we would expect additional losses that would reduce these PE-owned insurers' equity by about 8.9 percentage points, compared to the average capitalization of just 9% for life insurers. Finally, weakened insurers could fire sale or lead to asset sales, particularly corporate bond. And so now insurers are standing at a nexus that provides a transmission channel that could have the stress in private credit spill over to the broader financial markets. So let me conclude. PE firms increasingly own insurers even as they're expanding into private credit. The upshot is that today insurers are part of the PE conglomerate that integrates capital supply and capital demand all within the same organization. This integration has changed the incentive of insurance investing, with implications for both policymakers and policyholders. More broadly, this integration is a reminder that financial intermediation has evolved. Today, understanding the PE ecosystem is essential for understanding the financial market itself. Thank you very much.
Thank you. The discussant is Victoria Waschen. All right, good morning. It's a pleasure to be discussing this paper. So Amy showed some big numbers for overall phenomenon.
This one's gone. Yeah, I think we can only use this today.
All right, cool. It's actually even bigger. So the background here is that as of the end of 2025, there is 1.4 trillion of PE-backed, meaning belonging to large alternative conglomerates such as Blackstone, Apollo, KKR, Carlyle, etc., and other large firms. So 1.4 trillion as of 2025, and basically roughly zero as of 2008. And so that growth is astonishing. Another fact that might be kind of implicit in all of it is there is a broader shift to holding of private assets for long-dated institutional investors, long-dated liabilities institutional investors. This includes pension funds. For example, for pension funds, we know that between 2008 and 2017, the allocation toward private shifts from roughly 10% of AUM to 20% of AUM. For life insurers, and keep in mind, when we say life insurers, the bulk of it are providers of retirement products. So a lot of it is annuities, right? And so this shifts from roughly zero, because it primarily goes to private credit, into 14% of AUM. All right, so with this as a background, so first is that there is general shift to privates among the life insurers, and there are other things going on, such as provision of retirement products. And the second fact is that a lot of these insurers are now directly owned by private equity. Now, with that in mind, there are several concerns that's been raised more broadly. First, because life insurers hold private credit, all the concerns all this big debate about private credit kind of also touches on life insurers. And first and foremost, it's the fact that private credit is a mark-to-model asset. And there is always a concern, is it an accurate mark? Is it an accurate mark? It's a liquid, so are they really reflecting the potential losses? Relatedly for insurers, because they have to be rated, there have been a rise of valuation firms, rating agencies, non-traditional rating agencies. And so there is a concern of whether there is something there, some shopping going there. There is potential regulatory arbitrage. There is a concern about liquidity management as the liability side is being changed and as it's being shifted to private asset. Is there really maturity mismatch building up on this life insurer's balance sheet? And then finally, there is this point about, well, actually, it's all within one big family for this PE-backed life insurers. And so could there be conflict of interest? And so in this list of concerns, by the way, even if we conclude that this is not a big policy concern, we are not like leaving this aside and walking out of this room comfortably that there is nothing funny going on. In fact, if we conclude that this is small, this kind of focus us into something that might be still a big concern. But so we are here, conflict of interest. And what this paper does, I mean, first and foremost, it does a lot of data work, and it finally gets us to this very granular analysis of the portfolio. And that is just amount of work that went into it is impressive, and the authors should get a lot of credit for that. And my comment will be that there should be way more graphs and way more summary stats that just teaches us about what on earth are they doing and are they similar to each other. Now, the focus here on not on this 5-year horizon insurance companies owned through portfolios of private equity, which is in itself interesting, but different phenomenon, but instead on this permanent capital insurance companies as part of this alternative conglomerate. There are 3 results, as Amy well emphasized. First is kind of, okay, now that we map this all, let's look at the portfolio. And that's for the first insight. And then there are these 2 analytical insights that kind of start shifting toward maybe that there is some wrongdoing. The first one is that the price at which they place certain securities, and we'll look into what exactly is being placed in a second, is coming at a premium. So the affiliated life insurance pays a little bit more. The second goes in the direction of this affiliated assets that are being placed on the insurance balance sheet actually have higher probability of default. All right, so 3 results. Result number 1 is just let's get this data and let's understand how this portfolio looks. Here's my take on this main figures that appears on this based on this data. And immediately you can see that there is like big difference between conditional on life insurers, between traditional blue and PE-owned allocation. And you can see how there is a big shift toward privately placed. This will be different slightly from what private is, but privately placed. Now, my take here is that this is an opportunity to kind of provide way more information for us. And I want to see here, what does it look like in a cross-section? What exactly is privately placed? What is the composition? This is a paper about affiliates. So let's look at the affiliate. And importantly, when we look at the composition of assets, we also kind of have to match it to liabilities because there's quite a bit of variation on the liabilities. So nailing this point, I think that this is a great start, but kind of nailing what exactly we are looking at would be great. And hey, let's put names out. So it is 1.4 trillion, but 800 of this, at least 800, because Apollo owns 2 insurances, Blackstone manages assets for 2 insurers, but at least 60% of that is top 4, right? And Athene is 28% of AUM of this 1.4. So why not just this data is public? So let's figure out how they look. In fact, I think that it would be very interesting to understand, are they managed similarly? Because they enter insurance sector very different points in time. And importantly, internally, they organize quite differently as well. And so this will give us a window into understanding what is this might be source of synergy, given that the 4 of them are very differently structured. How the insurance folds and generates synergies within their business. So that's on the descriptive front. Now let's move to the second result and third result. The second is like there is this premium at which the affiliated insurers buy this private assets. And the third result is about default probabilities. Well, I don't think that those attach to each other. And in my view, it's like we'll have to go with one or the other. So first point is that the way it's constructed, the result on pricing is definitely not about C loss. And it's definitely not about mid-cap C loss. It's nothing that's C loss. It's the stuff that doesn't have a QSIP. Whereas the result for default probabilities, that comes from NAIC's stress test, which is focused on C loss, the model is built based on the underlying of the C loss has to have a rating. So right there, this is like completely different sample of things, and it's focused on the C loan in its traditional sense, collateralized loan obligations in its traditional sense, the way they existed before 2008, right? So which is interesting, but there's just kind of, they don't even overlap. It also might be important to understand that the story seems to be leaning towards that, well, this is something about private that never sees the light of the broader market. Whereas the CLO market is actually underwritten, placed by banks. So a broader CLOs, a CLOs that is appearing in a stress test, the pricing is done in the broader market with underwriting by the banks. So I think that it's one or the other, and I'm going to lean towards the number 2, which is a pricing result. So the result is the following. So for PE-backed insurers, on privates, meaning no QSIP, we're going to get this 14 bips in price. By the way, I think it's 3 bips in yield, if that is correct. And then on registered, which is basically the C-loss of all kind, large cap, mid cap C-loss, this is 4 bips, that's in price, which is less than 1 bip in yield. And then when we look at the result and concentrated, so there is a question of like, is this because they trade, right? They can exchange. And so they focus on and show this result that this is primarily in the primary market, somewhere very close to when this was placed. And so there they say for privates that very near the origination of this asset, there is a price of an extra 40 bips or the reduction of yield of 90 bips. They're getting some traction on R square as well. Now, here's the thing. The way it is very neatly constructed, and they're matching something that's affiliated holds to something that an independent hold, like the same security the same day. It's not security, it's an asset, but forgive me if I keep saying securities. So they have affiliated and non-affiliated same day, but that construct kind of narrows them down to something rather unusual. And so it doesn't have a QSIP. It is issued by private, and it's gonna be so it's same day. So to create this match, so it narrows down to 841 tranches of something. And interestingly, this is, from what I understood, is that Apollo, which we said is roughly 30% of AUM of this broader phenomenon, only going to correspond to 52 transactions here. So I think that from this result, I mean, one is like to reflect about the economic magnitude of this and explanatory power. And second is kind of dig deeper into what's going on here. As I already said, it feels to me that the empirical construct of a clean identification has this effect of narrowing us down to something that is very niche and very small. And the fact that the Apollo doesn't hit on that sample in some significant way concerns me, because Apollo is a phenomenon, by the way. So now, outside of that, the other kind of technical comments here is, well, given that the price differential is so small, could it be, I mean, one thing to look evidently is sizes of these positions and the demands that they might have. And finally, the other thing is that the result is concentrated on this primary market, as the authors say, but the differential is way within the bid-ask spreads that you would observe on a primary, like first day market in a CLO. So it's really very hard to say, I'm not sure they'll be able to rule out whether they purchased it in the first day or they didn't. We just kind of see an average price at which they're acquiring. So it's very hard to say that they placed it. But first and foremost, I think that understanding what these 800 plus transactions are and how are they representative of the bigger phenomenon with which we started, that's my first goal. Now, the second comment about this pricing result is economics. Like, why on earth would you do that? And there could be reasons, but they're just not explained. And the point is that if you take a KKR and you take Global Atlantic with an insurance that it owns, well, there's two different subs. And basically we find that there are two subs, they belong to KKR. Investment income at an insurance company, given that their liabilities are largely fixed, belongs to KKR, just to be clear. That goes straight to KKR. Manage whatever they make in their CLO, in their credit affiliate, through their equity position also comes to KKR. So what is the economic reason for why I would benefit from transferring these BIPs from the Global Atlantic into the affiliate of credit? So one needs to kind of put a little bit of structure of what is, take a stand, and probably it's not one reason, and think about how this economics would work, one. And second, does it have policy implication from there? Because it could be something that relates to taxes, for example, or in multiples that the market puts, et cetera, et cetera. All right. Finally, taking kind of a step back from this, I think that it's important to acknowledge that what is the reason why they acquire these insurance companies? And we already said, look, the trend is that the insurers, broadly speaking, life insurers, those that provide retirement products, are shifting toward privates. And they are not alone in that. Pension funds are doing that as well. But the other thing is that it is no surprise that this phenomenon starts with those that were publicly traded or about to be publicly traded, because the big bet is, so the way these firms are getting valued is that the things that value the most are fees on AUM, not the carry components that kind of drips down to them. So it's really about fees on AUM, and the fees on permanent capital, no wonder, worth much more than the fees on maybe you will raise the next fund, maybe not, God knows when it's going to happen. And so when you look at the stock shareholder presentation of somebody like KKR, they are pretty explicit of how insurance helps them to hit AUM, grow AUM, and how it helps with the composition of the fees, which then translates to valuation. So I think it's important to acknowledge that the first and foremost reason why they do that is kind of at very least rooted there. Now, that doesn't preclude them from doing something wrong along the way, but we need to understand why they're doing what economic rationale, and acknowledge that this has to be kind of consistent with this broader idea of why they're accumulating billions of assets. In sum, I think that paper is spot on in like super important phenomenon. I think that they've done a service here from digging through all this data. I think that there is opportunity to educate us about what exactly they're doing. I think there is more heterogeneity across individual insurers, and that gives us a window into understanding just kind of what might be the economics of doing it. We don't need to rush to take a stand. Is it positive and the negative? To the degree that you want to dig into the policy implication, I think you have to pick result number 2 or result number 3. Either one of those will need a little bit more work. For me, even if we conclude that this is small, that just kind of shortens the list of concerns, but doesn't take the conversation away, I still think that's a service. Truly enjoyed reading the paper. Thank you.
Great, as usual. We collect a few questions and then you can answer questions. And, we don't respond to the discussant unless people ask you to respond to particular points. Go ahead. Then Beryl.
I'm going to pile on with another request for Amy. It feels like what we have here is an inverted pyramid with the private equity portfolio company at the tiny tip of the bottom. And, if one thinks about sort of conventional distress or bankruptcy, there's this doctrine of equitable subordination, right? Which if you own both the equity and the debt, your debt is going to be subordinated to all the other debt. So there's this very complex big pyramid of structured this and that. Is it possible for you to figure out whether one of these insurance companies both owns the portfolio company down at the bottom of the pyramid indirectly through a private equity fund and owns the debt, right? Because if the courts figure that out, I'm not sure they could, but if they figure it out, then losses are going to be a lot worse than in the NAIC scenario. Okay, so it's going to be extremely difficult, but why not ask?
Thank you. So I have Vera, Eric Zwick, Philip Schnabel, Gregor Matvers, and then Doug Diamond.
Yeah, really nice and illuminating paper. One thing I discovered recently while looking at bank borrowing from federal home loan banks was that some insurers were showing up, and Athene was one of them. I don't know how it's pronounced. So I wonder if one of the things that the private equity firms are doing is being a little more aggressive in making these acquisitions and then figuring out every single piece of cheap liability that they can hold on to. So because historically the insurers used to own most of the mortgage assets pre-depression, they were allowed into the federal home loan banks at that time. And that seems to have continued as a legacy out there. So it might be interesting to see whether some of the pricing advantages, because these insurance companies that are PE backed are also a lot more aggressive in sourcing FHLB funding, and then they can acquire all these assets because liquidity risk will ultimately be borne by the government.
Eric?
Yeah, it was super interesting. I guess I was sort of thinking about in the descriptive part, learning a little bit more about the tax incentives for a lot of these insurance companies to be established. So I think most of them are in Bermuda, where there's no corporate income tax, or there was until 2025, which could be used as a research design maybe looking forward. But I think you move a bunch of interest income offshore, but avoid some of the tax rules if you were to do it in an operating company that might generate some of the spread, but I'm just sort of curious about the institutional details. I'd like to learn more. Thanks.
Philip?
Yes, very interesting paper. I would like you to comment a bit on that list which Victoria put up in the beginning about all the other issues we're thinking about in the context of these insurers. One issue which I think is quite important, which you mentioned, I want to follow up on, is this issue of rated shopping. So you hear that a lot of the insurers are using private ratings. A name like Egan-Jones usually comes around, which supposedly gives pretty easy ratings. So if you have data on that, that might be interesting to look at separately, but maybe also connect to what you're doing right now. In particular, if you're thinking about whether, because it's private equity owned or otherwise, that they're not making the right investments, the rating agency involved may be one indicator of the quality of the assets, which you could use as well.
Gregor?
So, super interesting and important. And I think Victoria pointed out that the price results are going to have a hard time carrying you very far because they're just kind of small. But I think it would be useful to have a bit of a theory framing of like, why in the world would you want to have your own insurance company hold your own assets? And there's like, I can see there's two classes of theories. Like one class of theories is like, well, I'd love to sell all of this stuff to everybody else. But like, like in Victoria's like job market paper, I think it's like, well, I'm signaling that this is good stuff and I'm going to therefore retain a bunch of these private things as, in my insurance company as Apollo. Okay? And the other one is, I think the one you're pitching, which is, to rephrase a little bit differently, the reason why I stuff all this stuff on the insurance company balance sheet is because I have awesome subsidies on funding called, the collective insurance pool that is going to bail out the insurance company. So the equity holders who are Apollo are not the ones who are going to collect the losses. It's the ones insuring the insurance company, right? So these are the two theories, I think, broadly that we can have in mind of why in the world you want to stuff your insurance company with your own assets. And that, I think, tells us a lot about like, where should we look for theories or evidence of which one it is, right? Like if I'm collecting a lot of insurance premium, then, sort of this insurance option, it's probably the weaker guys who want to do it. It's on policies where insurance bites more and so on and so forth. If it's about signaling, quality, like banks do in syndicated loans when they hold their own thing, we probably look at it a little bit different. So I think that's part one. Framing it in theory, I think, helps a lot on thinking about quantity. The other one is on the stress test stuff. I was wondering, can you tell us a little bit about idiosyncratic and systematic risk of these things? Like, it seems like if I buy a bunch of CLOs, that like loads up like Koval, Stafford, Eurex stuff, right? You're loading up on systematic risk. If I buy a bunch of like full loans, that's idiosyncratic risk. Those in crisis should perform very differently. How do I think about your stress testing? And that would be sort of something that I'd want to understand a bit different. Thank you.
Thank you, Doug.
So again, I learned a lot from this. I'd like to know a little bit more about the institutional details of how the primary market works for these things. So thinking about like under normal securities, there's like an underwriter, there's an offer price, and if it doesn't sell out, the underwriter sort of stabilizes the price pretty close to the offer price. It's part of the deal. Is there something like that? Like, are these underwritten? Are these self-sold by the issuer? And then could we think about the purchases by the insurance companies as being part of trying to stabilize the price if the thing doesn't sell out? And second, it'd be interesting to know, like, if you know a lot about the liability structure of the individual insurance companies, is that related to whether they do this or not? Sort of, there's a sense that annuity contracts can be cashed in after you have them for a few years. So there's sort of annuities are runnable where life insurance sort of post the 1980s is not.
Luigi, and then I give you 5 minutes or 3 minutes to respond.
So I'm no expert in insurance, but I would like to add the third hypothesis to what Gregor said, which is that if I understand correctly, when you run a life insurance, you're running assets for the insuree, and the return is accrues to the insuree, not to the insurance company. So if you stack bad assets in that reserves, in that pool, you are ripping off the customers, the people who are insured. I know for a fact that in Italy, generally used to do that, put the bad assets into the reserves for the insurance. So I think the question that also was raised about what are the benefits, because you seem to take from one pocket and do to the other. I think my hypothesis is you are stealing from the pockets of the insuree, and that, of course, is net value added for the for the private equity industry, but it's a disaster for everybody else. And it takes a long time for customers to find out, because when you retire, you figure out that the return on your insurance has not been so good. But by that time, sort of KKR and Apollo have made a fortune.
Great. Why don't you take, 5 minutes to answer?
Great. Well, first off, just want to thank everyone for their comments. I would love to continue the conversation during the break. And thank you so much to Victoria for the wonderful discussion. I think there have been a few questions that came up that are all aimed at trying to better understand this data. And certainly we're also trying to do the same. In particular, I think the overarching question really is, why are PE companies doing this? I think the question is really why are private credit funds doing this? I mean, to be honest, for quite some time now, I was wondering, why does it make sense for private credit funds to be doing loans? If their financing comes from limited partners that take 8% cut before they can even earn carry, that's incredibly costly capital. So how does it make sense that they're doing these not alpha from a private equity fund, but like these beta type of investments that are earning spreads on the loans? Well, the answer has to be that they have to do it at scale. And where does that scale come from? It comes from all sorts of cheap financing. Insurance capital is one way for them to obtain that leverage in some sense. And I think what Virala suggested as looking at Federal Home Loan Bank is another excellent suggestion of trying to see how they're scaling up this industry as a whole. And I think certainly the suggestion by Eric and by Mark about other aspects of the data will really take to heart. To Phil, thank you for the question on rate shopping. In fact, in this audience, there are 2 author groups that are working on exactly that topic, who are looking at kind of the different ratings that insurance companies are obtaining from different rating agencies. What we can say is that I think our evidence is consistent that there is some rate shopping, right? Because the CLO stress test is holding constant a tranche, i.e. holding constant a rating. Yet within the same rating, same vintage, you still see dramatically different performance, especially when it comes to tail events. And so that to us is certainly evidence consistent with what these other authors are documenting about the possibility of rate shopping. And to Gregor's comments about framing why this phenomenon exists, I'm with you 100%. I think we should do better. I think for us, it's much harder to imagine that this is about signaling, but we can potentially get at it by just looking at the amount of securities that are placed within owned insurers versus other insurers to see if signaling is actually doing its job. Finally, to Doug on primary market, that is actually one of our suspicions as well. We were going to try to follow up to see if the primary market pricing paid by these insurers could help predict kind of secondary market pricing thereafter. So thank you so much for that suggestion. And on Luigi, I think you're spot on. I think, yeah, I'm going to leave it at that. And more broadly, I think this really is a phenomenon where we're trying to highlight the integration of parts of the financial market that we didn't think could be affected by private credit. We used to think that because these are all equity financed, then these investments are somewhat insulated. Even if there were a downturn, the equity holders, the LPs of the funds should absorb these losses. But now we see that they're actually turbocharged. Not only are insurance companies involved on the liability side funding them, but also on the asset side, taking off these loans from the balance sheet of these private credit funds. And so in general, I think these are just things for us to think about. Should insurance companies be the people bearing these risks? So thank you all so much for your comments and questions.
Great. We have a break now and we'll be back here at 10:30 sharp.
I'll be in the back.
I'm helping you. I'm giving you a cue.
Okay, great. Welcome back, everyone. The next paper is Leveraging to Lend, a Theory of Flex Credit, and Ulf Axelsen is going to present.
Thank you for putting our paper on the program. I feel we are in the affirmative action theory slot. So be prepared for some theory. So this is joint with Igor, who's also here. So let me start with seeing if I can move this slide. I mean, I can do everything off this slide, but it will, okay. So let me just start with an observation about how financial intermediaries finance their activity. It's like very broad picture across private equity, venture capital, commercial banks, charter banks, etc. Is like a dimension that I think we haven't paid as much attention to as we've done to just normal capital structure on the liability side, is this prevalent use of both balance sheet capital when you do your deal and kind of off-balance sheet capital, or what we call deal-by-deal financing or third-party financing. So this is done in commercial and shadow banking when originators sell off part of their loan portfolios to outside investors. It's done, or in syndication, the lead investor generates a loan, corporate loan, and then syndicates with a bunch of other banks. It's done in private equity, of course, where you have LP capital financing deals, but you top up with deal-level debt capital from banks, and even in venture capital, actually, because they use similar debt, venture debt, when they do it. So this is just seems to be a very prevalent phenomenon that we would like to understand more about. Now, when you talk to practitioners, which I'm forced to do sometimes, even though I'm a theorist, it's often puzzling when they talk about how they use this outside capital when they do deals, because they usually say things like, oh, it's great, we can lever this deal because we have a high hurdle rate, so levering up will make it increase our IRR, and then we can meet our hurdle rate. And you're like, have you heard about Miller Modigliani, Proposition 2, et cetera, et cetera? But they do kind of talk this way a lot. And we're going to actually have a model where they seem to actually rationally act that way as well. Okay. Now, this third party or deal by deal capital has come under a lot of scrutiny. Maybe the prime example is the financial crisis, right? When the originate to distribute model led to, like, at least according to some people, too lax lending standards, over-lending, and then things went really bad. So regulators has tried to do things about that. The same thing is actually true if you look at the private equity, which my only real empirical paper actually shows that when you have situations where it's easier to raise this outside leverage capital in private equity, these guys go kind of crazy and do more deals, but typically, on average, worse deals, and the returns, even to the levered equity, typically is lower for the private equity firms in those periods. So we're trying to set up the simplest model we could, which turns out to be somewhat complicated, that actually explains some of these things in an equilibrium setting. Now, what we're going to use is something we used in a kind of previous recent paper, is also the observation when we model these intermediary markets, primary capital markets, that we think they're mostly decentralized in the sense that firms are going to the markets, kind of like we call it sequential credit markets. You go from one PE fund or bank to another, and you try to get financing. So that's going to be an important part of our market setting, is kind of the sequential nature, because you'll see how that goes into the result
here. So what are we going to show? I'll try to explain how we get this. First, we're going to show why you do this mix of balance sheet capital versus this third-party capital. I'm going to show it's basically a competitive instrument. So using leverage, in fact, does make it possible for you to compete more for deals, okay? And it's going to be actually efficient when you look at this individual meeting between, let's say, an entrepreneur and a bank that's financing them. And that increased competition is actually going to lead to better situation for entrepreneurs because they get a lower cost of capital. So it's going to be individually rational to use this thing. But then we show that, in fact, it's socially inefficient relative to banning the use of third-party capital. And that's going to be because in these dynamic or sequential markets, we show that in each round, this entrepreneur and the bank they may be approaching are not fully internalizing how the effect on their future credit quality, if they get rejected, is going to happen. So there's going to be this externality where you tend to do too lax screening in each round. So your credit quality, if you don't get financed, goes down quickly, and it in fact leads to too many projects that shouldn't really be financed. And that's how we think we explain some of these aggregate patterns, okay? And we say, actually, regulating away this third-party capital, even though intermediaries typically say, we really want to use this because it's good as a competitive instrument, is actually good for social welfare, and it would actually make intermediaries richer because it would give more rents to intermediaries collectively. It would actually be bad for entrepreneurs because they're going to end up paying out too much rent to the intermediaries. Okay, so that's what the results I'm going to try to show you in my limited time. I'm going to jump to related literature. Most important is, of course, our other papers there. So I'm going to try to give you a flavor of how we get these results. So what we have is just there's a bunch of entrepreneurs out there seeking financing, okay? And we make it the simplest possible way. They come in, there's some prior that can be distribution of firms that can be good, and they would be positive NPV. You need to invest 1 unit of capital. You get an excess NPV of X if it's good, and you lose all your money if it's bad, okay? To help make this market more efficient, we have these expert-informed intermediaries, okay? So we're going to have big N of them. The big N is going to basically be the parameter that says how much competition is there between them, but also how much potential information is there that we can use. So each of these intermediaries can screen this project if they're approached, and then they're going to get a private signal, which is obviously, if it's a higher signal, then it's more likely that this is actually a good project, okay? And the third people we have here are just some competitive, uninformed capital market. And they are going to basically be able to provide balance sheet capital to the intermediaries. And in fact, in our model, there's no agency friction there. You can actually raise this balance sheet capital without creating any conflicts of interest, okay? And then they're also going to be able to provide this deal-by-deal third-party capital, okay? So we're going to see how things change when we do that. So here is a bit more structure on how the competition works in this sequential market. And there's different ways you can do it, and they're all kind of fine for most of our theory, but this is kind of what we find to be the neatest way, okay? So this is what people in search call a directed search market, okay? So we have this entrepreneur coming into the market. Everyone can see how long they've been on the market. They first face this market where there's all these N possible intermediaries. All of them are going to post some financing contract that they're willing to kind of like engage with the entrepreneur at. So that's going to be some fraction of your own balance sheet capital at some interest rate, and some fraction of potentially third-party capital at some other interest rate. So they kind of compete by posting, but this is before they actually draw their own signal. The entrepreneur picks one of them, and then that intermediary engages and says, we have this contract, now I'm going to screen. If I accept, then we start the project at these terms. If I reject, you can try your luck with other people, but I'm out of the market, okay? So the entrepreneur basically, if he doesn't get financed, he goes all the way to the end where there's only one investor left. Okay, that's a bad situation because that guy's kind of a monopolist, okay? And if he gets rejected there, that's when this thing doesn't get financed, okay? So if any of these people finance it, it's financed and we run it. Otherwise, it's not financed. So social welfare will just be, how many good finance do we finance minus how many bad we do, okay? And of course, credit quality is going to go down here if you get rejected. So we have this prior of how many good firms are left after each rejection indexed by T. And that obviously goes down after rejections, and it goes down more if there's laxer screening in the beginning. So the ones that actually don't get financing are actually worse lemons, okay? Now, I'm going to see if I can then give you the flavors of the result in a butchered version of the model with only 2 periods, okay? So think of only 2 periods. So that means there's 2 intermediaries that compete in the first period. And then if the one who wins ends up rejecting, there's only 1 guy left, okay? Now that guy is going to be a monopolist at this stage. So it's basically gonna, and I'll have that on this slide, it's basically gonna say, look, I'm monopolist, I'm gonna give you this take it or leave it offer, I'm gonna charge you all the biggest interest rate and take all the cash flows. So I get the full NPV of the project. So how does this screening work? Well, I'm going to start with a situation where you only use your own balance sheet capital. Okay, so that's basically the intermediary finances the whole project, and if it succeeds, they get a net interest rate R, and that's what we compete on. Okay. So how do you set the screening threshold? That's that equation there. It basically says, how low can my signal be for me to accept this project? Well, that depends on the interest rate that you have, right? So my cutoff signal, the lowest one that I finance at, is where I just break even, obviously, on my financing contract as an intermediary. But that also implies that any higher signal, I'm going to make rent. So there's informational rent for any inframarginal project, okay? So let's just, in the last period, again, this is where the last guy can basically say, I'll take all the cash flows, okay? So he basically owns the project, this intermediary. And what I'm going to use the same graph 6 times, so it's the same thing on the x-axis and y-axis. What I'm plotting is basically the signal that the intermediary gets. The big fat line is the NPV of the project, and then I'm going to show how you split the rents. So conditional on the signal. So this is one where this last intermediary basically fully internalizes everything. There's a cutoff. Above that, there's going to be positive NPV, and this orange thing is basically the surplus that you create and the rent that the investor gets. The only thing to notice about this is how big that area is depends on how much people screen in the first period, right? So if rejected projects for the first period are expected to be really bad, that area is going to be smaller, and the equilibrium in the model is with many investors is going to drive that thing down, okay? So now let's look at the first period, and people only compete in interest rates. Now, in the first period, these 2 guys are competing on interest rates. The stage surplus between the entrepreneur and whoever financing them is now going to be purely the net present value in the first period of the project, because they don't get, neither of them will get anything from the second period, because this is second guy will extract everything. So they don't really care about the second period. That's where this externality is going to come from in the 2-period model. So if you want to maximize the stage surplus in the first period between the investor and the entrepreneur, you basically should do all NPV positive projects. The problem is you would have to give the first intermediary all the cash flows for him to do that, make that, internalize that and do that cutoff. So that's not going to be the equilibrium because the entrepreneur gets nothing, and this is a much bigger surplus than your outside option of wait into the next period and do the kind of shitty credit quality project. So they're going to bid down the interest rate. That's actually going to mean that this is the orange line there is a profit line for the investor with lower interest rates. That's going to do two things, and that's actually the problem. It does two things at the same time. It reduces the rents to investors, but it also increases this cutoff. So you do stricter screening, okay? But you're going to want to do that because at least the entrepreneur gets that gray area there, okay? So if you only look at this period, actually this interest rate competition leads to underinvestment in the sense, normal sense that you don't want to give everything to the informed party, you'll keep some, and therefore they're not going to do exactly the best decision. So how does this change? And there's also some rents here to the investors, okay? So how does this change with third-party capital? So third-party capital, as I said, is you say, we're going to have a contract that says we are only going to use 1 minus delta proportion of our own capital at some interest rate RI for intermediary. And then we're going to, the rest, delta for like debt or leverage or whatever you want, is going to be raised from these third-party guys. And we prearrange that, okay, at some other interest rate, RD, okay? So what does that do? Well, let's first, the screening in terms of how much you screen as an intermediary is now completely determined by the intermediary's return, okay? Just like before, they have to break even on this thing, but the fraction of rents they get is multiplied by 1 minus delta, okay? The third-party people just need to break even on average. They realize that this investor will screen and use a certain threshold, and they just say, given that threshold, I need to break even on average, okay? So I need to just break even. So that basically means they don't need the same, they're not going to get the same interest rate. They're actually going to lose in marginal states and gain in really good states, and on average, they break even. So how does this help? Well, you can see here, this was the equilibrium with only interest rate own capital competition. Now, you would like to deviate if you're one of these investors and say, look, I can do this thing where I said, I'm going to do a sliver of my own capital. I'm going to put the interest rate to X, which is where I do the efficient screening, but I do it kind of like on only a smaller part of the capital. That's going to give me that's going to maximize the whole state surplus. And I can give the entrepreneur as much as before because I increased the surplus by using this third-party capital. So the third-party capital guys are in the background here. They decide the slope of this line. They basically lose on worse signals and gain on better signals, but on average they break even. So you can basically give the entrepreneur the same. So people will want to use this when they compete, but this deviation is not an equilibrium because both of them will compete. And actually the equilibrium turns out to be that they compete until the entrepreneur is getting much more of the rents and they have higher leverage. Now, why does this happen? Well, it's because you can see that this thing now has much laxer screening, which means that rejected products are much worse credit quality in the second period. Your outside option is therefore much worse. So you compete even stronger and you end up giving more of the rents to the entrepreneur. Now, I have like 1.5 minutes. The overinvestment result should be pretty easy to see in this thing. So remember, in this first period, in this bilateral meeting, you don't internalize the NPV of the product in the second period. Okay, and that's why you want to set this screening threshold so low, okay? That's actually not socially efficient because you see these marginal products that just barely positive NPV, it would be much better to leave them to the second period and see the new guy who gets a signal can tell more whether this is actually worth doing or not. You want to leave some of those projects to the second period to get a better investment decision. So this actually leads to too much financing, there's laxer screening standards than what a social optimum would do. And in fact, what the interest rate, a pure no third-party capital competition would do. Because without the third-party capital, there's underinvestment in the first period, but that's actually good socially because that helps like leave some of the projects to the last period. So I have 0 minutes. In my last 0 minutes, I'm going to just tell you that this all extends to any number of rounds you want. So this is like where you have to go to the paper and do the difficult reading. You can increase n to any number you want. You're still going to have the same effect of third-party capital and the same overinvestment results. And also that if we ban this third-party capital, it would increase welfare, it would make intermediaries richer, but it would be make entrepreneurs worse off. I think that's minus 1 minute, minus 2 minutes. All right. Thank you.
Good job. The discussant is Kristen Upp.
Okay, great to be here for the affirmative action slot. This is great. So this is a very nice paper where the authors study third-party capital in the context of sequential credit markets. And I really like, and I'll highlight this quite a bit in this discussion, this novel role of third-party capital, limited exposures of the lead financier. And what it does in this paper, it allows separately setting the informed investor's credit standards and how much rent that informed investor gets, okay? And so it turns out partial, at least in the stage game, having only a partial exposure to the investment for the informed financier is actually increasing surplus. Now there's this dynamic effect that I'll talk about as well, where it actually can backfire, but it alleviates, it's a tool to alleviate a tension between, on the one hand, surplus maximization, on the other hand, moving more rents to the entrepreneur. Okay, so that's very neat. And then there is, however, an additional friction, in particular that there is hidden renegotiation in these bilateral meetings, and the contracts that are signed after the renegotiation cannot be certified and revealed credibly to other investors. And that is the friction that then leads to overall, if you look at the whole game across rounds, to overinvestment and too lax credit standards. And then to counteract that, you can go back and actually restrict third-party capital. So I'll get more into that. Okay, and then these mechanisms are nice, tied to a range of applications. And so what I'm going to try to do in the discussion is to make sure that we sort of fully understand what are the key ingredients when this applies, because I think there's a really neat insight here. But it obviously doesn't apply in every setting, right? And every time, it doesn't apply every time there is a limited exposure of a lead arranger. There might be other things going on. So I want to drill down on so everybody understands, okay, here's really where it applies so that things don't get lost and we can actually, you know, in the appropriate empirical settings, then say, okay, this may be going on here. And then you have more of a contribution and don't get overlooked to some extent, okay? So I think it's a useful, insightful analysis. All right, so let me go into the stage game. So I'm highlighting here first what is public and what is private, because that's important in terms of the information set. So we're starting out a stage game, right? The Ulf was showing multiple rounds of financing. I'm now drilling down on one of these rounds and what's going on. And there's a whole timeline of what happens first and next, and that's all important. And so we start out where the investors that are around are posting terms, they're competing in a centralized venue, actually. Okay, so the entrepreneur sees all these N remaining investors, and they're making offers, and they're competing both on an interest rate and on how much they use third-party finance versus their own finance. Okay. And then the entrepreneur chooses one of those guys, and then we go into hidden renegotiation. Okay. So now that we have some exclusivity because we've chosen one investor, we're now moving into some exclusive renegotiation that is hidden, where also the contract that emerges from this hidden renegotiation cannot be certified and later shown to other investors in later rounds. Okay, and that's the key friction that leads to overinvestment. Okay. Then the third-party capital is arranged. That's also private because these guys know what the contract's terms are, and so they're not revealing that to later financiers either. Then comes the private signal. That's also important, that there is a commitment to third-party capital prior to the signal being obtained. That's very important. If you flip those two, things can change. And then finally, what is public is whether then after the due diligence, the informed investor rejects or not. Okay. If rejected, we're going to the next stage game with the remaining investor. The investor that just went through the due diligence is just exiting, is not sharing information with other people. Okay. So now what is the friction within a stage game? Okay, so if there's a competition, which there is upfront, the first bullet point here, public competition in a public centralized venue between investors. So with this competition, you have a push toward moving rents to the entrepreneur, right? Competition, it gets multiple offers. But the problem is that once you are in the exclusive relationship, that if you haven't given the investor the full rents to the project, there will be underinvestment. Okay, it's because the guy, if there's no third-party capital, he puts up all the capital, but he doesn't get the full return because there was under competition on the terms. So if you're putting up all the investment while only partially internalizing the benefits, you're going to have underinvestment. Okay, that's the thing that we're going to address with third-party capital. We're going to resolve that problem by putting in third-party capital. Now, there's the friction, as I said, across rounds, which is this issue that the private renegotiation leads to contracts that cannot be certified. And in the next round, you only see that something was rejected, but you don't know what terms were rejected. And so in principle, the entrepreneur would like to say, look, I got rejected by tough standards, right? And that's why I'm showing up here. But it cannot credibly certify that the previous contract was tough. And so that leads to sort of an unraveling where that leads to 2-lakh screening in each round. Okay. All right. So now I want to highlight, you see there's underinvestment and overinvestment. So this is the theory of the second best. So if you're now addressing the underinvestment by introducing third-party capital, you're stuck with the overinvestment. You may actually want to restrict third-party capital so the underinvestment force counteracts the overinvestment force. That's sort of the big picture where things are coming from. All right. Okay. So how does the third-party capital work? As I just said, if we have ex-ante competition, we're not going to give the financier that is going to be exclusively interacting with us all the rents, and therefore there will be underinvestment in isolation in the stage game. And so what does third-party capital do? It separately fine-tunes two things. Think about the pie here being total surplus. You want to find the right credit standards to maximize total surplus, right? You want to set that separately from how much rents this informed investor gets. And so you need kind of two tools to induce that. If you just have one tool, which is just the interest rate that you give to the informed investor, you're mingling up both the threshold and the rent that you give to the investor. Okay, and so if you have two tools, you can separate those. In this case, the second tool is how much you're effectively diluting your stake by giving part of the exposure to third-party capital. Okay, so you're getting a higher return, but only on a small stake. If you get a higher return on a small stake, you're overall not making lots of dollar rents, right? And so that's the basic idea. So total surplus, stage surplus can be maximized. But again, as I said earlier, there's both the underinvestment problem that we can fix, but then the overinvestment problem stays, which is the cross-round issue that we can't certify these contracts that were renegotiated. Okay. Are there alternatives to third-party capital? again, what is important here is that we're sort of in this specific setting, we're locking in the financing terms before the investor gets the signal, and then there's some exclusive relationship, right? And there's an ex-ante commitment to dilute your stake. You get a high return on the small stake. The rest goes to the uninformed investors. Now, are there alternatives? This has the flavor of a two-part tariff, right? Where you want to disentangle surplus and sort of marginal types that accept and reject. And so you could, in principle, with other restrictions, you could also implement this with a breakup fee, okay, where the informed investor signs a contract with the investor that says, if after the due diligence I find that I don't want to fund you, I'm going to pay you a breakup fee. Okay, and then you wouldn't need third-party capital, because then you can also, you have two tools again, the interest rate and the breakup fee. Okay? Now, the paper does point out, and that's again what I want to get into, which is correct. There might be issues with the investor being able to commit to such a breakup fee. Okay, so technically speaking, that's interim participation after seeing the signal. Can you just walk away and not make any payments? That would be one reason why the breakup fee doesn't work. The second reason why the breakup fee might not work is that if you have these contracts out there that pay people if they get rejected, then you might have a bunch of fake applicants enter, right? And so that depends again on the context. Are we in a situation where that could happen, or do people have ex ante sufficiently good prior information about entrepreneurs so that this flooding in doesn't work, right? And so again, I think it's useful here to feel it out and think, okay, where does this fit? And I think there are applications, right? So it's just, I want to highlight that this is essential. So again, you can commit ex ante to third-party capital and financing term, but you cannot commit, for example, to the breakup fee. Now, again, the really neat insight here, which goes a bit counter to what we usually think of. We usually think more skin in the game is good, except for risk-sharing reasons, but more skin in the game is good. Now here, limited exposure of the informed party is actually good in the sense that you can separately determine how much rents go to your entrepreneur and also maintain efficient investment, at least in the stage game, right? And that's a neat thing. And I want people to remember when does this apply, and then also use it going forward when there are settings where this fits. Okay. Now, what are the frictions? That's also important, always important when you think about what are the welfare implications, are there policy, regulatory implications, right? And so we have here a bunch of frictions: private signals, sequential and exclusive due diligence. And I'm saying here they're friction/restrictions, because I'm going to get into some of those. I think are more like in the paper, there are restrictions, but there might be in practice actually endogenous responses to deeper frictions. That's where I'm getting. And again, to interpret the results more. So we at the same time, apart from these various frictions, we do have centralized communication available. As I showed you in the flow chart, up front, we have public communication and competition, right? And we also have this public registry of all the rejections that occurred. Okay, so there is a centralized communication technology you can reach each other. And then there's some questions that come up that if the centralized communication and interaction is feasible, which would lend itself to a centralized market in principle, why is the market structure still sequential? And why are these exclusive interactions there post-signal? Okay, because you could also have, I'm just going to meet everybody, sequentially is fine, but then after that, I'm going to ask everybody to make offers then, right? That rather than having sort of locked in an exclusive relationship prior to signal acquisition. And then the other question is, and I'm going to do this only briefly, we can deliberate on why can the renegotiated contract not be certified? You have DocuSign or whatever that would potentially allow you to make sure that you can certify to the next financier. Look, I signed this contract. He rejected me, but you can see it's a tough contract that was rejected. Okay. All right, I'm going to drill down on the first now, though. Okay, why do we have this exclusivity? In the paper, in principle, it's just taken as given and to some extent as a restriction/friction. I'm going to argue that it's actually also interesting, again, from a welfare perspective, to think about where is this coming from? Why do we have this in practice, right? And I think one strong point there is that, and it's related to the existing literature, Fishman has a paper, Bulo Klempera, and I also have worked with Vincent on this, that this post-signal exclusivity is actually a way to commit your deal flow to one specific investor. And that's necessary if there is costly information acquisition, right? Why would I go through the effort of acquiring information if then all of a sudden everybody, hundreds of people are competing simultaneously? I have less of an ability to extract rents after the fact then, and then I might not even acquire information in the first place, right? So you have, absent this type of commitment to exclusivity, in a broader world where there is information acquisition, this exclusivity plays a role. It plays a role. It's not a friction. It's actually a response to the presence of information acquisition costs. Okay, so you couldn't recoup potentially your information acquisition costs if you don't have some of that exclusivity, and also it might not be efficient to have everybody acquire that, even if they have incentives to do so, because then you have a duplication of effort, right? Especially if these signals are correlated, right? All right, and so long story short, the sequentiality is plausibly responsive frictions, and that plays a role when we now think about what is the relevant planner, benchmark, what are the policy implications. So in the paper, the planner directly chooses the funding thresholds in this exclusive market structure, or sequential at least market structure, and basically stops. So the planner does not just wait for all the signals to come in, aggregate the information, and then make a decision, which in principle, without information acquisition costs, would be the optimal thing, right? With information acquisition costs, again, going back to what I said earlier, actually the planner might not want to have everybody generate those due diligence signals, okay? There's also, the paper doesn't really get into the incentivizing of investors, of implementing the planner solution. And there's also in the paper, the entrepreneur actually has information, and you might think about how the planner could extract some of that information, although there is the way the assumptions are set, it's a sort of a knife edge case where you actually cannot. All right, so suggestion is to think about alternative benchmarks, accounting potentially for information acquisition costs, or to have information aggregation. All right, the last point, and then I'm going to close, is again to think, when we think about these applications, which are potentially nice applications, to get into the details of the key points that are highlighted, right? There were a couple of frictions that are sort of essential for the different results, right? You can a little bit disentangle. One friction has this intertemporal effect, one has the stage game effect, leading to third-party capital. And I just want to make sure people have full transparency about what you need for what and where you can apply what, also from a regulatory perspective. So again, overall, a very nice result. I think it learned something about the role of third-party capital in this type of environment, and it was a pleasure to read it. Thank you.
Thank you very much, Christian. As usual, we'll open up for questions, and then you can answer. Vish, Doug, Luigi?
Yeah, I guess the question is asking is, if you had full disclosure of the negotiation, would you get the first best with the outside capital? Yeah.
Yeah, very interesting idea. So it seems like the thing that's most general rather than the specific thing on hidden renegotiation is that you can use this commitment to a fixed percentage of third-party capital to disentangle the screening from the rents. So if you took that as the most general point, so I can sort of see that like in private equity funds and things like that. It's not so clear like for loan sales because you can sell a variable fraction of those. But maybe if you think about regulation, maybe like the Dodd-Frank thing that puts a lower bound on the amount that you might want to sell, maybe that would actually be a good thing because you might get a corner solution where you just retain exactly that amount. But so I'm not sure how important that is. It seems to me that if you take that super seriously, then as these other things, the amount of rents, or if you had the cost of information changing, or the distribution, so the screening thing, you'd want to have the amount that was sold to the outside move around in a state contingent way. So I don't know, maybe that's testable, but it doesn't. That's
Luigi? Thank you. Maybe you'll take the other.
Yeah, so two things. First of all, in practice, is it true that the contract terms are given before the due diligence? It seems that most of the time is the other way around, and to what extent is robust? Second, at least thinking about venture capitalists, very often what they do is they say, I'm gonna finance you if you find somebody else that finance a share. So imagine that you allow that contract, which is, I think, perfectly feasible within your structure. Would you get closer to the first best or even potentially the first best? Because if you divide enough, you collect all the information and you might approach the first best.
I just wanted to understand the connection between this paper and the recent Burke de Marzo paper, which kind of also thinks about separating the allocation of rent to the allocation of investment, and in some sense has a similar feel to it.
So it relates a bit to the discussion's point at the end about costly ex ante endogenous acquisition of information. It seems to me that if you allowed that, there would be a delegated information acquisition problem. You know, you'd be duplicating all kinds of information generation because you want to find out what other people have funded. And then it would create a natural scale economy in that model. So you want to delegate to an institution rather than it being from arm's length investors. So I think there might be a theory of why venture capital funds are like large and they are kind of seen as a replacement for a market that could exist, but that would not be very efficient.
Yes. Thank you.
So the optimal contract when there's no third-party capital in this paper is debt. And I was wondering how you think about angel investors, where they're investing their own money, so there's no third-party capital. But in practice, the contracts often seem to take the form of equity. So I was wondering what your results would look like with a baseline optimal contract of equity rather than debt.
Miss anyone? Haoshan, go ahead.
Could you clarify the learning of the investor across periods? Because I can imagine that if a project got rejected 20 times, the 21st VC would say, this is surely a bad project because this didn't really survive 20 rounds of learning. So I'm not sure if that's captured in the model.
Okay, I'll give you 5-6 minutes, and then if there are other questions, we can take another round. Okay, gentlemen.
Yep. Think wish, if the terms are observable, then as the number of investors would go to infinity, we would get to the first best. So that's what would happen, but these are arguably strong assumptions. Fixed commission and state contingent contracts, I think this is fair. The problem is intentionally simple. In our case, we don't need state contingent, but in a more complicated model, that's probably could arise. And I think it's also related to Luigi's point. Well, what is important indeed in our model is that we need to pre-commit on what terms uninformed investors essentially are financed. So how much capital is there? And I think it's an empirical question to some extent, whether or in what settings this happens or not. At least the theory prescribes that maybe the efficient way to do. Of course, if after we obtain the signal and kind of raise the loans and then kind of can do cherry picking, then of course it would go against the mechanism in this paper. So to the extent that maybe again that holds to some extent, I think our mechanism has a bite. So, but that is important. Now, Adriano, Burke and DiMarzo connection, I guess it comes from the FTG where Burke was saying, oh, it's the same. So there are certainly similarities in the sense that, but their model is a one period model. So, and I mean, for people who are not aware of that model, so this is a model of, say, an extension of a Burke model of mutual funds to hedge funds. And then in the hedge funds, we see that hedge funds collect some rent as opposed to mutual funds. And then the kind of that model tries to explain, well, why is that? And so on. And the explanation is, well, because of capital lockup and information is not free. So kind of there should be some screening, and then we need to compensate intermediaries for kind of for that information. And then they also have this two-tiered capital, and the outside capital serves the function that it allows to bring the informed intermediaries to their reservation utility. So that is a similar aspect, but the aspect of moving kind of the dynamic nature of the model kind of it's specific for us. And I think it's also like this over-investment result there. It's just one-shot model. Viral. So that's, I think there is a also related and deep question, what is the efficient structure of this market? In a way, we have signals, right? Or we have, like, we see who everyone screens and so on. And then the question, well, if we all can get together and get one aggregated signal about one, this project is good or bad, that probably was efficient, but then it doesn't interfere with the incentives to get this information. And then we actually have a collection of papers now. We started, our first paper was about centralized market, where people looked, kind of obtained the signal, and then they kind of posed the contracts on centralized market. And we show that actually under some assumptions, natural assumptions on how the market works, and kind of, if we want to preserve incentives to get this information, then generally there is no easy way to aggregate this information. So it's a fundamentally difficult problem. And angel investors, I don't know, Uf, maybe you more familiar with angel investors, you can.
Yeah, the angel investors, I think I don't see immediately how. I agree, they probably don't use third-party capital. And you can then ask yourself, why wouldn't they do that? Unless they use kind of like a syndication, if you think of it as a syndication, which actually works similarly to our setting. Do I have time to make some other comments? Okay, I'll tell Luigi. I do think actually the way I interpret these markets is that you do actually, in a way, commit to contracts term before you do your final due diligence. Okay, I mean, it may be in stages, but when I talk to the VCs and the PE guys, they often say, look, there is this standard type of, especially VCs, there is this standard type of contract that we have, and we compete in that, conditional on then accepting the investment. Okay. I think also in PE, it's like you have these rounds where they say, okay, we put this up. These are the financing terms, but obviously if we're going to engage in this, I'm going to do my final screening as well. And we actually show that's an optimal mechanism to do it, actually, if you want to go to the mechanism design part of it. So I do think that, and I think banks do the same. They have like post-it. I mean, if you do mortgages and stuff, it's all post-it. So I do think it is like that. Now your point about the VC syndication is like, I'll do this if also this other guy does that. That does actually get around some of these frictions, not only in this setting, but in the other ones we've had. It's it would be often a better way to solve some of these problems. I think that's where you go back to the I think the discussant, who I thought was very good. Thank you very much, Christian. Where I feel like also in the back of our minds, we kind of have this idea that micro foundation for some of this is just costly to produce these signals, so you don't want to do it. You want to be sparing in how many people are going to do this. We've tried to put that in the model, but it's a freaking mess. So we left that for Christian to work out. But and And Doug, we have to think more about the institutional setting for loan sales, because I think there are ways they commit to this, but I'm a little hazy. So it's something we need to think better about, that institutional setting.
Can I ask
yeah.
one more question, maybe related to this, is that how, would it be interesting to think about a continuation of informedness of the third party? Because especially in private market, you have some that are completely uninformed, but some that are partially informed, and more the third party capital is trying to become a bit more informed, maybe not as informed as the intermediary, but somewhere in the middle.
Yeah, I think that's, actually something that also the discussant has worked on, which I think actually can fit in some extension of our model. So actually one implication of our model that I didn't stress is that our third-party capital in the way it's set up has to be deal by deal. Okay, so it's not securitization. It's not like pooling these things together and then selling that off. It's actually an important distinction. And I think this is usually what happens, is that the originators are not the ones who securitize. I agree that if we thought of like different levels of informed investors, you probably would have that, yeah, we need some people doing that. They could be a little bit informed, not as informed as the guys who originate, and then we can go down this chain with this distribution, which I think is one of Christian's nice papers, is kind of doing a similar thing that could work kind of like together with our setting, I think.
Final, but 30 seconds.
Okay, just following up on some of the comments. So on Luigi's point, so were you actually saying that there's, in terms of mechanism design, it's optimal to post the terms first and then do screening? And what would happen in your model if you reversed, if you could screen before? And the other thing, there was a discussion of the cost of information, but I didn't see any explicit cost of acquiring the signal. Is there, and how does the information market work in your model?
We don't have costly information acquisition because it's a mess. The answer to the first thing is, if you just look at this stage game where you say, we're two people, I could potentially have a signal and we're going to split the rent some way. Yes, it's an optimal mechanism to have a posted contract that I then either accept or reject based on my signal. That's an optimal mechanism. We actually show that in the paper.
I think we missed how Zhang pointed
Yeah.
out just.
Okay, but you talk to Hao Zhang afterwards. So, yeah, out of time. All right. Okay, good. All right. Excellent. So we are now moving to the third paper of the morning, estimating the impact of loan supply shocks. And Nita Bergman is going to present. Go ahead.
Great. Thanks for the invitation to present. It's been a while since I've been here with all the stuff going on in the world. So it's nice to be back and to see everyone. In any case, this paper is joint with Alejandro, with Raj, and with Itai, and it's about loan supply shocks. So, this isn't a room that needs to be convinced that understanding the impact of loan supply shocks is a key economic question. And as we all know, the core empirical challenge here is separating loan supply and loan demand effects. Okay, so think of a bank being hit by a supply shock. So for example, a large deposit withdrawal. There are two basic questions you can think about in estimating the impact of this shock. The first is the loan level response. Okay, so does the supply shock cause the bank to reduce lending to the firm? And if so, by how much? Which is to say, does the bank transmit the shock to the firm? The second question is the firm level response, which is by how much does the firm's total borrowing decline across all of its lenders? And of course, the answer to these two questions is generally different because the firm can reallocate borrowing across its lenders. But it's the second question, which is the firm level response, which from a macro perspective is the more interesting one because it's going to help us understand things on investment, employment, output, et cetera. Okay, so I'll be talking today about two approaches. One is the well-known Khwaja-Mian approach, And this approach provided a very important insight. Okay, so now it seems second nature, but this was almost 20 years ago. And that is, let's use firms borrowing from multiple banks to separate supply and demand effects. Okay, so here is like a version of a KM fixed effect regression. You run the change in lending from bank J to firm I. Okay, so banks are always J, firms always I. And you run that on some sort of bank level loan supply shifter WJ, such as deposit withdrawals and firm fixed effects. To the extent that the demand shock is at the firm level, it's going to be absorbed by the fixed effect, and you're going to get this KM coefficient, which is often interpreted as measuring the loan level effect, which is to say the answer to the first question. So you'll see sentences such as a 1 standard deviation increase in the loan supply shifter reduces bank lending by X%. Okay, so that's approach 1. Approach 2 is more well-known in the macro finance literature, and this is the Amiti-Weinstein bank and firm fixed effect regressions. So here what you're doing is you're regressing the change in lending on bank and firm fixed effects. Notice there is no loan supply shifter, there's no W. Instead, the bank fixed effect is interpreted as capturing the total supply shock, and the firm fixed effect is interpreted as capturing the demand shock. And then what you do is you run a real effects regression, right? So you run whatever, change in employment on these two fixed effects, and the coefficient on the bank fixed effect is going to give you the loan supply impact. Okay, so our paper is divided into 3. So in the first part, which has to do with the KM approach, we show that a significant KM coefficient does indeed confirm that the bank transmits supply shock to borrowers, but the KM coefficient does not measure the loan level effect, is not the answer generically to the first question. Instead, it recovers an elasticity of substitution in borrowing. We also show that the commonly used test for seeing whether demand and supply shocks are correlated, which is the main line of attack to try and get at the second question, the firm level question. So that test does not recover the relevant correlation and therefore cannot justify firm level regressions. We then build a simple micro-founded model to discipline empirical analysis and derive an estimator for the firm level effect, derive an estimator for the loan level effect, and derive a test for the lack of demand and supply correlation. Turning to AW, we show that the bank and firm fixed effects do not correspond to the demand and supply shocks, which has the implication that the real outcome regressions are going to be misestimated. And we then derive a method to obtain the corrected demand and supply shocks from the bank and firm fixed effects. And then finally, in part 3 of the paper, we apply these methodologies to the 2011 Spanish debt crisis and show that the new estimates paint a quantitatively different picture. Okay, so that's set up. So here's the model. It's actually quite simple. Essentially a page. So we have a firm. It's got no internal wealth. It borrows from 2 banks. We can do general N as well. So the firm borrows L1 from bank 1, L2 from bank 2. Borrowing and investing a total amount L yields a present value R of L. We assume that raising external finance is costly. Okay, so with a deadweight cost associated with raising an amount Lj from bank J equal to this power function with the exponent rho. Importantly, changes in this AJ variable are going to capture shifts in bank level loan supply. Okay, so as AJ rises, that's going to shift upwards the firm's cost of external finance from bank J. And what the firm is going to do is it's going to maximize the present value of investment minus the financing costs, where the financing costs are the L's and the costs of external finance. Okay, so that's it. It's structural but very light. And so now what we're going to do is essentially log linearize and let the model speak. As a first step, it's useful to just take the FOCs of this problem, divide one by the other, and you immediately see that the elasticity of a substitution in borrowing between the banks is given by this 1 over rho minus 1. Okay, so this is going to give you what is the change in the relative amount of borrowing between the banks, these L's, given a change in the relative costs of external finance. So that's the EOS. Okay, how about the first object of interest in the model, so namely the impact of supply shocks on total firm borrowing? Well, if you denote changes in time with delta, and you log linearize the FOCs, you get that the impact on total firm borrowing is given by this equation here, to the first order, which is to say what? That the change in total lending is determined by the weighted average of the supply shocks
where the weights are the pre-shock borrowing shares, and by an elasticity parameter theta. Okay, so we call this the total firm borrowing elasticity. And this simply governs what is the response of total firm borrowing to the weighted average change in lending costs across the banks. And we show in the paper that this theta essentially depends on the curvature of the NPV and the curvature of the cost functions. And that has some nice intuition, which we don't have time to go into now. What is important now is, first of all, this theta elasticity is negative, which makes sense as total costs, as external finance costs go up, total borrowing goes down. And also, this EOS is more negative, we can show, than the total firm borrowing elasticity theta. Okay, so that's the total firm borrowing elasticity. How about the loan level elasticity? Is at the bank level, I should say. So once again, if you log linearize the FOCs, you get the response of lending from bank J to changes in the cost of external finance are given by this equation here. Okay, so this equation is the key equation in the paper, and we're going to give it a name. It's the scale substitution equation. And what it gives you is essentially a decomposition of the change in lending by bank J into two intuitive components. Okay, the first is a scale effect, which captures the impact of the weighted average bank level loan supply shocks on lending. Okay, so that scale effect is essentially the same firm level effect that you saw in the prior slide. The second effect is the substitution effect, which simply reflects the fact that when the relative cost of lending from bank J rises, okay, so that's this AJ over A minus J, so when that rises, LJ is going to decline. And by how much is it going to decline? Well, obviously, that's going to be governed by the EOS. Now, if this thing looks vaguely familiar, that's because it is. In essence, this is a Slutsky equation. Okay, so in fact, you can rewrite this equation, just rearrange terms and whatnot, and that's going to give you the loan level response, the answer to the first question. Okay, so what is that? What is the impact of a shock to bank J on bank J's lending? Okay, so that's the own price effect. And if you look at it, you see simply the weighted average of the two elasticities, the scale elasticity and the EOS. And then you can look at the cross price effect as well, right? So what's the impact of bank minus J shock on lending by bank J? Okay, so that's the cross price effects, which are going to turn out to be important. Okay, so one more thing before we go to the empirics. Okay, so till this point, we've considered shifts in the cost of external finance in these AJs, but we don't see those. So assume instead, as the literature does, that we have this WJ, which is an observable bank level loan supply shifter, such as deposit drawdowns, credit line withdrawal, whatever, all these shocks. And now conceptually relate the change in the total cost of external finance to the loan supply shifter with a linear projection. Okay, so there's this B1 transmission coefficient there, which takes you from W space to A space, to the cost of external finance. Add two more components. One is firm level demand shocks, which would be Higgs neutral anyway, but anyways, put that aside. And the second thing is noise, because empirics. And what you get is the empirical counterpart of the scale substitution equation, which you saw a second ago, which also reflects, you see there in red, the demand shocks and the error terms. Okay, so let's revisit some empirical approaches. Here they are. Let me just say that the key messages here are actually model independent. So the first one is that the KM is an EOS. So here is the KM regression. Again, this is often interpreted as the loan level effect. This interpretation is not right, though. Okay, so it's very easy to see. Take the difference in the KM regression between the two banks. The firm fixed effects are going to drop out, and what you see is an EOS specification. Beta KM is in EOS. Now, why is that? Why is this EOS different from the loan level effect? It's precisely because of the cross price effects. The fact that as W2, so say only bank 2 is hit by the shock and bank 1 is not. As W2 changes, the cross price effect is going to make L1 change, which is going to make the impact on the ratio different. So it's all about the cross price. Okay, you can run through the model as well. I'll spare you the algebra. You're going to get the same thing. Okay, so KM, EOS. Now we've got these three objects of interest here, and we can rank them. We know that the firm level lending elasticity is larger than the KM coefficient. We know that the loan level lending elasticity is weighted average. So you have this ranking: most negative KM, then loan level, then firm level. I should say that this ranking is model dependent. In any case, a negative KM coefficient indicates the existence of a loan level effect. Okay, but it overestimates the magnitude of the loan level elasticity. Okay, point two. We want to get to the firm level effect. And we all know we can't use firm fixed effects at the firm level. So the standard thing that's done in literature is a test. You run the KM regression with and without fixed effects, and you compare the estimates. And if you find that these two estimates are the same, okay, so this is the test, you conclude, the literature concludes that there's no supply and demand correlation, and which would allows you to run the firm level regressions. We show, however, that the difference in these coefficients is not an estimate of the supply and demand correlation. And intuition is that in addition to capturing the correlation between supply and demand, there's another term there, which is the correlation between the bank supply shock and the average bank supply shock. And this additional term stems from the cross price effects. The situation, in fact, is even worse. Because if you indeed have convinced yourself that these two coefficients are zero, okay, once you take into account the extra term, in fact, it suggests that the correlation between supply and demand are positively related, which means that your firm level regressions are going to overestimate the effect of loan supply shocks. Okay, AW, very quickly, again, the way these things are interpreted is that the firm and the bank fixed effects are respectively interpreted as the demand and supply shocks. We show that this interpretation is not right. The firm fixed effects, in fact, contain demand. Okay, that makes sense. But they also contain part of the supply shock. And what that means is that the real effects regressions are going to yield biased estimates of the loan supply shock. And to the extent that you do various aggregation exercises, that's going to not work as well. So we've done KM, we've done AW. There is one case where the KM coefficient, which is an EOS, does equal the loan level effect and the firm level effect. And by the way, AW works. And that is the knife edge case where there's zero cross price effects, which is to say zero substitution and borrowing across banks. Okay. So what we're going to do is develop some new estimators that don't make an assumption on the degree of substitution, and then let the data speak. To the extent that there is zero cross price effects, these three objects are going to collapse into one. Okay, so let me try and give you some intuition of what's done here. So let's try and get a total from borrowing elasticity. Well, consider again the scale substitution equation. We can't run this because we have the demand shocks. If we could run it, then we'd immediately get this B1 theta, which is the total from borrowing elasticity. What we can estimate is the following scale substitution regression, which throws into the error term that demand shock. To the extent that the demand shock is correlated with supply, you're going to get the standard thing, which is that D1 is a biased estimate of the total firm effect, and D2 is a biased estimate of the EOS. Okay, so we show that under we think are reasonable assumptions, you can obtain a consistent estimate of the total firm elasticity. And intuition is as follows. So again, D1 is biased for the thing that we want, this B1 theta, where the bias is driven by the correlation of demand and supply shocks. Which is to say that we want this covariance term. How do we get it? The thing is to look at D2. Okay, so D2 is also biased. It's biased for the EOS. The nice thing is that the KM coefficient gives us the unbiased EOS. So by comparing D2 to the KM coefficient, we recover the covariance term between supply and demand, and then use that to de-bias D1 to get to this B1 theta, to get to the firm level elasticity. And therefore, the upshot of this is, we have an estimator for the total firm borrowing elasticity. This is, of course, model dependent, I should say. And as a bonus, we have a test for whether demand and supply shocks are correlated, right? That's that covariance term, which one should use if you want to justify running firm level regressions. How about the loan level response? Well, that's very easy. The loan level effect is simply the weighted average of the EOS and this B1 theta, and the firm level effect, well, you have them both, so the weighted average. How about the cross price effects? Well, those are also dependent on the scale and substitution, again, Slutsky. So we have those as well. In terms of AW, Again, we've shown that the bank and firm fixed effects don't correspond to demand supply shocks. We derive a method in the paper to get at these supply and demand shocks. And there's a trick. We actually use the KM coefficient and our estimate of the firm borrowing elasticity. And those are the shocks which you can use in real effects regressions. So I'm running out of time. Let me really briefly show you some of the empirics. We use data from the Spanish debt crisis, which was of course related to real estate. We need a loan supply shifter, so we use a standard one, which is the pre-crisis real estate exposure of banks. Okay, so this is our bank level loan supply shifter. And if you run it, you're going to get a KM coefficient that's at minus 0.221 over there. There's an interpretation of it, right? An EOS interpretation, a standard deviation increase in the relative real estate exposures reduces the relative amount of borrowing from the bank experiencing the shift by 2.5%. More importantly, here is the estimate of the firm level effect. That's this B1 theta. So you see it's around, or sorry, it's less than half of the KM coefficient. And the loan level effect is, somewhere in between. So using the KM as a measure of the loan level effect in this case is going to overestimate this effect by 50%. Here you see the bank fixed effects from AW and the corrected loan supply shocks. Here is the real effect regression, in this case looking at investment. So in the left column there, that's a standard AW regression with bank and firm fixed effects. In the right column, you run the same thing, but with the corrected demand and supply shocks. And you see that the estimated effect is halved with the, when I say estimated effect, I mean the estimated effect of the supply shocks is halved with the corrected loan supply and loan demand measures. I will skip this. I mean, you can use other types of real effect regressions. Let me just, I'm concluding. So, okay, so what we show is that the KM and AW methodologies work in a knife edge case, and we can discuss how knife edge it is, but in a knife edge case of zero cross price effects. Okay, once you step away from those zero cross price effects, the tools do not work. Okay, so the KM recovers an EOS, not the loan level effect. The commonly used test for whether demand and supply shocks are correlated doesn't recover the relevant correlation and therefore can't justify the firm level regressions. In fact, if you find a zero there, you should strongly suspect that they are correlated in the wrong way. We then build a simple model to discipline our empirical analysis. We derive an estimator for the total firm borrowing effect, an estimator for the loan level effect, a test for demand supply correlation, and then in terms of AW, a very similar message. Okay, so the bank and firm fixed effects don't correspond to what we want them to correspond if you're outside of that knife edge case, and we derive a method to obtain the corrected demand and supply shocks. Thank you very much.
The discussant is Amos.
Great. Well, thank you again all for coming. One of the great things about doing research is we, take time to go back to like very classic papers, really think them up very carefully. And I really commend the authors for writing this paper. It made me go back, reread the existing literature, really think hardly about what's going on here. And so I'm going to try to unpack a little bit of what I think the core issues are. So Nitai did a great job presenting the paper, so I'll do it pretty quick. So they write down a formal model to uncover the economic meaning of the regression coefficients that we see in firm bank level data sets. And I think that's a super welcomed exercise. Of course, back when Khwaja Mian first came out, it was a paper about Pakistan, and now we have credit registries everywhere. We even have credit registries in the US now with the Y14. So we need to think carefully about what econometric strategies do in those settings. Now, they write down a specific formulation of how firms substitute their lending across banks, and they find that under that specific formulation, the results that Nitai showed you are completely true, that a firm fixed effects regression identifies the elasticity of substitution, not the change in lending induced by the bank. The firm fixed effect coefficient estimate overstates the change induced by a shock to a bank. And a small gap between the firm fixed effect and OLS regression in the firm bank panel does not imply a lack of bias in the firm level regression. And the results are presented as a critique of the existing literature. And they propose a new technique rooted in the model to try to kind of uncover this bias. So obviously, when we have a paper that's presenting results as a critique, we have to kind of go back to the original work a bit just to figure out what exactly was there. And so in that regard, I do want to just basically kind of tell you what my reading is. So my reading of the literature is, first of all, and Nitai very nicely in the slides pointed this out, that the Kwajalein paper is, I think, pretty transparent in terms of saying that it is a knife edge theoretical point, right? So in the setup of the econometrics, there is a model there. It's a toy model. It's not nearly as rich as this model. They basically just don't allow substitution. There's just no substitution. If your bank cuts you off, you're done, and you can't switch. And I think that the authors have a very valid point that that is a crucial assumption. And I think that is important to emphasize that under that assumption, all of the conceptual points of the Kwajalein and the papers that follow are valid. And so, if you are using these techniques, you are inheriting that assumption. Now, the playbook to think about that assumption in this literature is one you could complain about, but I think it is what is done, which is let's go to the data to try to justify that assumption. Let's justify the assumption that it's very difficult for companies to substitute, right? So that's how that literature works. So, for example, in the abstract of Kwajalein, they use their own methodology to then assert that small firms cannot substitute across banks. And I think we had a great conversation over lunch yesterday that one critique that's not really in this paper right now, but could be there's kind of a fixed point problem. You're using the methodology to then assert that they can't substitute, right? So I think that's not right now in the paper, but maybe that's, having reread it all again, I was like, oh, it's kind of interesting. And by the way, so I'm not going to cherry pick here. I'm going to use the 4 papers they cite in the footnote that says people have followed their methodology. And I'm going to show you all 4 papers follow this playbook. So Raj's own paper basically goes through and says firms are not able to perfectly substitute, right? Chodorow Wright, the classic paper, which this is nice because it's not using Kwajalein to justify the lack of substitution. It uses syndicated loan data, it uses the persistence in the relationships, and it basically argues, well, look, guys can't substitute. They can't switch, right? So Jimenez et al., I mean, I could show you pretty much all you got to do. I didn't even have to use an LLM for this, right? You just go to the paper, search for the word substitution, and all the papers have this argument. Guys can't substitute. So again, it's important to recognize that that's the core idea behind the methodology. So, we had a useful discussion. I did these slides before, so I'll probably tone down some of the slides now that I understand better the paper. But I do take the paper right now as being just the opposite extreme, which is a CES substitution pattern among banks. Now, that makes a lot of sense in trade when you're thinking about a company choosing between two inputs in its production function. I would argue it doesn't really make that much sense in banking. Maybe as a benchmark, it's maybe a Modigliani-Miller kind of starting point. But the assumption is, I don't think innocent here. I think the assumption is quite important. Obviously, substitution effects are going to be way important in a model, a CES model, right? Relative to what we think goes on with banks. And the CES assumption, in my mind, is crucial. In the conversation we had yesterday, Nitai and Raj have convinced me that maybe it's not so crucial, but I think that the paper needs to develop that. That's not in the paper right now, okay? So I think, again, just to kind of try to summarize that conversation, I think their point is, as long as you have any cross-price elasticity effects, cross-price effects, then these theoretical results won't come through. But again, I don't think that contradicts anything that's been written in the past, which is people have said this is a knife edge case where these theoretical results go through, okay? So then I will pick on this assumption, right? Because this constant elasticity of substitution assumption on the way in which I, as a medium or small bank in Pakistan or Germany or Portugal or even in the US, the way in which I'm going to substitute across banks I think we have decades of research that suggest that it's not some smooth way of doing it, right? That there's going to be constraints, there's going to be difficulty in doing it. We have tons of models, obviously going back to Stiglitz and Weiss. We've got the idea that there's borrowing constraints based on collateral availability or covenants. There's relationship-based lending, there's geographic constraints. I would argue that none of these are encapsulated in this CES structure, that you need a kind of harshness of a constraint somewhere, and that's not in the current paper, okay? Other than in section 6.3, where they do say in the knife edge case, and Nitai did a very good job of just explaining that, in the knife edge case, essentially all the Kwajalein kind of insights go through, okay? So again, there's probably, I think that's the future of the paper. Right now, the cost formulation in the paper does not like nest these frictions. There's no way of taking them and saying, you might think, well, rho goes to infinity. That's what we would do in CES to get Leontief, right? That's not credit rationing, right? That's, I don't use the other thing because it's way too expensive or it's not going to help me. It's not, I would love to borrow more from this bank, but they've cut me off. That's a different thing, and it's not nested in this framework, okay? A kind of more minor point is that the empirical framework doesn't allow for you to separately even estimate rho, at least now. That could probably be changed. So we can't even really judge exactly like whether it's a reasonable number or not. So again, I think this fixed point problem of using these techniques to then assert guys can't substitute, I totally agree, and that's something this paper really made me appreciate. That's a little circular, right? So what I'm doing here is showing you two papers that don't even cite Kwajalein. They don't cite Amity Weinstein, that use completely different techniques. Simone Lenzu's paper and a paper by Banerjee and Duflo, one using Italian data and one using Indian data. Again, they're using very different techniques to try to basically say that the relevant margin of adjustment in these settings is, Simone's paper basically says 100% credit rationing, that there's almost no adjustment of the cost of borrowing, so that rationing is super important. Banerjee and Duflo obviously also say that credit constraints seem to be first order. So then I think I can skip this because I think Nitai did this exactly right. I will just say the Kwajalein paper does show that the two effects are equal, which does suggest in their setting credit rationing is super important. And so therefore the diagnostic would suggest this is not the right model to explore what's happening in Pakistan. So to try to be more kind of constructive, and I think we had a great conversation yesterday, so I've already relayed these and we talked through them. I think just more clarity in the exact exercise that's being done, right? The literature assumes, and again, based on the conversation, I would change the word limited to complete, so that's right. The literature does assume the complete inability to substitute. How do the results change if you use a CS structure? That's the nature, I think, of the theoretical exercise in this paper. I think 6.3 is the future of the paper, and I think this could end up being a really, it's already a very nice paper. I think it could be a home run paper if this is done properly, which is let's take a more realistic setting in which you have both constraints, but you also have some notion of substitution, and how would that ultimately lead to kind of empirical estimates that we could actually extract what we want to. And maybe the conclusion will be, let's just stop using fixed effect. I don't know what the conclusion will be, but I think that would be something that I think would really be a game changer in terms of adding to this literature. And I think, again, the paper deserves a huge amount of credit for just pointing out that this knife edge assumption is super important in this setting. And then finally, I think, I've already hinted at this with the Banerjee and Duflo paper and the Lenzu et al. Paper, but at least give us some sense as maybe we can approach settings and try to give a sense of, what the frictions are in substitution, what the frictions are that can then guide us a little bit better on what we should be using. But overall, I want to just take a step back and say, look, I've been doing, mostly empirical, but a bit of theoretical research in my own career. And I think papers like this are super important. And by the way, they're super hard, right? And I think they deserve a huge amount of credit for trying to do that. That is, let's take econometric techniques that applied researchers are using and think carefully about what the models are that justify those techniques.
I think that that is just such an important thing for us to be doing. And so I really am trying to push the authors here to extend the boundary and really make it a little bit more general so we can really learn when should we be using these estimators, when should we not. It definitely made me appreciate more deeply the underlying assumptions in this body of work. And I think hopefully the whole audience does. Like, okay, this is a pretty knife-edge strong assumption you're using when you're using these techniques. But as it's currently structured, it does seem to replace one extreme with another. And I'd like to see the kind of flesh out in between. But overall, I want a huge amount of success for the paper. And I think it's a great paper worth looking at. Thanks.
Thank you very much, Amma. I will, take questions as usual, and then I give you time to answer. Is that? Sorry? Oh, okay, yeah.
So if I had discussed this paper, it would be the shortest discussion on NBER. I would say, yes, I agree, and sat down. In the paper with Philip and Veronica, we started with CDS, and banking people hate the CDS model. I mean, it's meant as a metaphor, so we understand it. And we substituted with a model in which firms do different activities. In our paper, it was you export to China and you export to the US. And in that setting, you can actually, starting from that point, and each of these, funding each of these activities requires specific, let's say, knowledge by the bank. You can end up with something that very much looks like the CDS, and then you end up with something that makes sense. But here's the question. That's just a suggestion. Here's the question. Once you have that setting, you still have in your model a firm demand shock. But if the firm is doing these different activities, the demand shocks are not anymore firm level demand shocks. And in that richer world, you have another slew of problems that start kicking into these estimates, because now the demand shocks could be demand shocks that affect more the type of credit that's provided by a particular bank. And then you're back to, without necessarily even the CDS, you're back to square one in terms of identification. So another potential line of inquiry probably is just acknowledging that potentially these demand shocks are not just a firm level thing, but it affects activities. And I think that potentially gives you a richer set of counterfactuals to consider where the bias is coming from.
Thank you. Actually, let me take my prerogative, because my question to you was somewhat similar to what you just said, which is, one could have thought that the knife edge case is the strongest when there is a lot of specialization in what different banks do, because then the substitution becomes impossible, right? Let's say if there's a bank that does the underwriting for export versus just your collateralized lending. But that situation is probably the one where different loans also pick up the sensitivity to the business cycle the most, and therefore are the least useful for identifying the demand effect, right? Or cleaning out the demand effects. And so this is really, kind of the real conundrum in a way between the work, right, that both of you guys or your teams have been doing. Anyway, I shut up here. And so I have Anil, Anjan, Jeremy, Max, did you have your, no, I somehow always get you around. And then I can tell her, right, exactly. Yeah.
Like every 5 years, I get asked to discuss a paper and I make a point that's similar to what these guys made. So I think this is super helpful. But the way to see the kind of schizophrenia in quasi-neon is to remember they're estimating this for people that borrow from two banks. Okay. So right away, how is it impossible to substitute if you've already got two banking relationships? Say, second, and this is something that anybody who's ever used the credit register data see, that there's got to be a theory of where those AJs come from. So different banks have different marginal costs, whatever it is. If you look in the credit registers that I've looked at, people walk down, or I guess they walk up the supply curve. If you go and you see in Italy, I've literally done this, you see that there's like 5 or 6 bank relationships often. You exhaust the cheapest one, then you go to the next, then you go to the next. So it's going to look like you're credit rationed, but you're not credit rationed at all, because you take down as much as you can from the cheapest one, and then you you go that way. That tells you that there's some substitutability, okay? And then you need a shock where the length of one of those supplies expands to be able to test exactly the thing that Amr was talking about. But as soon as you know these two facts, that you're borrowing from two and you probably took out most of the cheapest one first, the idea that you can't substitute is crazy. Of course you could have gone to the more expensive one. And so it's the size of the gap that matters. I don't know, people are impervious to this critique because it's been made by many people. I'm sure Daniel's heard it 20 times, but you should have been suspicious. So I think you guys could add a test to what you're talking about by saying, when you do have these multiple banks, if there's substitutability, you're going to see that you use the cheapest one. And that's going to tell you something about the way that people are substituting. So I think you could go back to the Spanish data and just check the extent to which they literally just march up the supply curve. And that would, I think, be helpful to identify it. It's going to be harder to get the shocks that would allow you to uncover this stuff.
Thank you. Anjan and then Jerem.
Yeah, so if memory serves me right, the Peak and Rosengren paper on the credit supply shock for these Japanese banks, my recollection is that there was some substitution, but not complete, right? So you could make up some of the loss in credit supply. So I think that's evidence too, right?
Jeremy wanted to ask Gabe.
Two quick comments. First, in terms of the literature, I don't see her here, but I thought a lot of the similar arguments were Noemi Pinardan-Tuati's job market paper. She has an appendix where she works out some of these CES relationships. So I think that'd be a useful reference to make contact with. Second, on the magnitude, so I should have prefaced, I think it's a very useful and very clean exposition. On the magnitude of this elasticity of substitution, and this sort of builds on some of the comments Amr made, if you think about the trade analogy, a standard point in that literature is short-run elasticities are a lot smaller than long-run elasticities. So in the trade literature, that's a J curve. Here, it's things like going to the other bank, if you need a new bank, setting up the relationship, if you violated a covenant, and that's the reason that the bank is cutting you off, getting over that covenant violation and being able to borrow again. And so for thinking about the practical importance of this for things where you're looking at short run outcomes, I would think that we're much closer to the Leontief case. If we're thinking about medium run or long run outcomes, then we're probably pretty far from the Leontief case in terms of the ability of firms to substitute.
Atif, now for the defense.
Thank you. For anyone who has been in this profession long enough, you know that the worst thing that can happen to an academic is to be forgotten. So, so thank you to the authors for remembering us 20 years on. I just wanted to say a couple of things. I really enjoyed it. Okay, another short anecdote. When I teach to the PhD students, I tell them, you know, the great news is every equation in the world is identified. So there is no such thing as an identification problem. The only issue is you're just not sure what words to use. So if you use the right labels for what you're estimating, every regression that you can imagine running is identified. And it sort of sounds to me that this was one of those issues that's partly playing out here. So let me go back to the original Khwaja and Mia paper. One of the, which I thought was the main result is that I always thought of that as that there is no known level effect. And that's exactly what Nitai said, that, you know, you're estimating substitution. And so that's why one of the headline results, it's in the abstract, if I remember correctly as well, that for large firms, the effect is zero, basically, because all you're capturing is the substitution effect. But I don't remember exactly, maybe we used the wrong words and we called it whatever Nitai said we called it. But in my mind, it was all very clear that this is substitution. So I don't think, like, it's not like you're not really attacking me. I knew that. We said that in the paper, and that's, of course it is. You know, it's not, It's not rocket science. That's why maybe Anil is a bit like, what are you guys talking about it? So it wasn't that big a deal. I never thought it's that big a deal, but when people use it too much, maybe they use it incorrectly, but we should not be faulted for that. The last thing I'll say is maybe something a bit more serious, which is in terms of the econometrics, I mean, I think one has to be careful putting more structure. Because whenever you add more structure, it's the nature of the way we write papers that you want to be critical of other people, right? Not yourself as much. That's totally fair. I'm not, that's not a criticism, but I think I always worry about structure. Because when you put structure on the data, you introduce the possibility of misspecification bias. And as George Box said, all models are wrong, right? Including yours, including everything that I've written. And so it does raise a very important question of what is this misspecification bias? So for example, I was loosely thinking about it. I think if you introduced heterogeneity, that some firms are like this knife edge Khwaja Mia firms and other firms are like your firms, I think we have a serious problem potentially in applying blindly once again your methodology. The last thing, and this is just a sort of a meta philosophical thing, I think the key thing is exactly, maybe I think Amir mentioned this, the key thing is to understand the limits of whatever you're doing and to understand the implicit assumptions that you're making and saying, okay, does this really hold true in the data or not? And that's why everything we do at the end of the day, you have to do it as a sort of, these are heuristics you're using. And so I think it would be useful in what the exercise that you are doing to also point out the limitation, like what is the misspecification bias that you're introducing? Because for sure there is the possibility of misspecification bias in what you're doing. Thank you for doing this.
Okay, great, thank you. You want to answer?
Okay, so first, thank you very much for all the comments and the great discussion. My understanding is the new rules are that I can't respond to the discussion. Anyway, whatever. I'll leverage some of the comments to respond. Okay. So I'll start with Atif. I want to emphasize this fixed point problem that Amr was discussing. And that is the following. We show that if you are in the knife edge case, then the tools don't work. And to understand whether the tools work, you need to be in the knife edge case. So if, for example, you find using the KM regression that large firms can substitute, well, then how did you find that? You found it using the tools, but the tools do not work when there is a large degree of substitution. So this is the issue that we are discussing when we think about that. In terms of structure, yes, we are putting particular structure to it. We think it's a very basic structure, right? And as Arno was saying, we have essentially one friction, and it's a very smooth friction, right? So we've got these costs of external finance. But we don't think that we are replacing one extreme assumption with another. And I'll explain why. In KM, the extreme assumption is zero cross-price effects. Our model, admittedly with a smooth CES structure, but our model allows for any degree of cross-price effects. And then we just let the data speak. Are the estimates the same or not? In fact, we have a measure for the cross-price effect. I should say the cross-price elasticity. So that's there. So the KM is okay. It's zero. We're saying it's essentially zero and up. Now, having said that, I completely agree that we can place even more structure, and there are important things that this particular structure is missing. For example, we do not have credit rationing. You can also think about cost of external finance, those C's, with some sort of discrete jumps, etc. But we think that the way to do this is to first write down this baseline model, which has a very simple micro 101, Slutsky intuition. We have that. And then we think, okay, let's add these other effects. In fact, we have solved a model which has the loan supply shocks, which are shifting two different things. One is the smooth parameter that you see here, and the other is credit limits. The solution is much more ugly. That doesn't mean it's bad. I mean, the world, as you're saying, is complicated. The way to do it then is to say, okay, let's simulate it. Let's estimate it. And then most importantly, let's compare how far away the baseline simple, Slutsky structure is to the real macro, whatever structural thing. That's a very useful exercise. We think, in fact, hope that it's a different paper, although if the referees ask otherwise, then, maybe not. But that's that. Now, just briefly, some comments. That is for the other comments. Daniel, I completely agree. Our tricks and whatnot do not address this issue of activity level specialization when the demand shocks are at the activity level. It could be that we could use this framework to try and think about that in a particular way. These things could be useful, but yeah. So we have a section 7. Yeah, and Antoinette, you also raised this issue of the specialization. Anil, I think this issue with like the waterfall of the banks I go to is really useful, and if we can get that in Spanish data to exhibit evidence for cross price effects, that's great. Let me see what else here. Gabe, we'll have to look at that job market paper. EOS. So if I understood you correctly, you are suggesting looking at the term structure of EOS, right? So you've got you can think about an EOS for short term, like 1 year and 2 years and 5 years and whatnot. I think that's a very interesting thing to look at. Technically, you could do this thing per year and see whether the estimates collapse or not. Could be that on the short end of the term structure, the 3 estimates collapse, and on the long end they don't, or vice versa. I could be missing people. Yeah. Okay. So I think we'll stop.
I just want to add to what Anil said, which is that in a credit register, you generally have this issue that these are large firms which have multiple banking relations, which are switching. Those are the cases where cross price effects really kick in. So maybe in a setting where you have small firms where they are at that limit, it's true that you could think of other ways, but especially for large firms or syndicated loans which are there, these cross price effects are very important to think of.
Can I say one thing? I mean, in response, what I've also always thought is that there's obviously endogeneity in the number of banks, which is a separate issue, but it also affects your EOS, because if I know that I'm particularly sensitive to the business cycle, and for me, it's particularly costly to lose my main bank relationship, right? Then I will have multiple, banking relationships in anticipation of needing to do more substitution, right? Which makes the whole thing even more complicated, which you might not need to tackle, but therefore, that's why I find it also so useful to make the point that you are making. And I think this, I just want to say one thing to Atif, which is, it's not that you didn't have structure. You also have structure when you put in bank fixed effects, right? We need, even when the structure is easy, it can be even worse when we don't understand what the structure actually implies. So it's not that, that paper didn't have structure. It's just that it didn't maybe point out enough to the literature that came thereafter. What are all the implications that particular, seemingly simple structure actually entailed, right? All right. With that, thank you very much to everyone, and we see each other after. Wait.
Hey. So Bill, where are?
Okay, yeah.
All right. Welcome back, everyone. We are continuing with when is less more, bank arrangement for liquidity versus central bank support. And Viral Acharya will be presenting. Thank you.
Thank you, Antoinette and Amir, for the opportunity to present this paper. This is joint work with Raghu and Bill Shu. Bill is our graduate student in economics at NYU, and Raghu needs no introduction. This is not working. Okay. Okay. Yeah. Okay, so over the past century or so, we have seen large increases in the size and scope of central interventions, central bank interventions in banking crises. In some cases, this has coincided with their formation in the first place. And yet, significant banking crises have been occurring in a fairly punctuated manner, both in developed economies, including in the United States, as well as, of course, in emerging markets. So some of this was, you could say, despite central bank intervention, which was, of course, made easier by fiat money. The costs of creating money on the fly became very low rather than doing it through species. And so the question we are after in this theoretical exercise is why, despite central bank activism as a lender of last resort, do we see so many banking crises continuing to take place? And we're going to answer this question by drawing attention to a seemingly unrelated phenomenon, which is that before the central banks got so active and in fact got formed in the first place in many occasions, there were really good private arrangements for liquidity in times of stress that were put together by banks in advance. So Lawrence White, in his 95 book, talks about remarkable monetary stability during the Scottish free banking era, especially during 1810 to 1844, when most banks there had unlimited liability, meaning shareholders would have to dip into their own pockets for paying off depositors with whatever losses they were going to bear. There was no lender of last resort, so Bank of England had not yet extended its reach to Scotland, and yet there was much greater stability and growth than contemporary England at that time. And these kinds of contingent liability structures were fairly prevalent from 1880s to the middle of 20th century. Many banks in Europe and North America operated well under this structure. This is not to say that banking crises were not infrequent then, but the question is, why did banking crises occur even after central banks have taken up the job of providing contingent liquidity? So these were not unlimited liability structures. Shareholders would be additionally liable for up to 1 to 3 times the paid up capital after insolvency. And of course, there has been a call for getting contingent convertible bonds into the bank capital structures. And they've had some success in reducing bank fragility. And of course, the conversion point is still at the point of discretion with the central banks. But the fact I want to draw your attention to, just as a way to lay out the stage for our theoretical exercise, is that contingent liability got phased out precisely as and when central banks started becoming active. So the right picture here is for the UK. The black bars are paid up capital, and the gray bars are the total capital. So the gap between that and the black bars is actually the contingent capital that was due from the shareholders as a contingent liability that would show up on the balance sheets of banks. And you can see that there was a steady decline during the first half of the 20th century. And in a book by Turner, he recognizes that after 1956-58 episode, when a lot of banks in UK had problems, there was a decisive action by the Bank of England to coordinate their rescues and reorganization. And that after that, you see that contingent capital completely lost ground. And in the US, of course, it lost ground after the creation of the FDIC as well. So are these two phenomena related? The fact that there's so much public intervention and that there has been a disappearance of private arrangements to inject liquidity into the bank balance sheets in times of crisis. So we're going to start with a wonderful model by Jeremy, who's also going to discuss the paper. Thank you. This is a model of no, I mean this. No, okay. Okay, so in Stein's model, which I teach every time I teach my PhD course, the banking sector raises funds from households via short-term liabilities. So it's a model of deciding how will money get manufactured and how much of it is optimal privately, socially, etc. And of course, there are long-term bonds to invest. And what the bank has is what are called as long-term projects, but think of this as assets that can be sold in a secondary market. So because there are money-like deposits, it's cheaper than bond funding due to a premium that's attributed to riskless liquid assets. So convenience yield is at the core assumption of this model. But it's still a model in which depositors nevertheless run in a crisis state because it's a sign of there being some problem with the bank in future. And if it's a money-like liability, you have to be sure that it's going to get paid off, and so therefore runs take place nevertheless. So in the crisis state, when these runs take place, banks can sell assets, but they cannot arrange private liquidity in Jeremy's model. So at the back of his model is an incomplete markets assumption that the amount of money-like deposits that can be issued is really constrained by the need to have these sellable assets that you can sell. There aren't markets to arrange or inject contingent liquidity in times of stress in this model. So since money funding is cheap, but it's constrained by assets, banks overinvest because of a fire sale externality. They don't realize that when they create more money, they have to invest in more assets, but then this depresses the fire sale price for others, and therefore others try to seek more assets, et cetera, et cetera. And so you get over investment as a way of over creating money-like liabilities. So our key departure from this model as an extension of the model is to bring back this market that is not there in Jeremy's model and think about a framework in which money issuance can be supported not just by asset side, but also by arrangements that banks can make on the private side. So you can create money both by saying I have more collateralizable assets that I will sell in the market, in the secondary markets when I need to pay you off. But I can also pre-arrange liquidity to flow into my capital structure at the time of stress. And that should also give you more credibility to provide money-like claims. So that's the central idea. So we show that, like in models that Arvind has written down, that private provision of contingent capital, once you allow for this contingent markets to be working, you restore efficient outcomes in spite of a collateral constraint out there. Okay. So historically and post-GFC proposals for contingent capital can be thought of as there being some rationale for them being at work in equilibrium out there. Okay. Now, of course, private arrangements for contingent capital do not eliminate fire sale states in which there's a shortage of aggregate liquidity. And because there are fire sales, the central bank may intervene because it's fiat money. Your cost of providing liquidity is low on the margin. You want to step in to improve outcomes at that stage. And now public liquidity starts supporting money creation. So it's not just your collateralizable assets that you will sell in the secondary markets. Now public money comes in and pays off depositors, and now it's on the back of that that some deposits can be created in the banking system.
And our main result is that it's not really the quantum of public provision of liquidity that is injected that is the problem. It's really the price at which you inject this liquidity. Okay, so if you underprice the public liquidity injection, it's going to crowd out any incentives to have private liquidity arrangements because the public liquidity injection is going to be against your collateral of assets as what the central bank liquefies. Even actually fair support, which is what some people propose, is actually underpriced relative to the what would be a desirable efficient price, because what the model says is that you should really charge the rate at which a private liquidity arrangement would have been costing you, and you are replacing that, so you better charge that same price if you are not going to eliminate incentives to create private liquidity. So you have to, in some sense, compensate in the budget rate for the fire sale externality, fire sale costs that the bank is incurring. We look at some extensions, but I won't have time to get into that, which is if this private insurance arrangement was frictionful, then how would it change things, for example? Okay, so let me get to the model. Jeremy's model has a representative household, bank, and private investors. So you choose between current consumption and late consumption. The households are just in the background. There is some money in the utility function that's discounted at the rate gamma. But your consumption at date 2, you discount at the rate beta. And so the expected gross return on bonds is RB, 1 over beta. The gross return on money is different. It's 1 over beta plus gamma. So money earns a lower return. It's special. And the gap between these two rates, RB minus RM, is what the banks are trying to pocket by issuing deposits in their liability structure. So in Jeremy's model, this deposit spread is fixed. And you can imagine a model in which this is even declining with quantity. Okay, so banks face this kind of a prospect on their investments. With probability P, there's a good signal, and with 1 minus P, the signal is that there is some problem with the assets out there. And that's going to mean at date 2, there could be a really bad realization on the assets. So with probability 1 minus Q, the assets will yield 0. And with probability Q, they give lambda I over Q, so that the expected value of assets from that point onwards, from the crisis state onwards, is just lambda I rather than f of I, which is in the good state. Okay. Now, seeing that y equal to 0 is possible, money like holders, those who hold money, will withdraw at date 1, because otherwise it's not money. It's not going to be a safe asset. Okay, now what will happen? There's a secondary market that opens up at date 1. Banks can sell assets out there at fire sale price. Potentially K will be less than or equal to 1. So the liquidity that they are able to generate in the secondary market is K lambda I, K times the expected value of the cash flow. Okay, so let me show you what contingent liquidity arrangements do in this model just through a set of diagrams of balance sheets. So this is a bank that has on the left side an investment I. It's funded partially by money. So proportion M of I goes into money, and the remaining quantity 1 minus MI is funded through long-term bonds. In the good state, money gets repaid. It's going at the rate of RM. Bonds get repaid as well, and banks earn some profits. Okay, of interest is the crisis state, which occurs with probability 1 minus P. Now, how do you pay money in Jeremy's model? The only recourse you have is to sell your assets at fire sale prices, so it becomes K lambda I. And now the money creation constraint is that the assets that you own, K lambda I, must be greater than or equal to the promises that you've made to money, to holders of money. Okay. So the fire sale loss that gets incurred by the bank in this state is 1 over K minus 1. That's the potential return that they give up to whoever is purchasing the assets. And low RM implies that you want to pocket this money, you want to create a very high capital M, and then the constraint will be binding. You don't have as much assets in the fire sale value as the amount of money you want to create. Okay. Now, if you introduce contingent capital, we assume that it pays off some premium RE that will be determined in equilibrium from your good state profit. So think of this as like a contingent kind of arrangement. You're using your profits in the good state to create some cash flows in the bad state. And someone is saying, okay, if you pay me off in the good state, I'll inject a set of capital for you in the bad state. Okay, so the contingent capital is going to be denoted as C of I. It doesn't show up on the balance sheet because it's an off-balance sheet asset that's just going to come in at date t equal to 1 in the crisis state. But now you can see why the contingent capital is relaxing the money creation constraint, because now the burden is not just on the fire sale value of assets. The liquidity injection that you have prearranged can also serve to pay off the depositors. Okay, so contingent capital saves on the fire sale. So you reduce the loss by 1 over k minus 1 on every unit of contingent capital that you issue. And it will also relax your constraint. It will allow you to issue more money. Now, who are these contingent capital holders? So in Jeremy's model, there are these private investors, like think of Warren Buffett. He has a wealth W. They invest all of their W to earn some other technology that they have, G of W. Then they buy fire sold assets, and then they also invest in this G technology with the remaining quantity that they have, W minus M. Okay. Now, if you introduce contingent capital, what you have is that they get paid this REE, but they have made this promise that they must stick to, and they are also going to be paying this contingent capital E in the bad state. And you can see now that the price that they're going to charge, adjusting for the probabilities of states, is in equilibrium by their first order condition going to be linked to what do they believe is going to be the fire sale return in equilibrium and what will be the marginal return on the G technology that is out there, okay? So the money creation constraint in equilibrium, we show when Jeremy's model is expanded for contingent capital that it never binds. And the intuition is the following, that the premium for contingent capital that the patient investors like Warren Buffett would like to charge is basically their foregone fire sales, okay? So they're assumed to be competitive. That the premium that the banks are willing to pay is their fire sale savings, but there is also the shadow cost of constraint. And so banks will issue contingent capital until the shadow cost of constraint has been reduced to 0, okay? And that's the reason why complete markets with contingent capital at time 0 and fire sale at time 1, basically being the price of contingent capital ensures that the real investment I doesn't go into the inefficient territory, okay? So just to summarize this point, which is a key point, that the private equilibrium outcomes are efficient in this framework. You will see some creation of money, which is along the red line. On the x-axis, you have the rate of return on money. As it gets low, you want to create more and more money, but you see that some of it will get created with just a private arrangement for liquidity in the form of this contingent capital. The blue line is that this investment basically remains unaffected. So you never compromise on going beyond the socially efficient level of investment. And then if you look at the other region where amount of money creation is actually in excess of the investment, you just get this complete picture, which is that as you are trying to pocket an increasingly lower rate of return on money, you increase the money supply, but you do it all through private arrangements of liquidity. It doesn't happen through your collateralizable assets or investments out there. Okay. So now, why does the central bank step in? Because private contingent capital eliminates overinvestment, but not fire sales. Okay, so so if you assume that the central bank's cost of supplying money is C of L, on the margin it's 0. So then they will step in at some point and they will optimally choose a level of injection capital L, which is against the proportion phi of your collateralizable assets. And then you will stop when the margins are equalized, the fire sale return 1 over k, G prime, which is the reservation opportunity of patient investors. And when that's equal to the central bank's marginal cost of supplying money, think of this as inflation or political sensitivity cost to an over-interventionist central bank. So these costs will be equalized, okay? How does the bank's problem get rearranged because of this? They recognize that in the crisis state, there's an injection of liquidity coming in from public sources. So phi of I is the injection coming from LOLR payout. And if we look at a bailout central bank, so they don't charge anything just for sake of argument, we analyze all the other cases. But they also recognize that they save on fire sales discount of 1 over K minus 1 if this public money backs deposits that are being demanded in that state. Okay. So what do you get? You get that when banks anticipate the underpricing of liquidity, so we are looking at what the public liquidity injection and money creation would look like. And the nice result is that none of these quantities are actually getting compromised. You know, public liquidity would back money creation just like the planner would and at the quantities the planner would. But what fundamentally changes is how money is manufactured. Okay, now you manufacture money in the bailout central bank case more and more progressively through holdings of your real assets, and you rely on those assets being liquidated or being pledged to the central bank. And you can see that the money that was being manufactured through contingent capital, now the contingent capital market endogenously vanishes. There's no demand for contingent capital because you would rather rely on a mispriced central bank put out there. And this imposes all the inefficiency on the asset misallocation that's happening at date zero. So rather than taking this market as exogenously absent, we show that when the central bank misprices or underprices the liquidity provision relative to the efficient case, the market endogenously actually vanishes. The desire to raise, to support money by private liquidity arrangements just collapses. This is consistent with declining capital levels that have been documented for both UK and US out there. So to just conclude, private sector remedies to the problems of banks overissuing money. They leave the possibility of public intervention with the potential to improve matters, but now you get a public intervention introduced market failure, which is that the market for private liquidity just vanishes. It may be that finding the right mix of private contracting and public support should focus on whether the liquidity that is injected into the banking and more broadly the financial system should be priced at the right levels out there. Thank you.
Thank you. The discussant is Jeremy Stein.
No, unfortunately, Victor's out of batteries though. Okay. Well, thanks very much for inviting me to discuss this wonderful paper. Right back at you. No, this is really, really interesting. I learned a lot from thinking about this paper. You'll see I have some differences in interpretation, but it's really, there's just a lot here. So what are sort of the key points? You know, the first thing is that contingent capital, sort of a nice design, and they have a model in which that comes out very, very, very nicely. I agree with that. The sort of normative thing here is the concern that a central bank and its desire to intervene can crowd out the market for contingent capital. And that's true in the model. I'm going to argue that at least in some cases, they can also be complements, that having contingent capital can make the lender of last resort's job easier. And then kind of the theme, this is not really quite the model, is that, you know, we have these interventionist central banks and they're kind of intervening a lot. And that's the reason we don't see more contingent capital in the modern world. And there, I think, again, as a practical matter, I'm going to disagree. I mean, there is actually a very active market for contingent convertibles in Europe, notably not here. And I think, you know, the answer to why in one place and not the other has to do more with regulatory treatment and tax stuff. All right. But, you know, here's the basic model. And the key thing is you've got a desire on the one hand to create safe money-like claims. Okay. And on the other hand, if you wait till time 2, the thing can go to 0. Okay. So you can't just kind of say, hang on. Once you get to the interim bad state, the only way you can assure that you're going to be able to pay something back with certainty is to sell the assets before they get to the really bad state at time 2. And that's what gives rise to fire sales
And then if collateral constraints bind, there can be a pecuniary externality that runs through the fire sale price, right? And so if you just take that model and you have no regulation and no contingent capital, that's where you get this result that essentially if this effect is strong enough and if the collateral constraint is binding, you can get an inefficiency. Basically, too many fire sales, and when I fire sale my asset, it's going to tighten somebody else's collateral constraint, and I'm not internalizing that properly. And you know, if nothing else, you might think, well, that's a reason we should regulate leverage in this setting. Okay, so their first very, very nice and very, very clear result is, you know, in the model as I just cast it, we basically left it to people to solve their problems in the interim date. You get to the interim date and you're like, oh my God, things are not very good. At that point, you just can't raise enough money, right? So what would they have you do is fold back to time zero and enter into an insurance contract. And then what you can do is basically move money from the good state at time one to the bad state, right? You take some from the good state, so you have more in the bad state, and that basically helps you fix the problem, right? So ex-ante insurance here, which you can do at time zero, you don't have the resources to do it at time one, is basically a good thing. So that is essentially what their insurance or contingent capital is doing here. Okay, now I wanted to make a first observation here. There's actually a critical assumption in their model, which is when you enter into this insurance contract, it's sort of a trust me contract, which is basically somebody gets the insurance premium and then they promise in the bad state to pay you. Okay, it's an uncollateralized way to say it. It's an uncollateralized contract. Okay, what if you didn't trust them to pay you? You'd make them lockbox the stuff when you bought the thing. And that's how contingent convertibles work. It's basically like a defaultable bond. That is exactly the so-called knockout COCOs are exactly an escrowed insurance policy. What I thought was the most beautiful result in the paper, which Viral didn't allude to, is that when you lockbox the thing, then the result gets overturned again. Then you can no longer get to efficiency with the contingent convertibles. Basically, you're locking, again, this is pretty heuristic, you're locking up too much capital ex ante, and it sort of doesn't work. So this is where I kind of want to just depart from these guys. I think in their narrative of it, this was sort of a less interesting result. In my narrative of it, this kind of wants to take center stage. This is, you know, if you listen to the model, I think this is where the model is really kind of trying to tell you something, that contingent capital works only if you don't need to fully collateralize it. Okay, whoops, I've screwed up something. Help. Oh, I'm sorry, my bad. Okay, and then in the world where contingent capital is a good thing, you can, of course, mess it up by having a central bank that intervenes and kind of underprices, sort of intuitive, right? They're going to crowd out the private stuff. The one thing I just wanted to be, this is a little bit of a nit, is the central bank in this case, whether it's doing it fairly priced or unfairly priced, is not really a lender of last resort, right? A lender of last resort has to break even. The Fed's not supposed to, as a lender of last resort, ever lose money in any state of the world. So they're supposed to break even state by state. Your thing always, no matter what, the so-called central bank will always lose in the bad state and do better in the good state. So really, this is more like TARP or something like that. It's not a sort of strict lender of last resort, and it's related to the fact that in this model, it's not a bank-run sort of multiple equilibrium thing that a lender of last resort can come in and fix without taking risk. Here, the only thing you can do is basically involves taking risk. All right. Now, here's kind of the interpretive thing I wanted to kind of focus on, which is this thing is a model of some kind of intermediary that does some fire selling. Should I think of it really as a contemporary sort of modern day bank? And so, you know, I did with Sam and Andre and Rob some follow-up work, and this is sort of very much a theme of Sage Bell's job market paper, is that if you just take literally this kind of setup with a tiny tweak,
you'll see there's sort of, if the goal is to make safe money-like claims, there's two ways you can do it. There's what you might call the banking model. The banking model gets rid of fire sales. It does this by having some combination of deposit insurance and a capital requirement. But then you don't need to have early liquidation. This is not SVB, but it's like banks with deposit insurance. Or you can have something that we might call shadow banking, where there's less of a sort of safety net, there's less deposit insurance, and then you're back to kind of this thing where the only way to make the claim safe is by early liquidation. But I might want to interpret that a little bit more like a hedge fund with repo financing, right? There, the only way to get yourself safe is to pull the plug. So really the only thing you have to do to this model is a tiny little tweak, which is just enrich the bad state so that there's a very small probability of a total disaster, there's a pretty bad state, and there's a good state. And then you say the way you create a bank is the deposit insurer says, I've got you in the disaster state, but I require that you hold enough capital so that you're not going to stick me with the tab in the bad state. And then in the good state, everything is going to be fine. Okay, so you enter into it, and you can have the deposit insurance be fairly priced and all that, but because you don't want the deposit insurer to have to come in too many states of the world, you do some deposit insurance and some capital. So that's a bank. When you do that, the bank doesn't have to fire sell. On the other hand, another way to do intermediation, these are both sort of strategies that can coexist, is you can have a shadow bank. On the one hand, it doesn't have to have the capital burden. So that, that helps in one, but on the other hand, it's going to have to early liquidate. And as sort of Sage has made the point that, these two can kind of coexist at equilibrium, and depending on the assets, one may be better than the other. So now let's think about what the role in this setting for a bank would be with contingent capital, right? So now you're no longer about avoiding a fire sale. It's just that you have banks and you've given them a capital requirement as part of the thing, right? Well, then there's the problem that, you can say this a couple of ways. You could just say capital's expensive and we don't like to have too much. And the problem with just having a high level of uncontingently high level of capital is it's enough for the bad state, but in some sense you've got too much in the good state. So you're kind of overpaying for the capital, or you could do this in like an agency context, which is if you have enough for the bad state, you're going to have too much in the good state, and then they'll go run around and do stupid stuff with the excess in the bad state. So you'd like to have sort of a more efficient way to kind of customize the amount of capital. Or said a little bit differently, if you have a shock, you want to pre-wire the recapitalization, and so contingent capital does that. Okay, so this is a different thing. So now the contingent capital, it's not a liquidity injection anymore. It's a solvency thing. It's just, I'm trying to do standard, bank has to have enough capital, so it stands in front of the deposit insurer, but I want to just sort of calibrate this so it kind of is state by state, and so we're being a little bit more surgical in its use. You want to, in some sense, equalize the time to marginal value of capital. Okay, so this is sort of a different motive. This is, I guess, how I would have thought about it if you'd asked me before. And in this case, it's very complementary to a standard lender of last resort, because think about the lender of last resort. If you have a way of when the bank gets in trouble, we've automatically recapitalized it. And the lender of last resort's first commandment is you cannot lend to somebody who's insolvent. Then you've just made them more solvent at exactly the time you want to be able to call on the lender of last resort. So in that case, I would say they're complementary rather than antagonistic. So yeah, turns out, again, as I said, there's actually a pretty impressive market in Europe, mostly in Europe, some in Asia, for contingent convertibles. Right now, there's 250, 300 billion outstanding. The total issuance since the GFC, a bunch of it has already rolled off, has been on the order of $1 trillion. It's roughly split between securities that convert into equity and what are called knockout COCOs. The knockout COCOs are exactly the structure in this paper. That is to say, you have a bond,
And then if it breaches some trigger, your bond just goes poof. It just goes away. That is how you provided lockboxed insurance, right? You put up the money and then they take all your money away in the bad state. Okay, and again, it's mostly in Europe, and in Europe, it's pretty significant. It can be up to 20% of your tier one capital. You don't see it in the US. I think the explanation is pretty prosaic. It's just the regulators, because this is all about regulatory capital, if the regulators don't give it tier one capital treatment, you're not going to see it. So here, regulators, I mean, I remember at some point having this conversation with Tim Geithner and saying, like, these COCOs are really cool. And he was like, you're really stupid. We're not going to do this. And so they like preferred here. And so they do preferred. And that's it. And interestingly, the market took a bit of a hit with Credit Suisse. There was a bunch of legal stuff about whether they should have been allowed to trigger the thing. This was bad for the market, but the market has actually since bounced back. This is me just asking ChatGPT to make a picture. I actually asked it twice. I like this picture better because the numbers were bigger. So, I guess I'm getting better at computer stuff. All right. So again, agree. I think the contingent convertible structures seems like a good thing, and it has actually been an important thing. My sort of difference in interpretation is I think of them as sort of providing solvency support, not really kind of liquidity, and that the liquidity can then come, thanks to the solvency support, can come from the lender of last resort. And because I think in the world, this limited commitment or collateral constraint is important, means that you really do need to have these things lockbox. So what I took from the paper, the way I wanted to interpret the paper is, I'm just really just trying to read out from the model, is that tells you you're going to have a hard time. You will be able to use these COCOs as sort of a capital substitute. You're going to have a hard time using them in the sort of fire sale preventing way. And that's interestingly why the sort of hedge fund liquidation problem is actually very hard to solve. That will not be solvable. You can't have a hedge fund signing up for some kind of liquidity insurance precisely because you'd have to lockbox the insurance. So I think the Proposition 7 is really kind of the heart here, and it's not an obvious result. It's like a really sort of extremely nice piece of theory, and it's wanting to tell you something about where and when you can actually use these things. So.
Thank you very much, Jeremy. We take questions and then we let the authors answer. Luigi, go first.
So I'm with Jeremy here. It seems to me that there is a cost, and I did not read the paper, but from the presentation, there is a cost of providing private insurance. And of course, if the cost is zero, then there is no problem. But if the cost is real, the public insurance, of course, there is a huge agency problem, but the public insurance is almost for free because you have enough sort of collateral that you can use. And so a central planner would like to use some of the public insurance instead of the private. If you eliminate the cost, of course, you want to go fully private, but that's not the case, especially in early periods. And this might be a difference between modern and so early and contemporary times, because you present the evidence of the Scottish banking period, but the US banking period was a disaster. So the private insurance, and you have multiple liability in California, etc., but you had a recurrent banking crisis with devastating effect on the economy. So that's a real cost. Now, maybe in today's world, this cost doesn't exist because there is enough capital over there that you can deal with that. But certainly, at the time of the US of the 19th century, that was a real issue.
Thank you. Doug, Anil, and Enrico.
So I thought it was very clean that you sort of able to move this into essentially complete market setting and just use the state prices. but it seems like a lot of the COCOs are not set on exogenous states, but the endogenous bank solvency. So it'd be interesting to think about if you reformulated the model that way. And then you'd have this issue of, one, how you price it, and conceivably, if you put it that way, you'd also need to have regulation to sort of force the bank to be willing to hold this. So I think this framework could look at that question. And then, I mean, relating to Luigi's point, I mean, this could end up being about how do you price the state-provided insurance. So basically, how do you price deposit insurance, and should you use like the arrow prices instead of just actuarially fair?
So the wonderful paper by Stein that I always teach is Fruit, Sharstein, and Stein. And I wondered if you could have reinterpreted a lot of this as saying, okay, normally hedging doesn't pay, but here you got a fire sale, so there's fire sale externality. And here, maybe the thing you want to look at is in their paper, they have this whole thing about nonlinear hedging and maybe hedging with options that only pay off in certain states of the world. And whether this was a call to say requiring that form of hedging, like buying certain options that pay off, would be a way to replicate what the contingent capital is. Where my analogy runs out is I wouldn't have thought that there's a way to get your Proposition 7. I didn't read the paper, so maybe it's in there, but there, I don't see how the pre-funding. So does that say something, if I pursued this, that the person that was on the other side of the option somehow wouldn't be willing to price the option if they had to pre-fund? I don't quite see how that goes, but it seems like those steps are where you're headed. And when you put it that way, I think it's clearly related to the COCOs, but this feels like it's a little bit different.
Thank you. Enrico and then Arvin.
So fantastic paper. I'm glad that this big question is put back on the table. Also the second paper. The comment on, so I've been working on the COCO mechanism, and I completely agree with Jeremy that the problem is that it's very hard to call the trouble state when you convert. And currently we're relying on book equity, which is a terrible instrument for a number of reasons. And on the other hand, you could argue that the Credit Suisse, and I do argue, worked. The conversion worked. There was no bailout. There was no default. Of course, it waited too long. And that's exactly the weakness of the construction, that you are trying to specify contractually something is very difficult to specify, but ultimately you need to give some discretion. It's like an optimal control problem. The residual rights of control you have to give the supervisor somehow to act. Now, it's a very delicate construction. You need to validate the action of conversion because it will be taken as an action of taking property. But on the other hand, that is the crux. If you want to deal with the emergencies without always just coming in and bailing out, you have to be able to mobilize some good. Another quick comment. This is the capital solution or liquidity solution. If you go back to the US before there was a central bank, the clearinghouse arrangement was one in which there were other banks coming in at the right time and being paid very well to provide liquidity when they decided the bank was to be safe. And I think I would like to bring back the question that you started with, but why don't we pay penalty rates? Why don't we demand penalty rates in distress? Now, of course, you say, it seems you're only compounding the problem, but if the issue overall is an issue of incentive, I mean, the private solution was to impose penalties when you got stretched. Seems to me that that would have to be put back somewhere on the table. Thanks.
Thank you.
I will refer to this other amazing paper or speech by Jeremy, his monetary policy getting into all the cracks. So you should tell me if I'm wrong, but it feels like the following is correct in your setting, which is if the central bank ex post lowers interest rates, it reduces the fire sale. And because it changes the rate of return for everyone in all states, it doesn't change the private insurance incentives because investing ex ante versus ex post is sort of all the same. if you go down that road, maybe it gives you a way of breaking this idea that often pops up in central banking, which is some division between financial stability things and monetary policy things. Because maybe ex post you want to do monetary easing rather than doing LOLR. I bet you might get that result.
Perfect. Let's allow one round of answers and then we see if there are more questions. Yeah.
Okay, great. Thanks, Jeremy, for that wonderful discussion. Thanks for all the wonderful discussion. Thanks for all the comments. Look, I mean, there's some things we agree broadly with you. We could quibble. COCO's in Europe, not US. Is it just taxes, or is it the US bails out more? And you know, SVB versus Credit Suisse, one was bailed out and one was not. But anyway, I think the point you made about the contingent, convertible, and collateral is really the heart of the issue, right? I think in the past, when you had sort of extra liability, double liability, triple liability, you collected when the bank was dead. So it was absolutely clear at that point that you had to collect. The problem was it was really hard to collect. How do you go after the equity that now is you know, has to put up their house to help the creditors of the bank? I think COCOs are a lot better because you put the money up front and then it gets written down when the bank gets into trouble. The problem with the COCOs is precisely what is that event? Because you want to do it before the bank dies in order to save the bank, so to speak. And that's where all the problem comes. And so what we've learned from Silicon Valley Bank is we need a better definition, from Credit Suisse, is we need a better definition of when they kick in. And you know, maybe book value is okay if it's clear, because everybody can then price around it. And that's really the problem. Now, in the model itself, it turns out that you escrow if there is a concern about the private insurer putting up the money when they're required to pay out. All they have to do is escrow until date 1. And if they can pay out at that point, then there's no problem. There is no cost. It's because they have to escrow until date 2, because the event can happen any time, that then they forego the private investment on their part. And then it becomes really costly. And you're absolutely right there. And then Jeremy didn't say this, we recover all Jeremy's results then. So essentially his paper is about when contingent capital is really costly. Now, you know, the point about capital versus liquidity, I think, is really very important. The question is, if I become I get this infusion, either via write down of my bonds or because I get outside money, those two, one is an infusion of capital, the other is an infusion of liquidity. Now, in a perfect world, they're equivalent, because if my capital goes up, I can go out and borrow in the market, I get the infusion of cash. In a less than perfect world, in the middle of a crisis, they are very different, because I might be really solvent, but I can't get the liquidity, or vice versa. And there, I think the points that Jeremy made are really important. We need to think about how these different forms of capital infusion or liquidity infusion, how they work, and I think differentiating between the two could be very important. I also think the idea of you know, this deposit insurance being complementary with contingent capital would be worth exploring. The key point in our paper really is this: can you price the deposit insurance or lender of last resort appropriately? By the way, we have a situation where the lender of last resort gets paid within the state. Because remember, in your paper, the depositors who run, they run at date 1, even though there's value left. It's because there is riskiness that they run. And therefore, the deposit insurer who doesn't mind the risk and is willing to pay based on expected value will still be willing to insure at that point, and it can be break even at that point also. Just limits how much lender of last resort to get there, where your point that a capital infusion at that point can make things a little better in terms of lower fire sales is absolutely right. But we have the internal pricing also. It doesn't have to be across states. It can be internally priced also. I think the point really that we're trying to make is it's very, very hard for the public insurer to price at the appropriate rate because it looks like they're making a killing. They're offering exactly what the private market would at that point. How can the public insurer offer what the private market would? I mean, you can see this even with deposit insurance. As soon as the deposit insurance fund starts making money, the banks are on, on their case saying you're charging too much as a premium. It's never thought of as here is the support when things really get bad. It is you're floating in money now paid back, and then of course you end up in the crisis state without adequate funding. So it's that political economy issue that we're saying is hard to solve. If you got the pricing right, as Doug says, you did the right contingent claim pricing, there would be really no problem. Let me stop there. Bill?
On the point of double liability not working in the US or in some of the history, I just wanted to say that that was where a lot of the shareholding was really dispersed to retail depositors. And of course, they don't have enough additional personal wealth. In our model, what we want to make the point is that banks are constrained, whereas the private investors aren't. So when you design the system, you really want the unconstrained or the relatively unconstrained investor to be providing this contingent capital. And that wasn't the case in double liability. So it's more of a design of contingent capital issue rather than contingent capital in general doesn't work.
Let me give it to Viral in 1 second. Arvind's point, lowering interest rates, well, it is a much broader solution. We don't have endogenous sort of interest rates in our model. There's one fixed interest rate. It would help, of course, any kind of lowering in a time of crisis, but then it affects so many other things. So you have to ask whether monetary policy is the right tool to deal with a crisis in a particular part of the banking sector.
Just a couple of things. I'll give responses. Yeah, just 1 minute. Yeah. Only in the context of the model. To Luigi's point, so in the model, it's not the case that public liquidity injection is zero in the private optimal. So socially optimal and the privately optimal public insurance is at the same level. But because it is mispriced, the creation of money will be done just through the creation of assets rather than arrangements of private liquidity. And
cheaper rate.
Yeah. Yeah, exactly.
It's an efficiency.
Yes. Yes. Yeah. 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 That's the reason. No. This was in the so when you create more money, you do it on the back of public liquidity, both in the planner and the bailout central bank case. But the bailout central bank, because it's not charging the right price, distorts. Yeah. Yeah. You get both. Yeah, money should be backed by public money in the model. Yeah, in all the cases, because it's fiat money. It's costless to provide on the margin.
Okay.
Yeah, I'll stop there. Yeah.
Thank you very much. The next paper is Bank to Non-Bank Lending and the Reallocation of Credit. And we have Dominic presenting.
Perfect. Thanks so much to the organizers for including this paper on the program. It's a joint work with Jane, Yiming, and Katerina. Jane is here in the audience, and Katerina is at the ECB, so the usual disclaimer applies. Perfect. An essential function of banks is credit provision to the real economy. But more recently, what we have been observing is that banks are increasingly lending to non-bank financial intermediaries, which we call NBFIs. And in the US, it has been documented that this lending has grown substantially over the past couple of years and reached about $1.8 trillion as of 2022. A similar trend is also evident in the euro area when bank lending to NBFIs expanded to 3.5 trillion euros in 2025, reaching almost 70% of banks' corporate exposure. Importantly, over the past 6-7 years, this lending to non-banks has grown substantially faster than credit to firms, especially since around 2022, outpacing it significantly while the credit to firms has plateaued. So given that the bank lending to non-banks is taking an increasingly larger share of bank balance sheets, in this paper we try to ask two questions. First, what are the drivers of this lending? And second, what are the broader implications on the banking system and an aggregate credit supply to the real economy? So ex ante, in principle, it could be the case that if non-banks are less constrained than banks, this type of lending may be just a pass-through or even enhanced credit supply if banks lend to NBFIs that further provide credit to firms. Think about bank lending to private credit funds. In this paper, we argue this is not the case. We show that bank lending is not merely a pass-through of lending to the real economy, but reflects a narrowing of bank business models that in the end contracts credit supply. So we arrive at this finding in a couple of steps. First, we show that the significant and rising fraction of this lending is composed of very liquid short-term reverse repos that are backed by safe government collateral. And these repos go to non-banks that invest primarily in securities rather than lend to the real economy. This has important implications because on bank balance sheet, this type of lending is crowding out banks lending to firms rather than other liquid assets like government bonds. And because the credit goes in the end to non-banks that finance securities, the reduction in bank lending to firms is not offset in the end by NBFI stepping in and increasing lending to firms, which leads to an aggregate contraction in the credit supply. We then look into the causes, what's driving it, and we argue that the rise that we observe in bank to non-bank lending is primarily caused by increased demand from NBFIs to finance government bonds. And an important factor that we point to during this time period has been the shrinking central bank balance sheet that leave more government bonds in need of private financing. And NBFI step in, but they require funding from banks to fund these government bonds. And our empirics and the model further imply that for a given amount of QT or bond issuance, this bank to non-bank lending link is actually amplifying the standard crowding out of credit provision that the real economy that has been previously documented in the literature. So for the sake of time, let me skip the literature and dive directly into the paper. So I'm going to spend a bit of time on talking about the data, and I will present the 4 main empirical findings that we cover in the paper. I will finish off with the model to kind of help understand the empirical findings and quantify the aggregate effects. So on the data side, we combine several administrative data sets from the euro area, and the core of the analysis builds on loan-level data from Unaccredited Credit Registry, which gives us information on bank lending not only to firms, which has been pretty standard in the literature, but also to non-banks. We further supplemented with additional transaction-level repo data to kind of give us a sense what has been going on in this market, especially because that's the one that has been on the particular rise. We further combine this loan-level data with a couple of additional data sets, including balance sheet information for banks, non-banks, and firms, with a special focus on security holdings by various sectors in the economy. So let me now dive into the empirical facts that we document. The first thing we look at is the composition of bank lending to non-banks. And here we are breaking it down by various loan types, including reverse repos, term loans, credit lines, and revolving credit. And confirming what we already know from the US, we show that term loans and credit lines are a sizable share of this type of lending, one thing that we document is that reverse repos, which are here in orange, are the largest category, and they has been responsible for the strongest growth over the past 3-4 years. And importantly, these reverse repos that are here at the core of our paper are something that you cannot directly observe in the US Y14 data. Now, when we further break down this lending by borrower type, here in the left panel, we look at various major NBFI sectors. We see that this growth is primarily driven by investment funds. And if we look by investment fund type, it's the hedge funds who take up most of the borrowing increase from banks. Instead, we observe much smaller growth in lending to other NBFIs, especially those that are lending to firms such as private credit funds or lending companies. So the main takeaway so far is that this rise in bank lending to NBFIs is mainly comprised of reverse repos that going to NBFIs that primarily invest in securities. So now the question is like, what is the cause of this strong growth of repo lending by banks that we observed over the past 3 years? Our main hypothesis that we want to test is that the main factor driving it has been an increase in the supply of government debt that requires now financing from the private sector. One way you can see it already in the aggregate is by looking how this reverse repo lending by banks is the timing of it and how it aligns with central bank balance sheet holdings of government debts that we show here in red for Euro area and in the left panel and in the US on the right panel against the reverse repo lending by banks in green. So what you can see is that this rise in reverse repos to non-banks very much coincides in terms of timing with shrinking central bank balance sheet already from mid-2022 and continued government debt issuance in major economies. In that this is present across not just Euro area and US, but also Japan and the UK. So the mechanism we have in mind that we want to test is that decline in central bank balance sheet along with an increase in government debt issuance is leaving bonds that are in need of financing. And NBFIs step in, but they require to borrow from banks to finance it through the leverage, especially through reverse repos. An even direct way to see how it closely aligns with the government debt holdings that need to be absorbed by the private sector is to plot the reverse repos again in green against the amount of government debt that is in private market hands. So taking the total supply and subtracting the central bank holdings from it. And what you see is that indeed the growth in reverse repos very closely aligns in the aggregate with the growth in privately held government bonds. Importantly, these trends cannot be really explained by conventional monetary policy because the timing is quite different here. So this is just an aggregate evidence, and we formally tested by zooming into loan level data and studying the relationship between privately held government bonds and bank lending across various borrower types. And what we see is that as privately held government bonds rise, lending increases disproportionately more to NBFIs, especially hedge funds. And this holds across sectors, but also within NBFIs itself. Now, one reason why this may be going up, this type of lending may be going up, is due to the demand, credit demand forces, which we try to argue for. So NBFIs demand more credit to finance these bonds. But an alternative story is that it's the credit supply factors driving it. So banks actively reallocating credit to that sector. We try to disentangle these two effects by saturating our specification with a bank by loan characteristic bucket and time fixed effect. So we're looking within the same bank at the same time, loans of very similar type lend to different types of borrowers. And we find that the coefficient still remains pretty large, suggesting it's the stronger NBFI demand driving the effects rather than credit supply shocks by banks. So the economic magnitude is very large. Per 1% increase in private holdings of government bonds, we find this leads to a 1.25% higher lending to hedge funds. So we argue this is a demand. One additional way to sort it out is not only to look at the quantity, but also the price of these loans. So we zoom into the repo lending, and here we are plotting in blue the spread on these loans against central bank holdings of government bonds. And we see that with the QT, both the quantities of repos and the price, the spreads, are both going up, suggesting it's the NBFI borrowing demand dominating the supply effects. And this is consistent if we zoom into microdata as well. One additional direct evidence, really trying to nail it completely and connect it to the QT more directly, is to use the transaction level repo data that allows us not only to track the quantity and the price of the lending, but also the collateral that was pledged to get this loan. And in addition, we use the security holdings data by the Eurosystem to construct the changes in ECB holdings of this specific bond as a share of outstanding. And we look how these changes in holdings affect the quantity and the price of the repo loan in this market. And sort of what we find is that a decline in ECB's holdings of a specific bond is associated with an increase in quantity and increase in the price of this loan, again, consistent with the increase in demand for funding bonds that ECB retreats from. And these effects are very much similar, even if we look within the same country maturity bucket and time, suggesting this is not driven by aggregate monetary policy or country-specific macro conditions. So far we have argued that it's the credit demand from NBFIs driving this lending by banks, but we also study the importance of the credit supply factors. We consider three main mechanisms. The reserve drain is the first one. So as the QT is happening, central banks are reducing their reserves, which increases bank balance sheet capacity and may induce banks to rebalance to other liquid or low duration assets such as reverse repos. Second are the capital constraints. So banks may reallocate to NBFIs because these are safer, more liquid loans, especially for capital constrained banks. This may be a good idea. And finally, this period coincides with an interest rate hike by the ECB and other major central banks, which leads to deposit outflows, which may again induce banks to rebalance towards safer and more liquid NBFIs exposure. So in the data, we show that all these free supply forces are present, and they do amplify the rise in bank to NBFI lending, but they have limited economic significance in our sample. So we finish off our empirical facts with the real effects. So we are looking how banks are responding to an increase in demand from non-banks to borrow, and how it affects their balance sheet. So the net effect on credit supply depends how banks reallocate their balance sheet. And we find that the growth of bank lending to NBFIs has largely come at the expense of bank lending to firms and considerably less from other assets such as government bonds or reserves. Per 1 percentage point increase in NBFI lending, we find this is associated with about 56 basis points decline in firm loans. Now, digging deeper and moving to a more granular data, we see that at the loan level, an increase in government bond holdings by the private sector for banks with higher ex-ante share of NBFIs exposure. They increase lending to NBFIs and reduce lending to firms. And this importantly holds after absorbing a credit demand with borrower time fixed effect, suggesting it's not the reverse causality driving it, such that banks experiencing weaker credit demand, they are just moving to the other sector. You know, lots of discussions today about it. So now this increase in the supply of these loans by banks to non-banks is having additional sort of firm level effects. We find that firms more dependent on banks that lend to NBFIs receive in the aggregate fewer loans from both banks and non-banks and less financing overall, leading to a contraction in credit supply, especially for smaller and riskier firms. So far we have shown that this bank to NBFI lending rise is composed of reverse repos going to NBFIs that finance government bonds due to a contraction in the balance sheet of central banks. Next, we are building a model to rationalize these empirical findings and quantify the effects of an increase in the supply of government bonds and how these effects depend on this link between banks and non-banks. So in the model, we have two sectors, a representative bank and representative NBFI sector. Banks are financed by deposits and equity and invest in reserves, government securities, corporate loans, stocks, and loans to NBFIs. Deposits, there are two types: retail deposits that are insensitive to risk, think about insured deposits, and institutional wholesale deposits, which do depend on risk of the bank. Banks are maximizing risk-adjusted returns subject to the standard capital constraint. Now, NBFIs are funded by external equity, and they borrow from banks to invest in government bonds, loans, and stocks. The borrowing from bank is collateralized by the government securities, and the degree of collateralization does affect the rate that they pay in equilibrium for this borrowing. Now, the NBFIs are maximizing equity value that increases in returns and fall in risk, subject to the collateral constraint, subject to how much government securities they have that allows them to borrow from banks. Now, these three assets, government securities, loans, and stocks, banks face an upward sloping residual supply curve for all these three assets that depends on the other sectors that hold these assets. And importantly, the bank to NBFI lending rate and quantity is determined in equilibrium. So there are two key differences between banks and non-banks in our model. First, on the portfolio constraint, banks are subject to regulatory constraint that tilts their portfolio towards safer, lower risk weight assets. NBFIs are subject to collateral constraint, which limits how much they can borrow from the bank, which depends on how much safe securities they hold. Both these constraints affect banks and NBFIs' ability to absorb the supply shocks in risky assets. On liability structure, banks have access to cheaper deposit funding, which allows them to lend to NBFIs at low rates. Now, in the calibrated model, we find that NBFI's risk tolerance is higher than banks' effective risk tolerance, which makes NBFIs a sector that can absorb more risky assets conditional on the shock. Now, in the paper, we consider a counterfactual where we increase government security supply from QT or fiscal expansion, and we document two effects. First, there is a direct substitution. When the yield on these bonds increases, both banks and NBFIs are tilting their portfolios to these assets. Now, because non-banks are more risk tolerant, they are able to absorb more of these securities, and to fund a purchase of these government bonds, they borrow more from the bank, which is further crowding out corporate loans. Now, importantly, we find that the extent to which this crowding out is important depends how cheaply it is for the non-bank to borrow from banks. Specifically, if we allow for cheaper lending from bank to non-banks, we find that more funds are flowing to NBFIs, which is amplifying this crowding out and leading to a stronger contraction in the supply of bonds. Now, in the calibrated model, we are finding that per 5% increase in the residual supply of government securities, loan to firms contract by 6.3%. But in the model with more costly banks lending to NBFIs, this contraction is about 1 percentage point smaller. So to conclude, the rise in bank to NBFI lending is mainly comprised of reverse repos going to NBFIs that invest in securities, is driven by the rise in the credit demand to finance government bonds that are now released from central bank balance sheets, and is crowding out corporate loans on bank balance sheet. And we document that this crowding out is further amplified because of this bank to non-bank link. Thank you so much, and looking forward to Wenshin's discussion.
Thank you very much. The discussant is Wenshin Du.
Great. Thank you so much for inviting me to discuss this excellent paper. There is a lot in this paper. I would say even just the empirical part is extremely rich. The author has done a ton of robustness checks, and in addition, there is a full-fledged model, is counterfactual analysis. So there is a lot to go through. My overall take is I think the story, the overall narrative is extremely compelling. There's excellent data, as you already see, that's coming from the ECB. Both on the bank side and also on the security side and also on the repo side. And the overall empirical strategy is very well crafted. And Dominic did an excellent job in presenting, which makes my life super easy. So I'm just going to repeat with one slide on the overall takeaway from the paper. The paper finds that the rapid growth of banks lending to NBFI in recent years is primarily driven by reverse repo. So what is reverse repo? It's basically secure lending against some collateral. And in particular, these type of reverse repo largely take the government securities as collateral, and NBFI also use the funding to finance security holdings, as opposed to thinking about private credit funds taking funding from banks and then on lend to non-financial corporations. And the key broad implications as put forth in the paper is that the rise of this form of NBFI bank nexus actually implies a narrowing of banks' business model and a significant crowd out of loans to non-financial firms. Okay, so that's the overall thesis of the paper. I'm gonna jump right straight into my comments. I will first talk about the relationship of this paper with the broader literature. To me, it's perhaps less about the bank's own crowding out, but just more thinking about the government securities have a general crowding out effects on private lending. And then the second and third things are more bookkeeping items. I would like the authors to dive deeper into the data to articulate a little better in terms of the differentiation between banks, i.e. depository institutions, and broker-dealers, which are in charge of the bulk of the repo activities. And certainly, whether the story is largely sourcing data from ECB is a story about the ECB fiscal crowding out story, or it's more of a story about the European banks acting as global repo intermediaries and financing the US Treasury cash future basis trade. And after going through these two bookkeeping items, I'll revisit the crowding out and discuss some potential general equilibrium effects that we should also take into account, and finally end the discussion with my own broad implication from these results that are somewhat different from a pure crowding out of a private lending part. Okay. All right, so jumping straight into comment number one, to me, this is more natural to interpret as an overall government bond crowding out story, okay? And the existing literature, there's this long-lasting existing literature that documents at least three main mechanisms by which the government securities can crowd out private borrowing. The first actually goes back to the Friedman 1978. You can think about the interest rate channel. So there's more supply of government bond in the economy, which raises the overall interest rates, which curbs private investments. So that's mechanism number one. Mechanism number two is more of a direct bank holding story. You can imagine as long as banks are holding more and more government bonds on their own balance sheets, which can crowd out rooms for making corporate investments. It's a little similar to the story here, but the existing mechanism in the literature is more about the government bond versus the direct lending substitution. And thirdly, in more recent years, especially coming out of the European debt crisis, we have this pretty extensive literature looking at the sovereign bank nexus. And in this mechanism, the sovereign stress, especially coming from the peripheral euro area countries, can erode bank capital, and with weaker capital positions, banks would cut lending as a result of that. Okay, so in addition to these three mechanisms, we can read the paper as putting forth a fourth mechanism in this government bond crowding out story that focused on the bank NBFI nexus. So banks fund NBFI's government bond purchases via lending them in reverse repos, and these NBFI lending crowds out direct firm loans. Okay, so that's sort of how I see it, and therefore I think it's quite novel, and it appears to be a phenomenon that's very much present, especially over the past few years, as a result of a large contraction of central bank balance sheet. All right, so now coming to the bookkeeping items. So this is what I have from a diagram in the earlier paper that illustrates this important division between the deposit institution arm and the broker-dealer arm within the same bank holding company. So you can think about, we have like JP Morgan, like Columbus, Ohio, versus the JP Morgan securities, okay? So the deposit institution arm, you can think about a very stripped down version of bank balance sheet. It's going to take deposits from retail and corporate depositors, and it's going to park those deposits at the Fed called checking account balance. Those are the bank reserves, okay? This is directly taken from the earlier paper where I had the adjective in front of reserves, which is drainable, meaning that these are the reserves that banks can deploy beyond their minimum regulatory requirements. On the broker-dealer side, a stripped-down version of the broker-dealer balance sheet would consist of repo on the liability and reverse repos on the assets. Okay. And how does it work? How can you actually have the banks responsible for most of the repo lending? It can work in this example if banks are willing to run down its checking account balance at the Fed, so use the strainable reserves to finance a repo lending. But in the most case, at least when we were studying the 6 largest US G-SIBs, you're going to see the actual mechanics is the banks are going to actually have an internal repo, reverse repo position vis-a-vis its affiliated broker-dealer. So essentially, the broker-dealers are going to on-lend the repo to the third-party non-affiliates, but the funding in this case is indirectly coming from the deposit institutions, which drains the reserves to support that additional lending. The convenience of this model is if you consolidate the left and the right, you see the overall size of the balance sheet stays constant. What banks overall on a consolidated level achieves is to have a lower amount of reserve balances and have expansion in the overall repo lending, which is pretty relevant during the QT environment. If you think about the overall amount of reserve declines, banks might have incentive to replenish with other liquid securities or liquid on lending, such as overnight reverse repo, or you can also imagine there's a lot of demand to finance these government securities. In either case, there's going to be expansion in the reverse repo lending, and that's largely coming from the broker-dealers. If you look at the US flow of funds data and also the H8, which is the total assets and liability of the US-based commercial banks, only on the bank side, out of the $26 trillion of total assets, about 3% are repos, and I suspect quite a bit of that is actually internal affiliate repo that on-lends to their own affiliate broker-dealers. Whereas if you look at the US-based broker-dealer total balance sheets, their repo position is 3 trillion versus 700 billion from the deposit institutions. So I think the fact is pretty straightforward that the broker-dealers are a lot more important when it comes to repo activities. And so that puts a little bit of attention given broker-dealers, as we know, historically don't really on-lend, originate loans to non-financial firms. So I think just to clarify a little bit, it would be really helpful to include more breakdown between the deposit institutions and broker-dealers, and to articulate what is the source of this increase in reverse repo lending. Is it coming from additional deposit? Is it coming from a drainage of reserves? Is it coming from additional third-party unrated repo financing? So I think a bit more data work is going to be quite helpful to articulate all these important differences. Okay, so the second bookkeeping item is to think, is this a European story, Euro area story, or is this a US story? So Dominic also showed this chart. The paper has many extremely compelling charts, and these two charts belong to the very compelling chart category. But if you actually look closely, the green line is the same across these two charts. So these two charts are plotting the private bond holdings in the Euro area and in the US in the solid blue line respectively across the two panels. And it's plotting the total reverse repo lending to all NBFIs in the dotted green lines. So naturally, you should expect to separate out the US dollar versus the Euro area denominated reverse repo position, right? Which the SFTR can definitely, and the MMSR data can definitely help you tease out that apart. And because there's going to be quite significant differences, right? If the story is more about the Euro area, then you can argue maybe it's more about the fiscal crowd out story, given the ANA credit data is more about lending to the Euro area firms. Or if the story is more about USD, then it's more of a story about European banks acting as important repo intermediaries to finance the US cash future basis trade for the treasury market. Okay. And another important difference, this is coming from appendix figure, and it shows the change in the government bond investor clientele during the QT period in the Euro area and in the US. And you can see quite a bit of a difference. So in both regions, obviously we're studying QT, you have a big contraction in the central bank holding of government securities as shown in this big red bar that's negative. In terms of magnitude, the US had much more aggressive QT, at least so far to date. That's over $2 trillion, whereas the Euro area only had about $600 billion. And who stepped in while the central banks was contracting? In the US, interestingly, it's the household sector, nonprofit. But then as many people in this room might know, this is the residual sector in the flow of funds, which notably includes hedge funds that are not attributable to all the other sectors. So the US story is very much consistent with the hedge funds stepping in when the central banks are not holding as much, whereas the Euro area story is less clear. I'm not sure which category the hedge fund would necessarily fall into, but it would be nice to discuss the story about hedge funds taking up a big part of the reverse repo funding should be consistent with them also becoming a big part of the cash security holders on the collateral side. Okay. All right. So now revisiting the crowding out story. This is like a classic, somewhat convoluted diagram for the US Treasury cash future basis trade. To really understand it, you basically focus on the hedge fund. What the hedge fund is doing is to get repo financing from the dealers. In this paper, this is the bank consolidated balance sheets on lending in reverse repo to hedge funds, and the hedge funds use that to finance treasury bonds, okay? But the hedge fund in this cash future basis trade doesn't stop here. It also has a short futures positions with CME where it shorts the futures. So the hedge fund is doing a relative value trade without actually taking any direct durational bet. So therefore, to really complete the general equilibrium story, right, there is this other guy who is the counterparty of hedge funds, and these are the asset managers. So asset managers are going to have a pretty long positions in the treasury futures. For what? To conserve its balance sheet to invest in something else, and that something else is the corporate bonds and mortgage-backed securities. So your overall crowding out story doesn't take into account the general equilibrium effects that in this specific example, which is again very prevalent and big numbers, as we'll see over $1 trillion of potential additional investments in corporate bond securities and in mortgage bond securities, that are also additional funding that flows back into the real economy, if you like to argue that way. And overall, you can also imagine this additional leverage that's been accumulating in the economy can be a source that drives down the overall cost of government financing compared to the counterfactual world when all the treasury securities are going to be all bought up by the real money investors. Okay. And this is as promised, the big numbers. The levered funds are on net short over $1 trillion in treasury futures, and the asset managers are on net long over $1 trillion. So big numbers. And that brings me to the final slides on the broad implications. In addition to the broad implication of potential crowding out of lending to the NFCs, it seems to be like, what are the costs? What are the consequences? What are the financial fragilities? To me, the broader implications is on the stability of the government bond markets with this massive rise of reverse repo lending to the hedge funds-ish NBFIs. Why? For a couple of pretty obvious bullets, repo funding is generally overnight, whereas bonds are multi-year duration. Haircuts rise with volatility. There can be a forced deleveraging cycle with a 2% haircut for these safe government bonds, which implies 50x maximum leverage. Many things can go wrong with 50x leverage. And also large concentration, right? As we know, if you go back to some of these Fed notes, we pretty much are talking about a collection of 20 hedge funds based in Cayman Islands that are responsible for over $1 trillion of these positions. And when you have such high degree of concentration with such high level of leverage, the risk of a significant tail event is quite elevated. And so far, all this discussion is on the US, right? Whereas if the same phenomena is indeed present, as we can uncover through some of these data in the paper, the impacts on the euro area can be even more profound because of this core versus peripheral distinction. For euro area, the peripheral bonds not only have the duration risk, all those inconvenience, et cetera, there's also significant credit spread components, and the credit spread dynamics can also end up in a significant downward spiral as a result of a forced deleveraging. So final bullet, the seemingly riskless, safe reverse repo lending can act as an important source of hidden leverage, which would significantly increase the tail risk of the government bond market. And that's my overall read of the broad implication. All right, thank you.
Thank you very much, Wenchen. We take questions and then we let the authors answer. Amar can start.
Yeah, I'll have to start out. First of all, I think this is a super cool paper. I really appreciate like getting into the actual aggregates of where bank lending to NBFIs end up. I guess I would take issue with this pitch about crowd out, that somehow, you know, through the banking system, the treasury issuances, or at least the residual treasury issuances, are crowding out bank loans to like productive firms. And there's a lot of papers that would suggest that that's probably not what's going on. So Amit's work, that just like in the long run, we know that banks over the last 20 to 30 years have been doing fewer and fewer, you know, loans to the real side, especially businesses. You know, Emil has a really nice paper showing that, you know, in more intangible economies, banks just don't do a good job of doing bank loans. So they go to real estate. And then there's this Tobias Berg paper that makes this point as well. So I'm just skeptical of this idea that, you know, what's really happening is you have more government debt. They lend the NBFIs and those loans would have otherwise gone to businesses. I understand you have the micro strategy that kind of shows some evidence of that, but on a macro standpoint, it seems pretty skeptical to me because this is a long-term 20 to 30-year phenomenon. So I would shift the focus. What I find super fascinating about the paper is the idea that in this world in which banks don't want to do as many loans directly to the US corporate sector or the European corporate sector, in my mind, it's because these businesses are much more intangible capital intensive over time, and they just don't want to do those kinds of loans. The point that I find fascinating is they're not primarily lending to NBFIs that are then in turn doing those intangible capital intensive loans. That to me is really fascinating, and in the long run, it raises a question of what's going to happen to banking in the long run. Is it just going to be, I mean, I guess that's already happened. It's just going to be government securities and real estate. And that's the only two things they're going to lend to. And even when they do the NBFIs, those guys are just pass-throughs to government securities. So one tangible suggestion is this is a last 4-year phenomenon. I know your data don't go back that far, but did banks ever lend to NBFIs maybe 10 years ago that did do more real side like corporate loans? So anyway, I think it's a great paper.
Thank you. Jason?
Can you guys talk a bit more about W1, the quantity of non-bank, of government bonds and the collateral constraint on the non-bank balance sheet? I would have thought that if the bank's holding only W1, of course, then when you issue more bonds, the price goes down, the collateral constraint gets tighter and it goes in the opposite direction. And it might give you a cross-sectional prediction that more the bank holds of W1, then the more you should have this price effect vis-a-vis the substitution effect you guys are emphasizing.
Amy? Oh, yeah, sorry, thanks.
So the paper's logic is the bank's balance sheet constraint, then more lending to the repo and less lending to the firm. The true question is, when does it happen? It has to be genuinely constrained. Otherwise, why don't they lend to both? The reason I want to bring it up is another paper by the ECB using the exact data. They show those banks tend to lending more to the mutual funds and other funds, especially when they receive additional liquidity from central banks, from ECB, after the long-term free financing ratio. So I want you to pin down, where is this shadow constraint? Why don't they just lending both to the each side? And a second question, Wenxing also mentioned this. I wonder how many of this lending is lending to the internal affiliated non-bank financial institution. So the narrative is you are bank lending to non-bank financial institution, but like Wenxing's paper and also our paper to showing, at least in the United States, most of the bank, they only lending to the affiliated broker-dealer, not to outside non-bank financial institution. So if you observe the same phenomenon, but the logic is different. One is your logic, banks lending to non-bank financial institution. Another is the holding company is reshuffling the internal organizational structure. So I want to understand better that one. Thank you.
Amy?
This is to follow up on the point that Amr also brought up, which is when I think about repo lending, it's incredibly competitive. Basically, everybody borrows at the same rate. My job market paper was about repo market power, and we're talking about basis points. But when you think about lending, that's really where the bank's alpha is, right? There's vast disparity in the rate that banks can charge. And so when you're comparing these two different products, it would seem like if I'm profit maximizing, unless there's some regulatory treatment that I'm not taking into account in my calculation, I would far prefer doing the loan extension origination as opposed to repo intermediation. So what am I missing? What regulatory, I guess, arbitrage they're working on here? Thank you.
Yeah.
Super interesting. I would love to echo a point Winston made, also maybe give you the chance to respond, which is what are the roles of hedge funds in your story? Because you show another very compelling picture of this story or the trend being almost completely driven by the rise of, I mean, it's all about repo lending to hedge funds. And then I wonder, given your rich data, can you tell us more about what do they really do? And especially in terms of basis trades, I think there's another very interesting paper, Jonathan, Jeremy, and Neil Kashyap talking about the boom and bust of basis trades. So if you look at those hedge funds unwinding those positions, would that show up in your data? If that's the case, maybe that's gonna give you another smoking gun test of what's really happening in the background. Thanks.
Interesting paper. I'd love a discussion about levels versus dynamics. So the rise of private credit and these NBFIs has certainly increased lending, and especially a type of lending that the banks were unwilling to do. David Sharfstein's has a paper precisely on this. But on the dynamics, yes, maybe these private credit lenders are more sensitive to the rate of return on government securities, that there's a stronger substitution effect there. Like banks are regulated to have liquidity requirements. They're holding that liquidity, and not because of the return on it, but because they're required to. So although substitution may be higher, the level effect of private credit increasing real firm lending may be much higher there.
Great. Thank you. Let's take 5 minutes for you to answer, and if there are more questions, you take another one. Go ahead.
Thank you so much, Winston, for the wonderful and insightful discussion. All the points are well taken. We'll definitely think a lot more about it. To maybe answer some of the questions, we don't have that much time, but to start with the big picture, the crowding out story. So in our overall framework, although we do emphasize the crowd out on the bank's balance sheet of the loans extended by the banks, there's also crowding out of loans on the NBFI's balance sheet. And so that does work through the model. So to the extent that we think the government bonds crowd out is actually working through the bank is not doing much real economy lending anyway. A lot of it's extended by the NBFIs. The crowding out story works through that channel as well. We cannot do as much micro analysis for the NBFI balance sheet, but it's in the model. And perhaps one thing we can do is use the model to decompose the two channels to see, does the crowd out effect actually work stronger through the bank or through the NBFI sector? So that's something we can incorporate into our overall framework. And then maybe to Jason's question about the collateral constraints. So the W1 is on the NBFI's asset side when they hold more government bonds. It's in terms of quantity that allows them to use it as collateral to borrow more from the bank. And that's what's driving the increase of lending from the bank to the NBFI sector. That's what we call it, the demand side effect. If it's not clear, I'm happy to clarify it maybe afterwards as well. Yeah. Oh, and definitely the bank is constrained for this whole story to matter, because if the bank is unconstrained, then the bank can lend to both the private sector, hold government bonds, as well as extend loans to the NBFI sector. The main constraint in our setting comes from two sources. One is the regulatory constraints, so think of capital constraints. The equity is expensive for the banking sector, or leverage constraints. And the second is just from its funding side, that if the whole banking sector wants to massively expand deposits, that's not a super easy thing to do either. So the funding side itself also provides a constraint in terms of the size that the bank can extend. Maybe let me talk a little bit about the repo, why the banks prefer to lend in the repo markets to the NBFIs instead of holding the loans, even though they earn higher return on the loans compared to the repo rates that they get by lending to the NBFIs. And there are two sources. One, again, goes back to the regulatory treatment. The NFC loans carry much higher risk weights, and also in terms of liquidity, they're not as good. There's a second reason, which is in our model, we assume that the banks themselves are risk averse, and also to take into account that their wholesale funding is also risk averse. And so the fact that the corporate loans itself is riskier than the reverse repo that they extend to the NBFI sector makes it less attractive and makes them require a higher return on those. And so on the margin, when there's a supply shock of government bonds, they are more willing to lend through the NBFIs and hold government bonds and substitute out of the NFC loans. And let's see. I do want to comment a little bit about what the hedge funds are doing and sort of the broader connection with the basis trade literature. There's a very interesting dynamics in terms of stability and the stability implication of the hedge funds are levered and the real duration is actually held on the mutual fund or the asset manager's balance sheets. There's a lot of interesting work on that. In our paper, we kind of abstract away from that dynamics a little bit. What matters for us is that the NBFI sector collectively, hedge funds plus the asset managers, are holding treasury bonds, are bearing duration risk on it, and they are taking leverage from the banking sector. And in terms of, this is related to discussion about the crowding out in terms of government bonds that we don't explicitly model in the paper. You can think of that as a real lending on the NBFI's balance sheet. So we can sort of lump the corporate bonds on the asset manager's balance sheet, think of it as a real lending to the real economy, and that part we do accommodate in our model. We can perhaps make it a bit more explicit and talk about exactly how large that crowding out effect is relative to the on-balance sheet crowding out effect of the banks.
Maybe in the last 2 minutes, if you want to take some more questions.
Yes, I think that's all I have to say. I don't know if Don.
All right, Erica, you want to go ahead?
Thank you very much. Very interesting paper and discussion. I want to echo Winston's point. The overall story sounds more like a financial repression. If I think that way, then this increased lending to NBFI sounds more like an indirect holding of treasuries or government bonds. And so then the question is, why do we during this period see more and more indirect holding of securities? And so instead of holding more and more securities through this traditional financial repression channel, why do they indirectly holding this through NBFI?
Great paper. Thank you so much. I wonder if you could talk at all about whether or not the broker dealers are able to repledge or rehypothecate the securities that they take from the MBFIs. My job market paper shows that broker dealers are lending to the mortgage companies and then repledge the collateral that they take from the mortgage companies. And this allows them to lower their cost of capital and increase leverage in ways that might not be fully captured by regulatory requirements. So kind of hide leverage in different places. And I wonder if this might be a reason why they actually prefer to do the trades in this manner, because they can lower their cost of capital and hide leverage.
Thank you. A bit unfair to you, but 30 seconds to wrap up.
Okay. Coming back to some earlier points as well. So we do observe that it's the hedge fund in Cayman Islands absorbing both the borrowing from Euro area banks, and this is against both the treasury collateral and the Euro area sovereign collateral. So it's kind of very symmetric across these two markets. Now, the intra-group versus outside of the group lending. So in the data we work with, it's mostly the extra-group lending driving the results. The within group sort of lending to the affiliated broker dealer, it's pretty flat. So at least, you know, kind of that's on net, it's the outside of the group. And the matched book lending by dealers, this is the case indeed in the data. So I think that's part of why they to kind of reuse the collateral, they are funded by repos, they do reverse repos, but at least in the aggregate, banks are net lenders in this market. So and this net lending increases on the backside. That doesn't mean that the dealers are not matched. It's just that the regular sort of depository institutions are net lenders still in there.
Perfect. Thank you very much. Thank you. We have a final break and we'll be back here in 30 minutes. Thank you.
And mic is on.
Sorry. And there is the
No clicker today.
oh, no clicker. Okay, so just this.
Yeah, so let me.
Okay,
Yeah.
perfect.
Yeah, can you hear me? Good. This is a session with the highest shadow cost of time. Haha. All right. So we should congratulate ourselves for true dedication to science. All right, we get started with deposit competition beyond rates, and Matteo Benetton is gonna be the presenter. Thank you.
Yeah, so thank you so much for the invite and thanks for being here. You chose to learn about the deposit competition beyond rate rather than soccer competition between France and Spain, so I really appreciate that. Let me try to summarize in one slide before I go beyond rate what we know about rate. So here you can see the federal fund rate in the last 10 years or so, quite a lot of movement like in the recent tightening. And then the average rate on checking and savings account that the largest bank in the United States are paying. And as you can see, there is quite a bit of limited pass-through. We can spend the next 20 minutes discussing exactly the extent of this pass-through. We all agree, I think, is quite a lot below 1. Depending on the data, the timing, it can be, very close to 0, 30%, 50%. But what we want to do in this paper is go beyond that. So what I show you now is, again, the federal fund rate. And then in red, you see the total volume of physical mail that these banks send to our homes in order to convince you to open a new checking or savings account. Okay, as you can see, there is quite a lot of mailing, on average 40 millions per month, and also quite a lot of variation with the federal fund rate. I'm pretty confident that all of you have received something like that at home. This is from Chase, which is the largest advertiser in our sample. So you can get $500. Most likely you throw it in the trash, but in case you open it, it looks like that. So you can get $300 if you open a new Chase checking account, and very importantly, you set up direct deposit. It can create a switching friction down the line. You can get $200 if you open a new savings account, bring in $15,000 and hold it on this account for at least 90 days. You're like, wait, Matteo, but wait a second. All the literature is not talking about this, is about pass-through on rates. Well, you can try to look at the rate. It's usually on page 5 and it's really tiny because Chase, even when the federal fund rate is 5 percentage points, is paying 1 basis point. Okay, so the starting point of this paper is that I think the literature now agrees that the deposit function is really a key source of bank value. And it has mostly focused and estimated rich quantitative model with elasticities of demand to interest rate. At the same time, banks manage this type of depositor base with potentially a richer arrays of tools, and this is implication for competition policy, monetary transmission, and risk. So what we do in the paper, and this is going to be basically my talk, we're going to leverage new data to provide some evidence on additional margin that the banks are using, and then develop a model that rationalizes the use of this margin and allow us to tease out different friction that might be binding and affecting competition. So the dataset that we use is provided by a company called Mintel, and we're going to focus on the compare media direct mail. So I like to tell how this dataset is constructed. There are basically about 17,000 households that are paid to collect all this physical mail, and rather than throw it in the trash, put it in a box and send it to the company. Then the company collects it, take picture, and create a dataset that sell to banks and other companies to do targeted marketing. This dataset has been used before, for example, by Antoinette on a paper on credit card. In this paper, we're going to focus on direct mail, although they are starting also to track emails more recently, and on deposits. What we obtain from this provider is, for the last 10 years or so, all the campaigns by the largest 11 lenders. So in this case, I can even put up the name. You can look at them. In the United States, there are thousands of lenders, but these 11 account for about 50% of the 13 trillion of domestic deposit as of 2019. And another thing that I think is pretty interesting is that these banks spend quite a lot of money on advertising. So Chase spends $3.4 billion, which is not too far from what Coca-Cola spent on the same year. This is not just for deposit, it can be for credit card and other product, but they seem to invest quite a lot of money on it. The raw data set look really like what I just showed you. This is Chase, take Citizen, very similar offer. $300 for checking, $300 for savings, 2 basis point interest rate. So what do? We put all these images into a large language model. There are a lot of details there, but we want to create our own data set with a key variable of interest, like sign-up bonuses. Does it require direct deposit? Is there a minimum holding period? And then we also got from the company information on the household that received the campaign, and recently a survey of switching behavior, which is unfortunately, though, not linked to the receiver of the bonus. So we cannot do like a standard demand estimation type of exercise. The rest of the data is pretty standard. So with this new data, some facts, and again, these are just a conditional correlation. So first of all, starting from what we know, when the federal fund rate goes up by 100 basis points, for the largest bank, everything I want to tell you today is not about Ally Bank or Marcus, it's about these 11 banks. There is very limited, basically zero pass-through on checking, more pass-through on savings, again, but very limited, about 13 basis points, and this is somewhat heterogeneous. So even within our 11 banks, some pass through more than others. Going beyond that, there is multidimensional pricing. So another pricing dimension is the bonus. The classic offer is $200 if you bring in $15,000 and keep it for 90 days. As you can see, this offer is quite small relatively to a depositor that sticks for 5 or more years. But at the same time, even with a high baseline rate of 4%, they might lose money on depositors that come in, take the offer, and leave in 1 or 2 quarters. The dynamics over time, so there is some correlation with the federal fund rate. So the bonuses tend to be slightly higher when federal fund rates are higher, but the variation is quite muted. So again, I'm going to show you everything in the same table so you can compare. A 100 basis point higher federal fund rate corresponds to a $13 to $16 higher sign-up bonus. So bonus size may be roughly constant, I would say. At the same time, as I show you, there is an extensive margin that is moving quite a lot, which is the amount of mail that they are sending. Same regression, same table. 100 basis point higher federal fund rate corresponds to an 11% higher volume of mail and amount and dollar spent on advertising. And interestingly, we do some heterogeneity in the paper. This is really driven by the banks that are paying the lowest rate, so the Chase and Wells Fargo of this world. But it's not just that, so we need to think also about marketing volume. This marketing is very strategic. So we have several measures in the paper. I'm going to just present one here. So using the demographics, we construct target groups by income, age, and location. And what you see is that basically when the federal fund rate is high, the mailing is not concentrated. It's like an helicopter drop of mail pretty much everywhere. When the federal fund rate is low, instead this effort is more targeted, potentially to customers that are stickier and then stay with the bank for longer when the rate reverses. Again, same table, 100 basis point higher federal fund rate at 12% lower concentration of the mailing effort. So everything I've shown you so far is like supply side. We also have something to say on the demand side, but I want to acknowledge that this is maybe the weaker part of the paper. It's based on a survey, and there are other papers, these days with much more detailed data on the demand side. Having said that, our survey asked people if they switch checking or saving in the last 12 months. And what you see that as the tightening happened, also switching for checking and saving increases quite a lot. Again, in our framework, in our regression, 100 basis point higher federal fund rate, about 10% more switching. What we also can figure out with the survey, it's unfortunately a repeated cross-section, so we cannot observe the same people over time. But the survey asked, did you switch in the past 12 months? And do you plan to switch again in the future? And what you see is that both unconditionally and controlling for a bunch of demographics, people that have recently switched are also more likely, or at least they have an intention to switch again in the future. potentially suggestive that there is like a switcher type. And at the same time, this was extremely encouraging for our model. They are asked, when you switch savings, what do you value? And you see that they don't seem to value much the interest, potentially because for many banks it's terrible. Instead, they value sign-up incentive and sign-up bonuses. So to take stock of the empirics, we find that when the federal fund rate increases, there are indeed very limited pass-through on rates. And I think this is very much in line with the literature. But at the same time, other things are happening. Bonuses are potentially changing. The mail volume is changing quite a lot. There is less targeting and more switching. So with this additional fact, then maybe we want to rethink a little bit models of banking that have been focusing on rate to include bonuses, so multidimensional pricing, and also maybe a targeted margin, which is rationalized by the existence of heterogeneous depositor. So in the second part of the talk, I'm going to try to, again, in a short talk, sketch this model. So there is bank and there is depositor. We have a continuum of bank who are competing for heterogeneous depositor. We allow bank to pay an interest rate on the deposits, but in the paper, we show that paying actually 0 rate on your current depositor is optimal. And what is the intuition I want to just give here is that if depositors are sleepy, which is what we find in the paper, the retention elasticity to the rate is very small and is lower than the awake demand elasticity to sign up bonuses. And through the first order condition, then the retention markup is higher than the awake demand markup, all the way to be 100% markup. This will be the end of a model based on rates, but our model has other margins. So bank can compete by offering sign-up bonuses, B, to a fraction alpha of the population of depositor. We're also assuming that they cannot pay bonuses to their current depositor, which is in line with what we observe. So think about our model as a model of acquisition pricing, basically. This is not free, so they have to pay a marketing cost, which is linear in the fraction of the population of depositor that they are mailing the offer to. And we're going to consider both the untargeted case and the fully targeted case in different calibration of the model. Then how the bank make money, think about they put in the federal fund rate. On the depositor side, we also have a continuum of depositor, and there are 2 types, active and sleepy. This is a persistent type. In the population, there is a mass mu s of sleepy, 1 minus mu s of active. The active depositor are always awake. So let's say every quarter, they are looking for the best option. The sleepy guy instead are awake only with the probability psi sleepy, which is strictly less than 1. In the current model, conditional on being awake, the 2 types are identical. Okay, so they only differ in the probability of waking up. Banks that offer higher bonuses are more likely to be considered by the awake depositor. Switching is not free, maybe because of direct deposit, so there is a delta cost to switch bank. And then we also have this logic trick, so there is a matching utility. Some people like Bank of America more than JP Morgan for some, preference exogenous reason. The depositor is consuming the interest, the bonus, so we don't have to keep track of a time-varying wealth distribution. Wealth is constant, and think about wealth as $15,000 that is on the savings account. So with that, let me define Q as the density of a type, active and sleepy, at a bank J in a period T. In the paper, we derive D star, which is the equilibrium switching probability. And with that, the value of the bank is actually pretty intuitive, is the value of your existing depositors and the value of the new depositor that you're going to attract with your strategy. So the key object is really this VXB, which is the value for the bank of the marginal guy that they attract. And so what's the intuition here? How do they make money? They have a flow profit. They're earning the federal fund rate and pay 0. However, they discount this flow profit with what we call an effective discount factor. So there is R, you're discounting future profit, but there is also this endogenous departure rate. Why? Because people might wake up in the future and they might leave as a function of the equilibrium strategies of your competitor. So there is basically a dynamic strategic substitutability between banks. The type is private information of the depositor. So what does the bank expect? The weighted average value of a marginal guy is a weighted average of active and sleepy. But as you can see in the numerator, this is weighted not just by their share in the population, but by their share in the awake population. And so we have sort of a natural way, I think, I mean, not maybe standard, but pretty transparent, to show adverse selection. So the marginal depositor value is going to be lower than the average. And the reason is that an active guy is going to live at a higher rate in the future, but is also overrepresented today in the awake population. So with that, we have a standard first order condition. How do we determine the optimal bonus in equilibrium? It's a function of the marginal depositor value minus a markdown. So this is really price equal to marginal cost plus markup. The markdown is a function of competition with the current bank and other banks. And what you can see is that basically, even in a world with no traditional market power, so no product differentiation, sigma goes to 0, and perfect shopping, theta goes to infinity, the equilibrium bonus can be low, even with a very valuable average depositor, because the marginal value is very low. Perfect. So again, intuition for the equilibrium, we basically have three regimes. If the rate is very low, the marginal value is low, it doesn't justify the advertising cost, nobody's mailing and offering bonuses. We call it this no competition region. Going at the other extreme, high marginal value, the banks are mailing everybody because it's a linear cost, and then they start to compete on the bonuses, which have a higher convex cost. This is what we call the intensive margin competition region. And then in between, what's happening is as the interest rate increases, the banks are competing more and more on mailing. This generates an offsetting effect that the lower the marginal value, and in equilibrium, the two basically offset each other. And so competition is only happening on the mailing margin. So this is what we call the extensive margin competition region. My favorite part, we take this to the data. We are able, even targeting just a few moments, to match quite well the relatively muted sensitivity of the bonus to the interest rate and the very high, on the right, sensitivity of mailing volume to the interest rate. According to our estimates, active depositor is the minority of the population, about 8%. So most are sleepy, and the sleepy guys are very sleepy. So they have about a 1.5% probability to wake up every quarter. With those numbers, we can explicitly compute what is the value of a sleepy guy for a bank. So this is a depositor that is putting down $15,000. The bank is taking about $8,800, so 60% of the deposited wealth. On the active guy, the value is roughly the one of the bonus. So our model, you can think about the famous Gabay-Leibson shrouding, but we also have imperfect competition. Otherwise, they will lose money on the active, whereas that is not necessarily the case in our model. We can then compute the extent of adverse selection. So the average depositor value is pretty high at $7,800, but the value of the marginal is much lower at only about 958. So the gap between these two is our definition of adverse selection. Still, equilibrium bonuses are not $900, they're only $200. And so we can use our new data where we observe the bonus, and the difference between the value of the marginal guy and the observed bonus give us a sense of the extent of traditional market power. So the markdown coming from product differentiation, which is not 0, is about 758. So then we can put the two together, and the results is that adverse selection explains the vast majority of the gap between the value of an average depositor and what does the depositor get, which is the $200 sign-up bonus. With the estimated model, we can then run a counterfactual, which is potentially of interest, is what if we go into a world where everybody is sleepy? So ex ante, you might think, oh, that's great for the bank if everybody is sleepy. But if truly everybody is sleepy, we have killed the adverse selection channel. So now what banks starts doing is with this two-part tariff, they start competing a lot for this very valuable sleepy depositor. And again, it doesn't go all the way to perfect competition, but the depositor get a much higher fraction of the money deposited, about 75%, because the bonus rises to $4,500. Okay, so in the last minute, to sum up, we confirm the fact that banks charge substantial deposit spread when the federal fund rate increases. And again, this is very in line with the literature, and is potentially due to, again, recent work by Mark, Ali, and co-author on inelastic switching coming from sleepiness. At the same time, I think the really key to takeaway of the paper is, number one, that's not the end of the story, because there are other margins through which banks compete for depositor, and these margins vary with the federal fund rate. So if I have to summarize all the facts in one, what banks do is they expand customer acquisition unconditionally when rates are high, and they contract it conditionally, focusing on specific groups when the rates are low. Despite this additional competition margin, they still don't pass through the full value of a sleepy depositor. But the reason why they do it might not have to do just with traditional markdown from product differentiation, but with depositor heterogeneity. So if, in some sense, sleepiness is preventing competition using rate, the existence of activeness is preventing competition using this additional tool, which is sign-up bonuses and marketing. So thanks a lot, and I look forward to Gregor's discussion and the question.
Clicker? Okay. Thank you for having me discuss this paper. It's frustrating. I wanted to work on this, but then they wrote the paper, so I guess I'm not working on this. But I get to read it, I guess. So I retitled this paper as the discount coupon theory of deposit franchise, because the theory really works kind of like a 1980s or 2000 theory of when you go to a store, why don't they just lower prices? Why do they give you a coupon? And some people use the coupon, and then you go and get a discount. And you'll see how that insight of 1980s kind of translates into what does that do to the deposit franchise, get some really interesting results on competition, and so on. Okay, so this is a paper on the discount coupon theory of deposit franchise and how it affects, how it does with interest rates. Okay, it gives us a new intuition of why deposit rates are insensitive to interest rates, because that's not where competition happens. It happens on discount coupons. More broadly, it's if you're into the literature on does the deposit franchise hedge interest rate risk, the answer of this paper is no, it exacerbates it. It's got positive duration, not negative duration. Okay, and that's because, as we'll see, competition increases as rates rise. And I think that's actually a really neat result that I could have gotten the discount coupon result, but I think the competition result actually is kind of like you read it and you're like, ah, I get it. This is cool. That's a very nice result. Okay. And then the last result I would call it, or at least the one I'll focus on, is more of a quantitative result that kind of says, I look at the average depositor and they seem really profitable. And then I look at bonuses paid and they're pretty darn small to attract these really profitable deposits. Like, what's going on? And like, there's two sort of possible theories. One is inelastic, so we can just rip them off. Or there's adverse selection, like the people we attract with the bonus are the super flighty people. So I think we have all this intuition now since like, last couple of years, there's like some super flighty people, you offer them stuff, they take it, then they run away to somebody else. Like that's the fintech kind of intuition, right? And they're gonna call this adverse selection. And I'll talk about this, okay? Why did I want to work on this topic? I think this is this paper rolls in many underexplored topics, I think, in finance in one framework. Multi-tier pricing, people have started working on. Matteo has a really nice paper with Alessandro Gavazza in mortgages. And the idea really is, look, we've all focused on one instrument that banks / financial institutions have in doing stuff, which is normally pricing, some rate or yield or something. But no, really, you have like an introductory rate, and you have a reset rate, and you have a bonus, and you have a temporary yield, and so on. You have all these tools that you can pull. Like, why do you do one or the other, and what are the interesting implications? And this paper does that. There's the dynamic pricing, which people have been working on, which is think of it as invest and harvest part of the exercise. You attract some people in with introductory stuff, and then you rip them off because some people are sort of sleepy and they forget to re-optimize. That'd be like the refinancing literature is probably the most common one of these. And then I think the paper somewhat speaks to the super underexplored literature on awareness. We all think about financing as a brand, but part of the way competition works in finance, which we haven't thought enough about, is that everybody knows JP Morgan. So when they shop for a product, they know about JP Morgan, but they don't know about a random bank around the block, which might have an awesome product. And how does marketing work? And this awareness piece is, I think, super important. We haven't done much on it, okay? And this paper does a lot of it. And then it does the one last thing, which is it sort of says, we're gonna learn how banks market. And from banks' marketing behavior, we're gonna learn about how banks think depositors act, and we're gonna learn a lot about depositors that way, which I think is a fruitful way to think about this, okay? So the way I'm gonna proceed is I'm gonna start sort of backwards with the least important piece, the how do interest rates hedge the deposit franchise? Then I'm gonna talk a little bit about the theory, and then I'm gonna talk about why I think the adverse selection piece is actually not first order in some sense. There's something there, but I'm not sure I completely agree with the authors on how it works, okay? So deposit franchise and interest rate risk. Let's just put up a simple model of why there's a deposit franchise and how it's sensitive to interest rate risk. Like this is the simplest model I can write up, okay? You have like some assets, you have a monopolist bank, it's got some assets, they have positive duration, rates go up, assets fall, not very important. And then they have deposit with some face value D, they owe the depositors D, okay? And the nice thing is these depositors love their bank. So the bank can rip them off and pay them less than the risk-free rate. In fact, it can pay them like a mu of the risk-free rate. Think of this as an all-in cost of depositors, okay? So what's the value of a bank in the absence of things like fragility? Well, it's assets minus liabilities. That's assets minus deposits. Plus you get back the fact you can rip off depositors. That's your deposits times the present discounted value of the ripping off of depositors, which is what you make, let's call it the risk-free rate, minus what you pay them, divided by the risk-free rate, okay? And people frequently think about the benchmark of a fixed, how does interest rate risk play into that? You really have two factors, right? One is, of course, it's the assets, but then as the rates go up, your franchise value declines because, well, it's a long-dated asset. You get to rip people off in the future, but also potentially you have to reprice your deposits. That's the mu piece, and that's the cash flow or markup effect if you want to think about it. The standard model people have in mind is like a fixed beta model of when interest rates go up by 1, deposit rates go up by beta. In that model, as you'll notice, the discount rate effect and the markup effect cancel out. So with a fixed markup model, there is no interest rate sensitivity to the deposit franchise at all, okay? So if you want to get what this paper gets, which is as rates go up, deposit franchise goes down, you have to have that the profitability of deposits drops as rates go up. And if you want to do the hedging, it's got to go the opposite way. So for example, common way that you get deposit franchise hedging is you assume fixed cost. And as deposits expand, fixed cost per deposit go down. In this paper, it's the opposite. Profitability of deposits goes down. So how does the discount coupon theory work through that? Okay, 2 steps. One is it starts with this observation that we all know that deposit rates have a very low pass-through rate of interest rates. Okay, and normally the way we think about it, I think at least by we, I mean me, is we say something like, well, it must be banks have a lot of market power, either because people think they're special, or people are not aware of the banks, or something. There's like huge switching cost. Okay, and this paper says you've been thinking about this wrong. The insight really is what's switching a lot as a rate switch is advertising quantity. That's the main margins of adjustment. And the question is why? It's all about inframarginal leakage when you compete. So here's what I mean by inframarginal leakage. You spend $1 to attract, you try to attract a marginal person. Where does the money go? So imagine you raise your deposit rates by a little bit when you want to compete. Who gets, how much do you have to spend to get the marginal person? You got to offer all depositors, old and new, extra stuff. That's expensive. Instead, you could just offer a slightly higher bonus, like the mailing thing that you got. You offer a little bit more money there. The nice thing is you only offer that to the new people, but all new people get it if you want to attract one more person. That's also somewhat expensive. Or you can send more mailers. And if you send more mailers, you're going to just spend the marketing cost on the marginal person, least leakage. That's the reason why in this model, in this paper, but presumably also in the data, what you get is when rates rise, you send out more mailers. You don't raise the bonus and you don't raise interest rates, okay? This is exactly the intuition you kind of get on this old literature on discount coupons and inframarginal leakage. You don't raise prices, you raise quantity of mailers, okay? Step one, I think that is like a nice way to think about deposits through an old school theory. And that was sort of a neat insight I didn't have before. After some really like, yeah, that works, okay? Second step is competition and rates, which is, wait a second, why does this affect the deposit franchise and how it responds to interest rates? It's kind of neat. And the intuition is very simple. When rates go up, I want to grab some more people because the deposit gets more profitable. I send more mailers. Everybody sends more mailers. That means in some ways, people start competing across more and more banks. And because they do, the banking sector endogenously gets a little bit more competitive on the bonus mailing side. And that drives up competition. And when that means my residual elasticity as a bank is higher, it's almost like the market got a little bit more elastic. I want to raise prices, aka more mailers, a bit more. In equilibrium, more competition, okay? Also in the model is awareness. People are more aware if you send them a bonus. I think that's actually a sideshow. That's a bit distracting. I actually don't think it's really needed, the results go through, okay? So that's really neat. Like this was a super neat, the equilibrium insight for me was neat. I didn't have it before reading this paper at all, okay? Okay, caveats. I actually think that in this model, the equilibrium interest rate is negative. Right now it's bound at 0, but I think if you let it float, it'll be negative, which might be okay. But I don't know how the comparative static works with a risk-free rate when you have these two things. If rates go up, does the interest rate get more negative and bonus mailings go up? Like, I don't know. It'd be useful to know. Also from the paper, it's hard because the interest rate is set at 0 de facto. I don't really know what job rates play. I mean, they have a role, but in some ways now, we used to think all the action was the rates and we ignore bonuses. Now all action is in mailers and rates don't do anything. The perfect theory would tell us about both. Now, can we require perfect? Might be too much. But, and the last thing is, if we're gonna be quantitative, tells us deposit franchise is even bigger because we capped rates at 0, it should be negative, okay? The second question is, how robust is the competition result to target? There's a bunch of this is a pretty big literature in quantitative marketing, is how do we target advertising? And part of the literature is like this is very nice Villas-Boas, Iyer, Soberman, Villas-Boas paper says, like, you don't target switchers. You target your loyal people because the switchers suck anyway. I think the intuition survives mainly because what we see in the data, which is mailers go up with rates. But I think this is sort of something I'd like to a little bit understand better. Okay? That what I thought was neat. And the last piece is, I sort of think of this as a theory of mid-sized traditional banks sending bonuses. It's not really about huge banks because they have special awareness. It's not about fintechs because they compete on rates. It's like PNC Bank or Truist or something, what I think fit maybe best for this, but that's just a prior, okay? Okay, the last thing I want to talk about is this adverse selection, because I think it made me think a lot. I think this dichotomy, low bonus, high value is a really useful one, okay? But I think once you start thinking about what the issue is, it gets a bit more complicated. So the problem with adverse selection is you offer a bonus, you get people who are going to grab the bonus and then run away. They'll eat the bonus and then just go, and you won't be able to rip them off. Okay, and how does the paper identify this? It says, well, depositors look really sticky, so average depositors are super valuable. People who switch tell us they really want to switch a lot, and bonuses are small, okay? Now, I actually think the switching thing is not, I think the surveys are just a little bit off. Like I called an acquaintance of mine who works for a quantitative a consulting firm on deposits. And pretty much the estimate they have is after 12 months, 3/4 of deposits you get from cash bonuses are still sticky. And there's very little runoff after that. So I think quantitatively, people are not as flighty conditional coming as I think this suggests. So that's one. And the other one is, I think there's an easy solution to adverse selection, which is don't give people a bonus if they switch too early. And in fact, firms do that. If this is like a BMO smart account checking, and they say, look, we're going to pay you the cash bonus in 100 days. And if you think the 100 days is too little to rip the person off enough to make up the bonus, make it 120, make it 150, schedule it. In fact, if you look at around the, on Reddit, people discuss how like these bonuses aren't as good as you think they are because they have all of these things that make them kind of hard to track. Okay, so I think big picture, banks can ensure that switching too fast is just not that profitable. I think from a perspective of the model, it may not be terrible. It just says, you can always have a bonus that's going to be profitable for the marginal person or zero profit. I think that'd be fine. But I think the other question is, if banks don't take up this lock-up solution, what does this tell us about their depositor behavior? Okay, and I think the last one, which might be most subtle, is what instruments could banks possibly use to separate people who run really fast, medium fast, and people who are kind of like me, like you put your money and then you let yourself be ripped off? I think it's an interesting question to ask that I think we want to address. Okay, so let me wrap up. I think this discount coupon intuition to understand why deposit rates are insensitive is a substantial step forward. I mean, it's not like once I tell it to you, you're like, makes total sense, but I haven't thought about it before, and I've thought about these issues. So this is very nice. I think there's this subtle insight on why competition rises with rates. I think that one is nice. The paper could, I think, comment on it a little bit more, but I think it's super subtle. I wouldn't have thought of it. Really nice. But it has strong or quantitatively weak implications in the paper, but it's got implications for exactly how deposit franchise hedging works. I don't think depositors are as flighty as the paper does. I think that's just too much on the quantitative side, but I think they can figure that one out. Stepping back, I shockingly, I think depositors are still super poorly understood. Like there's something really weird, right? Like we have these inelastic depositors. They just don't move. And banks can earn huge rents out of them. So we think like, that's awesome. But then you see banks that compete quite hard for these supposedly inelastic people by investing in like non-price dimensions. Like Chase is putting in a bunch of branches and they advertise a bunch and so on. And it's like there's this weird dichotomy that people look like we shouldn't be competing hard for them because like, well, they're inelastic. We don't compete with them on the thing that we can normally see, which is price. But we do a lot on things we normally don't think about, which is like other things. I think that's a fun thing to think about. And this paper starts to solve that, which is really good. Okay, thank you.
Basic clarifying question is, you have this actual expense that I pay to advertise and market, and then I kind of felt like it disappeared. I didn't see where is it, like, is it in the markup calculation? Is that considered a marginal cost? And what exactly does that accomplish? I didn't see it in the utility function of the, like, what does that accomplish exactly? Maybe it's somewhere hidden.
Go ahead, Gav. You might have to turn it on because they turned all the mics off over the break.
I've never figured out how to turn them. Okay, this one's on. So several people in the room have written papers kind of talking about how this has changed over time, and particularly my understanding is that this is quite a bit less sensitive to interest rates. The bank deposit rates are quite a bit less sensitive in the most recent cycle you're looking at, starting in 2014. And I was wondering if you can use your model to think about why that's the case. Are we sleepier? Is there an exogenous change in competition? Can you shed a little bit more light on those arguments?
So I like this aspect of the bonuses. Actually, Dominic and I collected this data too, but you guys beat us to it. So two things. One is we did find that the bonus follows the interest rate very cleanly, so I don't really understand the difference there. I'm not saying it's as big as you would expect under some model, but it seemed to go up and down the way you'd expect when you can make bigger spreads on people. You'd be willing to pay them a bigger bonus up front. The timing was like right along with the Fed funds rate. The other thing was, and it connects to work we've been doing on the credit card stuff, is my view is that a lot of people are pretty rate insensitive. And I don't know if to call it inelastic. They're not paying attention, don't care that much. We see this on the credit cards because they have extremely high rates, huge variation even within the same credit score. And instead, financial companies go at people with huge amount of marketing. We saw that, we talk about that a lot in the credit card paper. And that goes to the deposit aspect, the branches. And so another aspect of it, but I think it's just one more, is these bonuses you pay people. So they're insensitive to the rate, but if you wave rewards at them from the point of view of credit cards or a bonus for a couple $100, they do somewhat respond to that. And so I don't see that as like extremely like puzzling. I agree. I believe that you wouldn't want to wave like a $2,000 at them and just let them leave. Then there are people who kind of what you're calling the adverse selection. But I don't think that it's I guess I don't think it's that puzzling that you would increase the amount that you pay them when you can make more money off them, when people do kind of respond to these kind of cash rewards, whatever you want to call them. So.
Let me add one thing, which is that at least when you talk to, well, the others here, when you talk to banks, one thing that worries them a lot is that actually they understand that they have a lot of noise in how they estimate the flightiness and the stickiness of people. And because of it, right, they don't want to be so aggressive in when they give bonuses, because they know that they are mistargeting to a very large extent. And then it's also the case that the larger banks are much better at doing it than the small banks, because, you know, big data, right? We know that the small banks understand themselves that they don't have as good data to compete with the big banks, so they have to be even more careful. Therefore, they're, you know, giving even smaller bonuses, which reduces on net, right, the competition. And so maybe it's not, you know, this actually supports your result, right? It's maybe not so surprising that they don't go to 2,000. They have to stay somewhere around 200. And I talked to the CEO of Citizens, for example, and they say, even with that, they still feel that it's not clear to them that it's NPV positive for a bank of the size of Citizens. But they feel that for JP Morgan Chase, right, they're doing a really good job on these type of things. The one thing that I found interesting, you know, and I find that, you know, obviously this whole endeavor very cool, is that we haven't seen, you know, obviously, you know, on the credit card side, we've seen that the targeting is much more specific in the types of points and miles and cashback and so on that's given that people at the low end versus the high end of the income distribution have very different utility. And it's interesting that right on the deposit side, this haven't happened so much yet, right? It's not like, oh, I give you insurance for your car trip and I give you, right? So that in itself is interesting. Maybe we're just getting there now slowly and it will start being this kind of thing. Or is there something inherent why you can tie more interesting bonus types to credit than you can tie to deposit? And then there's one more question behind.
Interesting paper. One possible explanation I wonder whether you considered for why the bonuses are small is that I'm not trying to wake people up. I'm trying to find someone that's awake and have them pick me. So the bonus only needs to be compared to the next best option that they have. So do you think the bonuses are trying to wake up sleepy people or trying to catch people who happen to be at this moment awake and then just pick this bank over that bank?
One data question. I don't know whether you have data on offers made to customers of the bank and other services who might be less likely to switch. You might be identify some of your adverse selection thing off of that.
Why did you answer one round and then we see whether there are other questions?
Hey, thanks very much for a great question. Hear me?
Mm-hmm.
Now?
Yeah.
Yep, there it goes. Okay. Great. All right. So thanks very much for the questions. And thanks to our Gregor for a super interesting discussion, some great references and some great ways to think about some of the results. On the cost of the mailing, so it is in there. It's a linear cost basically that scales up with the amount of mail that you send. We just didn't really, in the interest of time, have exactly where it shows up in our calculations. But basically, when we calculate the value of the bank, the franchise value, that's the value of the existing depositors, plus basically the value of your depositors you're going to acquire in the future. And it's in there. So the value of acquiring those existing depositors includes basically how much money you're going to make on them when you acquire them, but also the acquisition cost, which includes the bonus and also the cost of sending the mail out to them. So when we do our more likely to acquire a customer to spend more on marketing. Correct. So yeah, so we basically have something that looks similar to like a logit demand function, and there the quantity of mail that gets sent out, it basically increases the probability that someone's going to be aware of your offer, basically. Yeah. Less pass through over time. I think that's a very interesting idea, and we could definitely explore more. What kind of happened prior to 2014. The reason we've sort of focused on that period up until now is that's basically when our data starts. And so we've been focused on that period. But I think certainly we can think about and do some more comparative statics within the model to think about, in earlier periods, why might have there been more pass through. With the bonus, so I'd be interested to know kind of, we might want to compare a little bit about how we extracted the bonuses and to see if there's some sort of discrepancy. The one thing that I think we do sort of theoretically make the point is that, and I like this kind of point about inframarginal leakage, which is there is a good theoretical reason for why you start by increasing the mailing volume before you start increasing the bonus as they become more valuable. So and Matteo showed these figures, which is that for this intermediate region, as basically the federal funds rate goes up and these people are becoming more valuable, you basically exhaust the mailing margin, which doesn't have these inframarginal consequences, and then you exhaust that, and then you basically have full pass-through to the bonus. And so at least in our extraction of the data, we said, and to be clear, if you looked at his figures, it is flatter than we see in the data. So the bonus does move. I mean, we do find that the bonus does move with the federal funds rate, and we're actually a bit flatter in our model than in the data. But certainly, at least from what we saw, it does seem that the bonus is not moving as much as the mailing volume in response to the federal funds rate. And then I'll just say a little bit about there were some comments about adverse selection. So I think the points are all sort of really well taken. And I think that what our model is getting at is that in our model specification, it's very much that we have these active guys and we have these passive guys. And because the passive guys are, quite sticky, they're not actively looking for a bank. So even a small amount of active people can really create a compositional effect where the people who are actively searching are heavily tilted towards this active population. And then that can create this effect that even though your average depositor is very valuable, your marginal depositor is much less valuable. Now, I think you could ask, well, maybe these active people, maybe they are too active in terms of the calibration. I think that's basically what was Gregor saying. But I think what we're sort of getting at more generally is that one way you can understand why the bonuses are so low is that if you try to raise the bonus to $2,000, and this is sort of what Jonathan was saying, you're just going to make this bonus very salient, right? And so we've sort of have this stable population of active versus passive. But if you start offering people $2,000 bonuses, like people are going to start realizing, well, that's a pretty good idea, and maybe I should get out of my current bank so I can just get this $2,000. And so I think the broader idea is that there are limits to basically that even though these people look very valuable, as you try and increase the bonus, you're going to really start facing all these sorts of issues, which is it's going to be really hard to target, as Antoinette said, and you're really not sure about who exactly are the active people. You then are also people who were sticky are now going to become active because it just becomes much more salient. Maybe you're going to bring in some people from money market mutual funds because now it's actually a better idea to just start basically playing this bonus game than parking your money in money market mutual funds. And so I think in general, the idea is that we can kind of understand these low bonuses relative to the size, which is that at some point you are going to kind of be facing a lot of adverse selection problems in different ways. because of salience issues and things of that sort. I think that's sort of generally what the model is trying to get at, but I'll leave it there for now.
If I can add that 1 minute, perfect. Yeah. So just a couple of things to add to Itamar, and again, I think this data is great if they use more. We received the Excel file from the company, and then we decided to create our own because a lot of these bonus offer have a tier structure. So you see $200, $500, $1,000, but with different minimum requirement. So we thought to create the time series, we wanted to have our own data, but again, happy to chat more. I think on Antoinette and Doug, we haven't exploited it much, but there is this distinction between retention email and acquisition email. So acquisition email, you're a fully new customer of Chase. Retention is, let's say you are a credit card customer and you receive an email to become a checking account or savings account customer. And the pattern with the federal fund rate is actually a bit different. So the retention is less cyclical, perhaps because they know more about their own customer. The limitation to really test adverse selection is we don't have take-up data. So I think we can do something more, but maybe not fully satisfactory. Yeah.
Thank you, everyone. And last but not least, we have stress testing private credit, and I think David is presenting.
Thank you, all you non-soccer fans, for being here. There's no clicker. Okay. Great. So this is joint work with Sergey Chernenko, and I think most of you know that there's been tremendous growth in private credit. We've seen some papers that have sort of gotten at that a bit. We're going to focus on an important type, or probably the primary type of private credit, which is direct lending. These are largely loans to middle market private equity sponsored firms. There are, of course, other forms of private credit that are not included in this picture, including, commercial mortgages and consumer loans. And one of the key things to know about this is that banks and insurance companies play important roles in funding private credit. Even if they're not directly holding these loans on their balance sheet, they're lending to private credit funds. We're focused here on the financial stability concerns that folks have raised a number of issues, the possibility that banks can incur losses on their loans to private credit funds, that banks have exposures to some of the firms that private credit funds are lending to, and they might therefore also suffer losses, that there can be violations of bank loan covenants and regulatory limits on the amount of leverage that private credit funds, or where we're going to focus on business development companies, can incur. And as a result of that, those private credit funds might have to delever. That's one of the main focuses of our paper. That there could be difficulty rolling over debt, borrowing by private credit funds, which could also, again, lead to delevering. And then there's concerns about redemption. We've seen that a lot in the newspapers recently. Redemptions from private credit funds, particularly to these semi-liquid business development companies. These have grown dramatically over the last few years, particularly in 2025. Now about $300 billion, and that these redemptions, which are typically capped at 5% per quarter, could put additional pressure on BDCs, leading to more leverage, less lending. And so basically, we're going to look at a model of BDCs under stress, business development companies under stress, in a very stressed macro scenario, and kind of ask what they do in response to that stress. And it will touch on, essentially, except for the second one of these, is going to touch on each of these sources of instability. So we're focusing on business development companies for a few reasons. One is they represent a sizable share of direct lending. Secondly, there's a lot of data on BDCs. They have to file, because they're 40 Act funds, they file with the SEC, so we can see through to their portfolios. And third, some types of BDCs, these term non-traded BDCs, very closely resemble limited partnerships that are the typical private credit funds. So there's a lot of private credit that goes through these limited partnership private credit funds that are not BDCs, but these term non-traded BDCs look a lot like those. So we think we're actually getting a pretty good look at what's in the portfolio of private credit funds. And we're able to look at a range of different structures. The typical leverage of a BDC is about 50-50 debt and equity. The publicly traded private credit funds, so these are the ones that are basically closed-end funds that have a stock price, have leverage of about 50%. The perpetual funds, these are the ones, these semi-liquid funds where we've been reading about the large redemption requests, have about 43% leverage. These private limited partnerships with finite life have about 40%. And this lines up reasonably well with other evidence on private credit funds. Okay, so our approach is we're going to basically run these BDCs through a stress testing scenario. The key issue that's going to come up is that BDCs are regulated based on their asset coverage ratio, which is essentially the fair value of their assets less non-debt liabilities divided by debt. And the 40 Act funds, these BDCs, are basically required to have greater than 150% asset coverage ratio. If you like to think about it in terms of leverage, they have to have leverage less than 67%. In addition, when they're borrowing from banks, they typically have an advance rate of 65%, meaning that for every $100 of collateral, the bank will lend $65. So you can think about that as about 2/3 leverage as well. And what happens in a stress scenario is that the fair value of the assets, can go down dramatically, reducing your asset coverage ratio, and then pushing you into a point where you're either violating the 40 Act restriction or you're violating covenants on your bank loans. And we want to see how do BDCs respond to that stress. What do they do in response? So we're going to run it through this macroeconomic scenario. We're going to build on the Fed's severely adverse scenario. We have to build in some more assumptions, so we're going to use some experience related to the GFC to build in some additional assumptions. And then we're going to value the portfolios of the BDCs. There are two major issues. One is, of course, what's the default rate going to be, which is going to affect the value. And then there's an issue about what's the security valuation. As spreads widen, what we'll see is a reduction in the value, and we're going to mark to market their portfolio. And one of the questions we're going to look at is their full mark to market. Are the BDCs going to fully mark to market, or are they going to not pass through all of those marks? And then we're going to make a bunch of behavioral assumptions about how BDCs respond to the stress. So, and what we're effectively going to be doing is, so default rates go up, spreads go up, that reduces the asset coverage ratio, i.e. increases leverage, increases the likelihood that funds violate their regulatory restrictions or the debt covenants on leverage. And then what do they do in anticipation of potentially to avoid that default or to avoid that violation? And we're going to examine the deleveraging that occurs. That is, how do they use their free cash flow that they're generating, assets, potentially asset sales, and cash buffers to pay down debt so that they don't violate these ACR limitations. And there's an issue here about whether they can sell assets that we'll also kind of be looking at. And so our baseline estimate is that BDCs use free cash flow, cash and asset sales to reduce debt and kind of cut lending by about 14% of assets on average. There's significant variation across BDCs in deleveraging. We find the largest amount of deleveraging for publicly traded BDCs, the middle amount for perpetual semi-liquid BDCs, and pretty limited 7% deleveraging for term non-traded BDCs, which again reflect the kind of broad mass of other kinds of private credit funds. About half of that deleveraging occurs through asset sales. But there's a question here about, can you actually sell assets? Right? They're highly illiquid. They're designed not to be sold. These are not broadly syndicated loans. There's a select group of folks that could actually buy those assets. So if you can't sell assets, what we estimate is that somewhere between, depending on what type of BDC and what assumption you make about pass-through of spreads into valuations, you get somewhere between 30 to 60% of BDCs being in technical default on their debt. That is, they violate the asset coverage ratio restrictions, although in our simulations, banks still fully recover on their loans. Okay, an important point to remember there is that banks have asset coverage ratios that well over 100%, right? So they are well protected. And so even if you have valuation losses, they get a recovery. The key question is, will banks forbear when funds default? That is, when you have these defaults, what are banks going to do in response? And we're going to look at what happened during the GFC for these BDCs that actually did technically default on their loans. And so here's the macro scenario. In the interest of time, I'm not going to go through the detail, but it's a significant drop in stock market value, big increase in yield spreads, peaking at 10% over triple B spreads, and the default rate peaks at 16%. SOFR drops. We have to figure out kind of like what the default rate is going to be. We have very detailed data on what the portfolio is, so we know the industries. And so we estimate industry default rates based on sensitivity to aggregate default rates. We're going to do a bunch of simulations here where we're going to be drawing a industry default rate that could vary across each of these runs of the simulation. And that will give us an estimate for each of the BDCs on what the actual default is. We assume equity securities are wiped out and that there's like a 60% recovery rate. These BDCs have loans, they have equities, they have joint ventures. Again, we do the valuation on all of those. And we're also going to do some forecasting on cash flows. This will be an important piece of whether it can be an important piece of whether they are able to pay down their debt. And cash flows are, income less expenses. And we look to the cash flow statement to figure that out. We take account of some of the facts. We take account of the fact that some of the interest income is PIK, so we don't think of that as cash flow. And we take into account redemptions, which is the focus of a recent paper by Yao and Itai in a recent paper. And we're going to also look at drawdowns by portfolio firms. We're going to look at dividend reinvestments, and we look at uncalled capital commitments. Now, we make a bunch of assumptions about BDC behavior in response to stress. We don't have a full-blown optimization model. What we do is we say, well, the goal is to maximize assets subject to constraints on this asset coverage ratio. So that's the basic goal. We have reduced form rules of behavior rather than a full optimization model. And basically what we're assuming is that if you've got positive free cash flow and cash, you're essentially using more of that free cash flow to pay down debt as your asset coverage ratio falls. So the idea is asset coverage ratio is falling. You're using a larger share of your free cash flow to pay down debt. And part of the rationale for that is that as your asset coverage ratio falls, there's a variety of factors that I'm not going to have time to go into the details on that make it harder to run a BDC. They have there's a greater likelihood that you're going to breach the covenant. It can affect your credit ratings. It may increase the probability of redemptions. And there's a variety of factors. So we make that assumption. If you look at the data, what you do see is that as asset coverage ratios fall, what you see is that BDCs use a smaller share of their free cash flow to reinvest and make loans, right? So they're definitely like aware that as your leverage is going up, you're trying to keep that leverage ratio down, so you're not violating covenants, and you're reinvesting less, you're paying down more debt. Okay, there's many limitations to this analysis, which I'm sure you'll point out. Let me just summarize briefly the main results. What you see is that in this stress scenario, the asset coverage ratio drops sharply and recovers gradually as you're coming out of this adverse scenario. Most of the initial decline is due to fair market value changes. We're quite aggressive in hitting the fair market value because we have the spreads going up very dramatically. So you're losing about 36% of the value of the assets by the fourth quarter. There's the default of about 12% of loans in default by the quarter 8. And as I mentioned, the median BDC deleverages by about 14%. Most of that deleveraging occurs in the first 4 quarters. And there's large cross-sectional variation in deleveraging. The key thing here is, so one of the observations is that publicly traded BDCs experience much larger and more persistent decline in assets, and that's related to the riskier portfolios that they have. Perpetual BDCs start out, these are those semi-liquid ones where there's these redemptions. Perpetual BDCs start out with much higher ACR, asset coverage ratios. They're less leverage, but by the fourth quarter, their ACR, their asset coverage ratio, falls to about the same level as the publicly traded BDCs, and that's because of redemptions. So what we're seeing is that perpetual BDCs that are going to get these redemptions start out with less leverage, presumably aware that there could be these redemptions, but in a stress scenario, they end up in the same place as the perpetual BDCs. And here we see deleveraging by type of BDC. The biggest deleveraging is, as I mentioned, the publicly traded BDCs. The next is the perpetual. And then these finite life BDCs have the least amount of deleveraging. And again, those are like, if you think about 75% of private credit is through these other types of private credit funds, not BDCs, these you're going to see the least amount of deleveraging amongst those. We do some analysis looking at how a bunch of different assumptions affect our conclusions. Key thing here is that if there are drawdowns by portfolio firms, there will be more deleveraging in the rest of the portfolio. Of course, you are extending credit to the firms that are drawing down. And an important assumption is this pass-through of spreads into value. What we do is we look at spreads basically on leveraged loans, and we're seeing this big increase in spreads. There's a question here about whether or not BDCs are marking their assets to market. Are they marking it to what would, into publicly traded, into traded securities or not? There's concern that they're not doing it. The fact that if they don't do it, there is a benefit to them in the sense that their fair value doesn't go down as much, their ACR therefore doesn't go down as much, and they do less deleveraging. So there is, and there's a question about what is the right measure to be using for fair value? Is it some fire sale price in the market, or is it some kind of non-fire sale, actually intrinsic value? Key question here is also, are sales going to be allowed? Are sales of assets possible? And in the world where sales are not allowed, you're going to have less asset sales and I should say most of the deleveraging is occurring through asset sales, right? That's how you're staying in, would happen through asset sales, and that's how you're staying in compliance with ACR. If you can't do that, you have a harder time complying with the asset coverage ratio restrictions. And what we see is that, like in the case of perpetual and publicly traded BDCs, something like 70% of them would go into technical default. If there's less pass-through, then fewer of them will. Finally, so one of the issues here is what happens when they go into technical default. And so to understand that a little bit better, what we did is we did some case studies of BDC behavior during the GFC. So we look at 20 BDCs with at least $100 million in assets and an ACR of less than 400%. What we identify is that there was deleveraging, there was reduction in debt as their ACR fell, that BDCs that started out with a higher level of ACR did less deleveraging. And then we also find that there was forbearance. That is, banks did not just liquidate BDCs that were in technical default. They kind of forced them to delever, so they were doing less lending. Yes, that's a message to make, right? They forced them to do less lending, but they basically did not shut them down, take on the loans on their balance sheet. Eventually, some of those BDCs were sold and there was a more orderly liquidation. So I'm not going to repeat the conclusions, but I do want to make note of two other facts here, which is that this is not to say there will be deleveraging. The argument here is that banks are well protected in the sense that it's unlikely that they would incur losses. That's not to say that equity investors don't incur losses. And in our scenario, they'll lose about 50% of value. And it's also the case that unsecured bonds that also fund these BDCs, which are typically held by insurance companies and mutual funds, would be likely to be downgraded to speculative grade. These are, however, a small share of insurance company assets and assets of mutual funds. So look forward to the comments.
Thank you very much. The discussant is Giovanna Relatia.
Yeah, it's like right. Well, thank you for inviting me to discuss this paper. The usual disclaimers apply. I still need a job for a few years, so please. So the paper is very interesting, and I don't need to repeat what David just did. It was a super clear presentation. Let me give you some background. These animals have been growing very fast. Private credit is now about 8% of what US banks provide to the private sector. And the BDCs are maybe not an enormous share of this, but it's about 20–25% of private credit in general. And when you look at direct credit, they are bigger, of course. And the question, so the paper does a very good job in providing a quantitative assessment of the risks associated with these new animals. And in particular, I think it's critical to give us a much better and much clearer picture of whether this is a concern from a regulatory standpoint. And I'll comment on that in a second. So the findings, I don't know if it's a little bit hard to decide whether these findings are benign or not. In the sense that you have substantial deleveraging that can be an issue for the sectors in the economy that are exposed to these intermediaries, and can be an issue, of course, for the investors in the intermediaries. But there is a sense in reading the paper, and maybe I'm wrong, maybe I got the wrong sense, that this is very hard to generate a systemic crisis by stressing these animals. So given I'm paid to be paranoid, the rest of the discussion is, how do I make these things worse? What is a shock that could make the situation worse for these intermediaries? This is a summary of the stress test. And again, David just covered that, but think about it in this sense. You have essentially, the shock comes in two forms. One is there is an aggregate default rate that goes up to about 17%. And then there is an assumption that the spreads on these lower rated loans will follow more or less what happened during the GFC. They apply industries betas to make the default rate industry specific. They shave a little bit of the spread increase because loans are less sensitive than bonds to that. And then they compute the portfolio default rate. They apply about a loss given default of 40%, so a recovery rate of 60. And the new discount rate, of course, is a more complicated function than just the increase in the spread, because, for example, the Fed is assumed to cut monetary policy rates aggressively. So you get the new asset coverage ratio, and then you have on the right-hand side of the screen, you have the behavioral assumptions for the companies. If the asset coverage ratio stays above 200, then they reinvest the free cash flow. They have no problem. If it doesn't, then first you use the free cash flow and liquid reserves to delever. And then at some point, if it goes even after that, it goes after 150, then you have to liquidate the portfolio. Then they have additional factors which are very important in determining how much deleveraging you do, which are in particular drawdowns by the portfolio companies. So there are credit lines essentially that these companies would access. There are dividend reinvestment plans in some of these things. So basically how much the original investors are willing to reinvest the dividends directly. And there are some capital commitments. I think a very interesting exercise is assuming that the Fed doesn't cut monetary policy. So you are in a stagflation environment where the Fed cannot cut monetary policy aggressively. And that, of course, complicates the situation. And then maybe the most important one is the one David spent some time on, is the no sales scenario. So again, being paid to be paranoid, how do I stress the stress test? Well, first, I would observe that we know from a large literature now that credit booms are typically associated with bad things. And the interesting thing of the literature by now is that it's almost like a fractal thing. So credit booms at the macro level are bad. Credit booms at the sectoral level are bad. And credit booms at the individual banker level are bad for different reasons. So SVB, for example, if you look at the assets of SVB, there was a massive increase in credit. And has nothing to do with the quality of credit, but there is something wrong with credit booms. And if you look at the right-hand side here, you see that it's almost a poster child for a credit boom. At the same time, it's true that leverage is very low for BDCs, but it has been increasing. It went, I mean, I don't have my glasses here, but I think it went from 0.2, 0.3 to about 1:1 over the period that is covered by the data. And so the one concern is about whether lending standards, screening, leverage ratios in the portfolio companies have become much worse over time, in which case the default rates may exceed historical norms. Now, granted, the GFC was pretty big shock, but one can think about worsening of that particular parameter. The second one is a portfolio concentration. And so they use a very large shock, but it's a macro shock that then percolates down through various industries. But a lot of these companies are very exposed to information technology companies, in particular software as a service. And we have seen, because of AI, a lot of stress in that sector in terms of if you look at the pricing credit spreads for bonds that are priced in the market, you see there's been an increase in spread quite dramatic. And also these companies tend to have a low recovery rate, typically it's about 30%. So again, you have a default that is not according to industry betas, but concentrated in parts of the portfolio where the BCDs are very exposed, and potentially you have larger losses given default. Now, the third part is maybe the most interesting part, and the one that maybe is linked to the paper by Yao and Itai, is that these loans are very opaque and the valuations are very difficult. And so when during a true stress event, the question whether you can actually sell them at a fair value or not is very important. And in particular, I would think that if you're forced to sell, you will first start selling the most liquid of your loans and the easier to evaluate, which means that you're imposing losses on the rest of the portfolio. And so the assumption that the discount that the valuation of the portfolio is constant during the stress period can be challenged. And indeed, you know, it's very hard to run these companies, but maybe you can jog them. And every quarter you have redemptions, and the redemptions themselves put the seed for further redemption in the quarter after, because the valuation left on the portfolio gets worse and worse because of adverse selection. Finally, we know that the exposure of the bank so far has been limited, at least we think, but the linkages are very uncertain. Banks may be exposed to the same portfolio companies, so there is that link of sort of know your lenders side. Banks in a macro shock like that may be in trouble themselves, and they may have problems with liquidity at the same time. And this is something actually that our monetary policy and capital market department is obsessed with. There can be hidden leverage in the intermediation chain. And so it could be that the investors themselves are levered up, and we have very little information on that. And so you could have greater default cascades than you would expect otherwise. So, you know, just this is the last chart. And you can see that the exposure of banks to NBFIs in general has been increasing quite dramatically over the years. And for the chart in the middle, it gives you the coverage ratio relative to tier 1 of this exposure, where the little green parts are committed loans. They have not been drawn. The gray one is the ones that have been drawn. And you see for many banks, both in Europe and the United States, the overall exposure exceeds tier 1 capital. I don't know what happened to the horizontal line, should be at 100, but it moved a little bit. And then this is for the NBFI sector in general. On the right-hand side is the revolving liabilities of BDCs themselves, and they are normalized to 1 in 2015, Q1. And you see that those have increased dramatically too, and they are also very volatile over the cycle. So I'll stop here. I think this is a super interesting paper, and thank you for forcing me to read it and read a lot of other things, because I knew really very little about this before. Probably still know very little, but a little bit more. And I think that I have seen is one of the few places where you can actually have a rigorous quantitative examination of these problems. The rest is very chatty and fluffy. So this was super useful. Thank you.
Thank you. Emil, David?
Does it work? Okay. I was wondering if you could just talk a little bit about the accounting rules and sort of how these assets actually get written down. I mean, if I think about the assets. They're very opaque. There's no market prices for them. If I think about banks, often, supervisors come in and force the banks to recognize losses. So how does that work for the BDCs? Is it the SEC and the supervisors, or could you have a scenario where there's kind of forbearance and basically they don't violate this ACR rule just because they take a really long time to recognize the losses?
Yeah, I was wondering about the risk of a credit crunch. So you mentioned this at the beginning, but basically those BDCs will stop lending. How big of a deal is it gonna be for the sectors that are relying on it? Like, we know that they are very exposed to IT, but is IT really dependent on their lending? Probably so. And who can step in potentially? Like, is it the case that there are like some other actors that could step in? I mean, yeah.
You?
So you focus on deleveraging assets to respond to distress, but restructuring the liabilities is often a preferred kind of way to respond to distress, as David has worked a lot on. So why abstract from that margin, and have you thought about interacting these two margins?
So thinking about the overall financial stability implications and just connecting to the very interesting paper we had this morning, I wonder about if you could sort of use your stuff to say a little bit more about the impact on insurance companies. I think David mentioned pretty quickly that these losses might be small relative to their assets, but it seems like they might be pretty significant relative to their capital. And there was some idea that this might cause sort of further knock-on effects. So just kind of curious about that.
Thanks, super interesting and forward-looking. And thanks to both David and Giovanni for mentioning my new paper with Chuck and Itai. Maybe I'll very quickly share one point which I learned from that project, and that can be potentially helpful. There is a notion about hidden leverage there, which we highlighted, which is a trade credit or delay payments, in that when you look at the data, and like 2 years ago in 2024 and 2025, and for each dollar of net outflows within the 5% cap, so pretty much that's half and half split by liquidating loans and borrowing from credit lines. As you mentioned, as those loans become harder and harder to sell, and as those BDCs become closer and closer to 115% regulatory constraint, they have nothing to do. What they do now is they basically delay the payments, even if they promise people they offer redemptions 5% every quarter, but they actually do nothing. That means that they issue something called permission, and it's called promissory notes. So you can think of that as trade credit. It's like to their equity holders. Instead of paying them cash, they just delay that, and they never tell them when they're gonna pay. I think that's something probably you can also incorporate in your simulation, because that means that legally they have to still pay that 5% at some point, but it's just nobody knows when they're going to pay that. And that definitely, suggests some transfers from, maybe banks are fine because they are becoming smarter. They know probably they're going to say no to those undrawn credit lines, but at the end of the day, equity holders are going to bear the cost.
Yeah, so I was just going to be a bit contrarian, because I've been also giving presentations on private credit to regulators, and Giovanni's exactly right. They are in fact paid to be pessimistic. And so let me make the argument that maybe you guys are even actually being too pessimistic in yours. So just to take the contrarian, I'm not going to believe these things, but I think it is important to have both sides of it. First, I think the leverage ratios of BDCs are substantially higher than the leverage ratio of private credit funds, which are 75% of the overall universe. The estimates from Gregor and Amit's paper, which is a very nice paper, but I think there is sample selection. We do have Form PF data from Theodore Berg at the OFR, and they're showing that essentially 70% of private credit funds have no leverage at all. And that if you aggregate them, it's about a 20%, 15 to 20% debt over assets. So I just think like the leverage levels in private credit funds are remarkably low. So remarkably low that it's actually a puzzle from an intermediation standpoint. And again, every time I presented this result, we also have a paper with Form PF that is taking forever to get approved. But I can say enough to an academic audience that the numbers are consistent with what Theodore Berg's found. So again, if there is hidden leverage, people say about CLOs are different. They are, of course, more levered. But the standard private credit funds doing direct lending are remarkably low leverage. So I think the BDCs, I understand why you're focused there, but I do think the private credit funds are much less. I already told you guys this in private correspondence. The private BDCs, their boards can cut redemptions to zero. And I think they will cut them to zero in a scenario like this. And so even the redemption effect that these cash flows will leave, I've had arguments with Viral, if I'm not here, whether they will for reputation purposes or not. I think if it's another GFC kind of event, I think they will cut to zero. And you don't have that, you have them cutting to 5%. And then I think the third issue, which is very closely related to what Georgia just said, which is, let's look at the biggest default that's happened so far. It's Medallia, right? Medallia Software defaulted. The three private credit funds, Apollo, Blackstone, and KKR, they took over the company and they are running the company as equity holders. That's why applying our kind of normal fixed income mindset to this industry is very difficult, because it's very difficult to understand. This is related to Emil's point on the accounting. The recovery rates are not like they are for fixed income. These guys are going to take over these businesses and try to run them, right? And they claim that they know how to do it. Who knows? I mean, those guys are private equity funds. And so just calculating what the actual losses is, and think about the incentive of the bank. The bank probably is going to want to believe at that point, or at least pretend to believe, that these guys are willing to run these companies and they can turn them around. So again, I'm not necessarily believe all these points, but I do think that it's important to see the other side, which maybe even your scenarios are excessively pessimistic.
Maybe, can I say one thing and then let you answer? I mean, in this scenario that Amma just laid out, but that to me is actually a bit concerned, because it's basically the fact that this could be taken over, right, by private equity, and then the reckoning of the low returns can be actually delayed by quite a bit. It can be then, how to say, depressive. Exactly. It can be zombie landing. That's the real problem, right? And therefore retarding for the economy for a much longer period. And basically the investors in these private equity funds are going to bear the burden without actually much repercussion to force any change, because there's just so little active governance that happens in these type of funds. And so, all the governance has to then happen at the extensive margin, but pension funds will keep investing in this stuff. And so I'm just worried that it's basically will affect growth more than maybe a crisis. But I should let.
First of all, thank you, Giovanni, for helpful discussion. And thank you for all of the questions and comments. I'll start maybe with kind of, I guess, our general approach, in that we are trying, I think, to be relatively pessimistic in kind of considering a relatively extreme set of, kind of making a relatively extreme set of assumptions, in particular about the increase in spreads, right? It's targeted towards effectively spreads on single B rated bonds, right? The actual spreads that BDCs and private credit funds are likely to use is likely to be much smaller. So that means that the effect on ACR is going to be smaller, right? And at the same time as assuming a very large increase in spreads, we're assuming that redemptions are going to be also relatively large, even though we generally think that redemptions are large because like maybe funds are not marking to market, but in our case, funds are marking to market like in a fairly extreme way, and at the same time trying to meet 5% redemptions, right, for at least like 4 quarters. Related, I think, to this is this question of like credit boom and our defaults going to be higher than we assume. First of all, like the defaults are not like the main driving force in our results, because the defaults are kind of like relatively slow to pick up and realize, right? Most of the shock is happening immediately. That spreads widen significantly. That drives fair values down, right? And that kind of causes initial deleveraging. Defaults kind of happen later on, but by that time spreads are kind of like narrowing. And so the defaults don't play kind of as much of a role. The other point I would make about that is that, like we're benchmarking defaults relative to GFC, and presumably defaults there were high because there was a credit boom before. So I think in that way, I think we are capturing kind of like these kind of credit boom type effects. On the accounting rules, so these are level 3 assets. So it's kind of up to the discretion of the fund essentially to kind of like how to value them. Having said that, they do use third-party valuation providers to prepare their financial statements, and banks, when they lend to private credit funds and to BDCs, require the use of these third-party providers for valuation, and also kind of like retain some discretion in valuing the loans themselves. On the credit crunch component, I mean, I think like what we say in the paper is like we estimate this contraction in credit, but again, it's very difficult to say what are like the implications of it really, right? Because a lot of this is going to private equity sponsored buyouts, and presumably the kind of like volume of that activity is going to dry up as well. So it's kind of like difficult to say about like welfare implications that, okay, like credit will go down 14%, but presumably buyout activity will probably drop even more than that. Interesting point about like we haven't really thought, I think, about restructuring of liabilities, and something that we should think more carefully. On the effect of trade, kind of like trade credit and redemptions, my impression, although mostly anecdotal, is that it's basically just like a month that they delay payment, right? Because the way that the redemptions are structured is that sort of you got the redemptions this quarter, maybe by March, March 30th might have been the cutoff, and then you're gonna pay that in April, like a month later. But we should discuss, but I don't think like the trade credit is a very huge factor here. Okay. David, do you have?
Not much to add. On the insurance company piece, I think what we have another paper where we look at what the insurance company exposure is. It's something on the order of there's about 90 billion of outstanding unsecured bonds, of which insurance has a little under 30% of that. But you're right, from BDCs, I think private credit funds are doing, correct me if I'm wrong, Sergey, less of the bond issuance. Yeah, but you're right. I mean, the right metric is not their assets; it's their capital. So it's good. Thank you.
Cool. With this, thank you very much. Thank you to everyone for sticking with us, and see you in the fall, hopefully. And now I will not tell you